What's up, Tasty Nation? Welcome back to the show. Hopefully you had a great holiday weekend. Feels like Monday, but it is Tuesday. This is Tasty Live. If you're watching, listening, welcome. Ryan, how you doing? How was your weekend?
I'm well, thanks. Yeah, it's just us today. 3 hours of period. Yeah, it's gonna be awesome.
Yeah.
Weekend was good, man. Beautiful weather here in Chicago, so I'm sure you were out enjoying it as well. Been packing up my apartment. I've got to move in another week, so that's kept me somewhat busy. And I got outside a little bit, had a couple beers, hung out over at my brother's, grilled out. How about yourself?
Similar. I went to Lake Geneva. So
beautiful.
My brother owns a bar in Lake Geneva.
Oh, really? Okay.
And
you get a drink for free?
Sometimes, not that time, because I was like outside because they had a live band there. But it was really funny because it's like you just know you're deep in Wisconsin when like the live band, the guy's like 60 years old, and his shtick is he drinks an entire bottle of Jack while he's like performing.
Wow.
Yeah. So, and it's just like it was great. He was great. But yeah, headed up there for Saturday, played golf Sunday morning. That was fun. And then yesterday, played some more golf.
2 rounds.
2 rounds in. Yeah. I have some friends that got 3 rounds in and they have newborns. I'm like, what are you doing? How are you doing this?
I don't know.
Yeah.
I have one, and I'm getting 0 rounds in.
Yeah.
Wow, that's fun, man. I want to dig deeper into this. He drinks an entire bottle of Jack while he's on stage. He finishes the set. How many years has he been doing this for?
I guess 20. Wow. Like it's got to be a big number.
That's crazy.
Yeah. He was a bigger dude, so he could handle it more efficiently than I could, of course. But yeah, it was a good time, perfect weather, and that's about it. Hopefully everyone had some good eats, some good hangs with the holiday yesterday. But yeah, it is kind of odd because it feels like Monday. Certainly not. But you said you're moving. Are you the type of person that is okay with moving? Like I despise moving. There's nothing worse than like packing stuff up and then moving and then getting it. Like it's just never something I would want to like. I would like to think that I would help my friends do X, Y, and Z. But if they ask me to help them move, it's just a hard no. Like I can't do it.
Yeah, I mean, look, I'm 38. If my brother or somebody else was like, "I'm gonna help you move," I'll just give you some money, put it towards the movers. I would prefer not to move any of the stuff myself. I don't like it. Nobody likes it. You got to pack, unpack. It's a pain in the ass. But yeah, I think it's easy enough. You know, you get it in the boxes. You get the moving guys come in. We'll get through it.
Yeah.
Try not to think about it.
Yeah. That's actually probably the best strategy is just turn the brain off, do the things, and then all of a sudden you're good. But with movers, it takes like less than an hour to go from point A to point B.
I mean, when you're younger and you're moving from apartment to apartment and you do get your buddies together and you move over the weekend, or at the time, she was my girlfriend, my wife now, helped her move out. And then you hire movers for the first time. And it's like, oh, never again.
Yeah.
Never going back.
Yeah.
Always will hire a moving company. So, yeah, we'll get through it. Excited to get into a new spot, have a little bit more space for my baby.
Yeah. Absolutely.
Yeah.
If you want to join us on the YouTube channel, we're streaming live there as we will be all morning. We've got a jam-packed show for you, and it's going to be fun because the market is up yet again. Every single day, market goes up. But the writing is on the wall here. E-minis are up 50 pre-market, NASDAQ up 320, down the Russell up as well, Bitcoin up 1,500, ETH up, and crude down 4 points. Gasoline futures also down. Everything down related to energy, I would say, except for natty gas. That's catching a tiny bit here. But what do you think of this preliminary market movement?
Yeah, I mean, I think it's a lot of what you're just seeing coming off of, well, yesterday and over the weekend. Some headlines floated that we might be closer to more discussions around an agreement, peace in Iran, end to the war. I think we've seen a lot of this before. I haven't seen any further details as of this morning, but oil traded a bit lower than where it is here today. And I think that's kind of what you key in on. That's the barometer here. Equities have been going up kind of regardless. But oil weaker, at least the initial response took you down to 90. Some of the back months were sub 90, but it's caught a little bit of a bid. I mean, shortly thereafter, last night, you saw that I believe the U.S. struck some Iranian boats in the Strait of Hormuz. So U.S. launches self-defense strikes near Hormuz, killing several Iranian personnel. From what I saw, they were laying mines. So I don't know how close we are to a peace deal, if that's still going on in the background. And you saw, the response there in oil. But again, I think that it's still an environment in which you want to be long equities. You have some headline risk here and there. For the most part, coming out of earnings hasn't mattered too much to the equity market here, pretty much at all-time highs or near there. But yeah, my read really, Mike, is that not much has changed.
Yeah. Feels that way. Volatility super low. And it's always weird because like anytime you get to all-time highs, you have this natural feeling of like, we have to go down from here, right? Like we can't just keep going up, but
got to pull back, right?
Yeah. But I mean, at the same time, you got almost a 2-point contango now between the M and the N contracts, 1.5 from the N and the Q in vol futures. Like the vol futures go from 19 to 22.5 all the way out in the V contract. So the market's telling us that things are calm, even though global tensions are still there.
Apologize. I don't know how to turn that off. There's a ding and it's not getting filled on an order. It's when I just changed the symbol. There is an indicator or something. It's an alert. So I'll try not to do that, but
the people love it.
There, yeah.
People love it either way. But yeah, kind of a wild, interesting market open. And last night too, this is like exactly where we were. So we'll see how the intraday movement comes out this morning. But SPX, just kind of a landscape of the rest of the week. You've got the end of month contract, May 29th, 3 days from now. Less than 100 points of an implied move for SPX for the rest of the week. But it is a truncated week, so I would say it's not all that bad. But still, 100 points for a week is nothing. 55 points still priced into today's movement. So half the movement for the rest of the week is priced in today. I guess they're telling us that people are going to trade today and then just get out of here for the rest of the week.
Just chill out.
Yeah. Couple of housekeeping items real quick. Next Thursday, June 4th, the landscape of trading will change. Pattern day trade rule will be eliminated. And this isn't just pattern day trading. I think this is really interesting because we've had a bunch of meetings about this and discussions with the trade desk. And they're like, well, pattern day trading affects people under 25K, where if you have less than 25K in your account balance, and that includes futures, since futures are swept into a different vehicle. But either way, if you have less than 25K and you're day trading, you would eventually get hit with this PDT rule, which prevents you from day trading more than 4 times in a 5-day rolling period. But what's also going away is starting day trading buying power, which is something that I used to get hit with all the time because even if you were within that 25K or outside of the 25K range, if you were day trading more than your starting day trading buying power, you get hit with that call, day trade call. So this actually affects a lot more people because it has nothing to do with the 25K rule. If you have 100K and you're using 90K of your available capital, and then you sell out of whatever positions you had and you're day trading more than that difference of 10K, you get hit with the day trade call. So that's going away as well. So ultimately, traders are going to have a lot more freedom to do whatever they want. I think it'll open up a lot of avenues for risk management specifically, just because we see it so many questions all the time of people like, I have this spread on, it's a winner, but I can't close it because I'll get hit with the day trade. So what can I do? And it's like,
that sucks.
It's insane. It's like, oh, well, you can turn this into a box spread, or you can do a 1-day calendarization, something like that. But yeah, all of these rules are going to be replaced with intraday margin requirements, and they're a lot more seamless, a lot more modern, just because we have so much new tech now. Like the tech that we were using 20 years ago is very different than the tech we're using now from the brokerage risk standpoint. Like the brokerage can see when people are over levered and are in a bad position, and they will, they can be disallowed. So yeah, scan the QR code if you want to learn more. But if you go to tastytrade.com/June4, we've got a landing page there. You can see a lot more information, and it's going to be great. We'll be ready day one. So you don't have to do anything. If this has affected you ever, the PDT rule or day trade calls, anything within the change that's happening, you don't have to do anything. It'll just automatically be updated from the broker standpoint. And again, we'll be ready day one. So June 4th, you'll be good to go. We also extended the double commission promo. So if you don't have a Tasty account and maybe you're getting back into the game with the elimination of the PDT rule, you can earn a 200 commission rebate. You can scan the QR code on the screen there and get your double commission rebate.
So with the cap of $10 at Tasty Trade, clear it up for me, Mike. You go in and let's say you place an iron condor, you do it enough times, it's $10 commission, you're getting $20 back. Is that how this works?
Yep.
200%?
Yep.
Math is correct there?
Yeah, 200% up to $3K over that 30-day period. Yeah. Which is pretty substantial, especially if you're super active.
Yeah, I mean, a great incentive if you're not a Tasty Trade user to at least check out the platform, open an account first, get in there, see what it's all about. I think that Tasty Trade is one of the best platforms for actively trading options. You go back to something else after using this for so long. It's happened to me just a little while ago. I had to sell some equity that I had in another account, and I'll just say this: you take a lot for granted. You're using Tasty Trade. Just the workflow, really.
Yeah, I saw some meme. It was some.
Oh yeah, I know.
You know what you're talking about? Yeah. There was some guy that was like, he was trying to get his clients to like not trade and just like invest and hold it for years. And he's like, I would just tell them to open this account at this place because the interface is so terrible that you couldn't even trade if you wanted to.
You'll never trade. Yeah.
So good.
That's fun.
But yeah, join us on the YouTube channel. Let us know what you think about the PDT rule going away.
Chat's popping off here today, Mike.
Yeah. The people were fiending for some action in the markets here after a long weekend. Yeah, I see some Knicks fans. I see some basketballs. Yeah, that was crazy. I wasn't expecting them to get swept. I thought Cleveland would actually be able to win a game, but they just got decimated last night. Insane. So we will have Chris Vecchio on shortly.
Oh yeah.
And he probably doesn't believe it's real. I mean, interested to hear what he has to say. First time the Knicks have gone to the finals, I think, since 1999. So awesome. Long time.
Yeah, I'm seeing missing Batistas. We're missing the Batistas too, and it's definitely not the same without Vanetta. But this will suffice.
Yeah, it has to. The show must go on. NVIDIA, question mark. Yeah, what's going on? Oh, it's up a little bit. Yeah, I mean, a lot of these stocks are going to be up pre-market with the general macro movement today. But let us know if you have anything you want us to check out as we've got a little bit of time before the market opens here. But yeah, just to give you a quick update on what we will be covering today. So in about 15 minutes, we're going to go over a crypto update, which we normally do on Options Trading Concepts Live. Options Trading Concepts Live would be a VOD today, so we'll just do it in the morning in about 15 minutes here. We got an options drive at 8 a.m., looking at pairs trading. And of course, we have the opening bell, and we'll have Vecchio on at 8:40 for Let Me Explain. And I'm very interested to hear what he has to say about his New York Knicks making the finals. Little market measures. Should we trade bullish strategies? One slide, yes. But no, we'll walk through the market measures there. And then we've got live from the trade desk with Quentin and Glenn. And then we'll hand it off to Liz and Jenny at 10 a.m. Jam-packed day. Did you trade NVIDIA earnings?
I did not, but we talked about it. I remember. I think we were talking about a setup on OTCL, and hindsight's 20/20. But our view was that it wasn't going to move. At least shortly thereafter earnings, and that seemingly was true.
Yeah. And it's still not moving. It's just hovering there right around 215. It's up to 218 right now, which is pretty decent. But yeah, it's kind of wild. I mean, we were talking about this too. Like Nvidia just has this aura about it where it's like it's such a huge company, 5.2 trillion. The numbers they put out for earnings are just like the most insane numbers you can ever imagine. But the market knows this. And it's like everybody expects them to post these numbers, and they're not saying anything that really is going to like change the landscape of what's going on. Like they're just meeting the demand of the world that is changing around us. And I think that contributes to the lack of movement for earnings. Cause like if I'm expecting to see a huge rally from earnings or a huge sell off, like they'd have to miss numbers, which I don't think they're going to. And to the upside, they have to announce some like crazy deal that nobody saw coming, I would imagine.
Yeah, it almost seems like, and I think we talked about this as well, but you get these bigger movements midweek on some announcement, a partnership, a new contract, whatever it might be. That's where the excitement lies versus earnings. Because to your point, it's somewhat priced for perfection. Everybody knows or has a good idea, at least, of what the business looks like and what they're going to report on. And quite often, you just see that volatility collapse and you don't get much movement in the stock, at least if you go back and you look at how it's responded to those earnings announcements over the last, say, even 2 years really, but more so over the last year, over the last 4 quarters.
Yeah, it's been crazy. I think so it was 8 earnings announcements, now 9. Almost all of them were inside the expected move, and a lot of them were to the downside.
Yeah, I think on average it was like 1.4%, 1.5% to the downside was the average move.
Yeah, which is crazy because Nvidia, like I envision Nvidia posting great numbers and just rallying. Like the good old days of Tesla, where like they would just post these most terrible numbers, like we're burning billions of dollars, and the market's like, hell yeah, let's rip this thing higher. We did get a little clarity around SpaceX, the IPO.
Yeah, when is that happening?
It should be middle of June.
Okay.
But I did see something that SpaceX and Anthropic, I believe, there's like 2 other products that are IPOing at the same time.
Okay.
It's just going to be insane. But yeah, it looks like June 12th is the date that they are shooting for. And the ticker will be SPCX, listed on the NASDAQ. And they're trying to get to 1.75 trillion, in between 1.75 and 2 trillion, which is for sure projected to be the biggest IPO in the history of the stock market.
How often post IPO do the options start trading?
So good question. I think they used to take a lot longer, but this product, Cerebras, had an IPO like literally 6 days ago. What is this, the 14th? Yeah. A week. Yeah, the options were listed like 3 days later, and they have weeklies too. So I think given the hype around SpaceX, I would imagine they have options within like 2-3 days, but you never know. I think that they will have options within the same week of the announcement.
Awesome.
And I think June 12th, yeah, it's going to be crazy. But yeah, June 12th is Friday. Is that right? Yeah, I think it's a Friday, which is interesting. So maybe the following Monday they have options or something along those lines. But yeah, they'll have to have them soon because the market will be wanting to trade that for sure.
The market demands them.
Yeah, the market gets what the market wants. Ryan, when will my Ethereum that I bought at the top make me rich? Question from the YouTube chat.
That's a great question. I guess not until it goes back to, hits a new all-time high. I mean, look, right now you're clearly in a crypto bear market still. We've seen a nice bounce off of those February lows. It's really been concentrated in Bitcoin, though, as we've talked about. You've seen flashes here and there where ETH has outperformed. The ETH BTC ratio has done better. Solana has outperformed. I think recently here you're seeing a little bit of, or at least you were, a little bit of outperformance of Solana versus both Bitcoin, but more so ETH. But looking at ETH and looking at all the other alts and where we are in the cycle, I just don't think that bear market has fully played out. Now, maybe it's different this time. It's possible. But what we've at least seen historically is you're typically in this downtrend or sideways trend, just bear market, not the environment that we wish we were in where we were just ripping higher. But you're typically in that for about a year post the top when you look at these kind of post-halving cycles. And so we topped out at, I want to say it was about 126, 120, somewhere around there at the beginning of October. And then we saw the leverage flush, we saw the bounce, and then it got slammed back down to new lows, which was about 60,500 on February 5th or 6th. And we're in that recovery process right now. It's largely been consolidation. The range has been, with Bitcoin, it's been 60 to 80. With ETH, it's been sub 2 to close to 2,500, not quite. But I think you look at everything that's happening on chain, you look at all the institutions, everyone's building. This technology is real. There are many, many use cases, of course. I think maybe you got to get past the Clarity Act. If you get that, you kind of look and see, okay, is a catalyst there? Who else now makes some announcements? What else is happening? But largely, this is going to follow Bitcoin. It's going to follow the larger recovery in the market. And so I think you still have some time. When that's going to be, maybe by the fall. We go back to that 1 year period. But I think the Clarity Act, again, could be a catalyst. We continue to track stablecoin market cap. That's growing. I think there's, again, a future in which most assets are tokenized. Doesn't necessarily mean that it's going to be on Ethereum, but you're going to see increased adoption and usage of stablecoin. You're going to see all assets tokenized. And it's not even going to be anything that we really think about. It's just how they'll be settled, how they'll trade, the technology that's used to facilitate that process. I think these markets will be a lot more open to investors and traders globally, at least US markets versus where we are today. But I say all of that because I think it's definitely not here today, of course. But I think, within the next year or so, you'll probably see more constructive prices. But let's get past the Clarity Act if we get it, which I haven't checked recently as to what the probability is there. I like to tell myself, though, that ETH's going to 10K. It makes me feel better when it's 2,000.
Well, yeah, I was actually going to bring that up because I remember we were talking about 10K, 12K levels. But I mean, just looking at the chart, the good news, the bad news is it's down at 2K. But the good news is it doesn't take long for it to double in price. Like if it's going to move, it's going to move.
Yeah, I don't think, as much as we talk about ETH or some of these other crypto assets, digital assets, you can look at some of the adoption numbers and sure, decent amount of people are clearly aware of Bitcoin, hold Bitcoin, and growing user base globally. But generally speaking, most people are not invested in this. This is a very, very small asset class. It's going to take time. I think it's going to grow, but it's still early, as in, that might sound crazy to some people because if you've been in this for a while, like, what do you mean it's early? But generally speaking, the adoption isn't there yet. And I think you will see that once you get regulatory clarity, once you get more institutions building. But I think, that's the future.
Yeah. And relating it to AI, we're still early there. But a couple of years ago, it was just like ChatGPT.
Right.
It was like, damn, this is crazy. And now AI is already integrated into every single company that operates. Unless it's a really old school, mom and pop, cash only type place, every place has some kind of AI that's integrated within that infrastructure. And to your point, the tokenization of things will change the landscape of what we know today.
Yeah, I think in the future, whether that's next year, 5 years, regardless, you're going to see a lot of agentic activity, right? It'll be AI that assists you as an investor, but I think ultimately you'll have agents that are fully autonomous, that are transacting among themselves. They'll need a settlement layer. Presumably that's a blockchain. They will trade tokenized assets. They'll have wallets to be able to sign transactions. I think that's a very real possibility. And we certainly see that happening in some areas of the industry. But again, I think it's very early to get AI and agents as investors. But I think that's the direction that it's going in.
Yeah, especially with something like Claude Code. It's been crazy. 10 years ago, if you wanted to build something, you'd have to have a developer, and you'd have to articulate what you're trying to do to the developer, and they'd have the skill set to be able to execute it. Where now, obviously I can't still code, but I can create a visualization of what I think a website or web page should look like based on what I'm trying to do. and then that code can be taken and then professionally implemented. So it's crazy.
Yeah, I mean, the speed at which you can iterate and prototype and test and learn, given the tools that are available now, and I mean, really didn't exist 6 months ago in terms of the most recent models and versions of this. So yeah, it's fascinating to see how that's going to disrupt everything and kind of the impact it's going to have. I think it'll be positive, generally speaking, even though there's a lot of doom and gloom, fear that surrounds it. But that's just my opinion. I guess we'll see what happens.
Yeah. Take a couple more YouTube chat questions. We got a few minutes here, and then we'll get into an official crypto market update. Can you give me a safe call options trade on IonQ? No, we can't, because that doesn't really exist. Options have risk. You always take risk when you're trading options. But yeah, I would say I haven't traded this thing. I mean, it depends on what you're trying to do. It's moving to the upside quite aggressively here. It's gone from 25 to 63 in 2 months. So implied volatility is through the roof. So yeah, I would say I would label this aggressive if you're trading this. Nothing safe about it. But you can create situations where like you want to take stock. Like if you want to sell a put at 50, you can take stock with a basis of 47.5, 46.5, something like that. But yeah, let us know if you have any more specifics here. How do you learn how different trades move? An iron condor moves very differently than a butterfly, and that moves differently than a broken wing butterfly, and that's a jade lizard, et cetera, et cetera. Is it experience? Yeah, it's more just like understanding how options will move based on movements in the market, right? And that's why I always will say, if you can master extrinsic value and how extrinsic value changes, or predict how extrinsic value changes, like intrinsic value is easy. Intrinsic value is just what's the difference between the stock price and my in the money strike. That's intrinsic value. But extrinsic value is a little different. So like Nike, good example here. This leap option is trading for $500 right now. The stock's at 45, but the current at the money option is trading for $1,000. If we get an increase in Nike's stock price from 45 to 60, that would be a 50% increase in the stock price. That tells me that this option that's currently trading for $5 would probably be trading for closer to $1,500 if we got a rally in Nike from 45 to 60. So just like understanding things like that and how the Black-Scholes model spits out options prices based on the inputs. Once you have an understanding of that, then you can be like, okay, I've got this long naked call right here, but if I had a spread instead, well, I know that this spread only has a max value of $500, but if it goes in the money with tons of time left and tons of extrinsic value, it's probably only going to be trading for $2.50. So like these kinds of things you learn over time. So experience, to answer the question, I think makes sense, but it's really just having a good understanding of how option prices can change based on things moving. And that is how you kind of back into understanding what a jade lizard is and an iron fly and all these things. But you'd have to understand the actual risk graphs first. If you don't understand the risk graphs, then it becomes a lot harder to estimate where you're at. But that's the nice thing about the curve analysis mode is like, regardless of your strategy, if you learn how to use this, both from an expiration standpoint and a theoretical standpoint, you just have a lot more visualization of how these things move. So use the analysis tab as much as possible. Look at the expiration graph versus theo graph, and then mess around with these inputs, and that will be super helpful.
I agree with Griffin Jones in the chat here as well. It is understanding the critical Greeks, which you probably don't start there day one, but soon enough, that's probably where you anchor. And I don't think a day goes by, Mike, where I'm not on the curve view or using the analysis mode just to, when you have a lot of different short premium positions on, just to understand, where is your risk? And then what do you have to do ultimately to hedge that or reduce it or manage it should you get not just the delta move, but the vega move that ultimately is going to sting you a little bit when you're short volatility.
Yeah. And like this is another good example, this MES position. This is where we're at now. Like I have this straddle here. but I've collected so much premium that my risk graph here is highlighted, and I can show if I just change the zone to expiration, like this is where I would be at expiration, but we're not at expiration. So I have plenty of extrinsic value here that is left to decay, but as I push this closer to the expiration of my current strikes, you can see the risk graph kind of fills in and gets closer to that expiration risk graph. And then same story, if we were to just chop around here and maybe get a little volatility collapse, 3, 4, 5%, you can see how big of a contribution that plays to the extrinsic value collapse of these options. So yeah, to Ryan's point, like I use this every single day, and I think you should too if you're trying to learn how these things move and really estimate how these things move. Like I can visualize what this looks like now because I've used it so much. So I think that's where you want to get to. And then the strategy doesn't matter. The strategy is just like, there's a long call here, a short put here. Like you know how these things work in isolation, so you learn how they work together also. It is 7:30 on the dot, almost. Why don't we do a little crypto update here?
Yeah, I unfortunately don't have any slides.
That's fine.
But can run through, what we also look at on OTCL and sometimes Trade Desk Live here on tastylive, or live from the Trade Desk, excuse me, is, the momentum signals that we see in there. So I can give you a quick update as I just run through my charts on a different screen here. But, what we were looking at previously was you got that bounce. Bitcoin went up to, let's call it about 83, 84, and it's flirted with that level a couple of times now, and it's obviously sold off from there. Like I said, you're still in this bearish environment, and you're now seeing that again with that short-term momentum. You're seeing Bitcoin back to bearish, ETH is bearish, Solana is bearish. All of this is continuing to chop around. You've seen volatility come in a little bit, but the price momentum indicators that we track there, just a quick update, because we haven't done this really over the last few days, you're back to bearish momentum in all of these. So where does that mean you could go? Well, starting with probably the low end of that 1 standard deviation move. I don't have updated numbers there, but just from looking at what I have set up on my screen here with a similar approach in terms of the volatility analysis, you're looking at about, we'll call it 74,000 on the downside for Bitcoin right now, and the upside of about 80,000 in terms of the move. For ETH, looking at about 2250 on the upside, and we'll call it 1990 on the downside there. And then for Solana, looking for a trading range of 90.67 down to 79.68. And Solana really hasn't done much at all recently. Get a little bit of a pop. Everything is positively correlated with crypto, but it's also selling off. Where there is a bright spot has been in Hype, not available yet through the Tasty Trade platform, but Hyperliquid, I'm sure many people are familiar with that. One of the few markets that truly trades 24/7 and now has perpetual futures in a lot of what people call, in the crypto space at least, TradFi assets. But for us, that's just the regular stuff that you trade. But it's become a reference point, certainly during this period of war in Iran, where over the weekend, you can get some indication of what the price of oil is doing or where it might open up based on certain headlines, because those perpetual futures are trading. And they're seeing, significant increases in volume in those commodity products on that exchange. Unfortunately, for most U.S. investors, tough to access it. But it'll be interesting to see what happens post regulations, where you get, some of these competitors to your traditional venues, and how that might influence, the behavior and the product launches of those traditional venues. I've got to imagine at some point, it looks a lot more. I know it's getting there already, but it looks a lot more like a 24/7 market, not even just a 24/5, but a truly 24/7 market.
I like it. And yeah, I think that's speaking of the tokenization of things, like that's where we're going, like 24/7 full access. I think makes a lot of sense. Like that is the future that everyone desires, I would say. Yeah.
So Hyperliquid has been, an outlier here when you look at, again, this kind of bear market that we've been in. Where have there been some outperformers? We've written about this quite a bit on the Tasty Crypto Substack, so you can check that out over on Substack. You can sign up for the newsletter. It goes out every Saturday morning if you're interested. Another one that we've talked about that I think is also doing well, let me just double check here, is Zcash. So this is a privacy token. Trading above 600 now. So that's done well, up about 9% in the last week, up about 70% in the last month. So obviously extremely volatile. But when you look underneath the surface here, obviously we track just Bitcoin, ETH, Solana to start with, but there are some bright spots in terms of performance of some of these outliers on a relative basis.
I like it. You mentioned, certain levels and certain momentum on these different products. Do you have a certain setup that you utilize on the Tasty Trade platform with indicators?
Yeah, absolutely. And this is something that we've also written about with the specifics as to what we look at. It's very, very simple. Just use 3 different exponential moving averages. Pick this up from Slim way back in the day. If anybody is a kind of OG Tasty trader, Tasty liver now, I guess. But way back early on, Steve Miller, Slim, he had all of these different approaches and all of his technical analysis that he uses. And I think you can learn, from him on his site. But I just thought that his slim ribbons and the exponential moving average crossovers that give you this signal as to whether price momentum is bullish, neutral, or bearish was a great way to just stay on the right side of the trend. And so you can get whipped around, of course, but on longer time frames, it's pretty useful, in my opinion, right? I'm not going to put this on a 1-minute chart. You're just going to see the momentum shift from bullish to bearish pretty much nonstop. But when you look at this from a monthly perspective or a weekly perspective, which I think is one of the stronger time periods that you want to use as a signal, and as well as the daily, we'll look at that short term, as I just mentioned here. In that bearish trend, we've seen the short-term momentum flip back to bearish. So that's not a good sign if you're bullish, of course. But that's what I look at. And so it's just very simple exponential moving average crossovers. It's an 8 period, a 13 and 21. And when price is above all of them and you have your fastest time frame leading the way, you're bullish, and vice versa. When they cross over, you get the signal that you're going from bullish trend to a more neutral trend or bearish trend. And again, with something like crypto, where I get the argument, I see the chat, right? There's two views here, and they're wildly different. One is that this is the future, and it's crypto over everything, blah 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 blah. I don't agree with that. And then there's the whole, it's a tulip bubble, it's a zero, it has no value, and I don't agree with that either. But with a lot of this, it trades very technically. And yes, there are many, many tokens that are probably ultimately going to go away or are worthless. And when you get through these different hype cycles, some of the stuff from the last cycle, I wish it was going to come back, but it just doesn't. And so I think you're going to continue to see that play out. But point being, the way that I like to trade that is just to stay on the right side of the move, right side of the momentum. And so we use these indicators for that. And when it flips, got to pay attention. But you can apply that to any other asset class as well. We do that on OTCL. We look at this from a macro perspective, and it holds up. And I think when you get that full picture of, okay, what's the momentum around all these different asset classes? How are they correlated? What signals are we seeing? It gives you some sense of the environment that you're in. One example would be if you're seeing all of these defensive sectors in the equity market are now exhibiting very strong bullish, very strong positive momentum, and you're starting to see some other signals related to that elsewhere, then you might have, some sense, some signal, I guess, that you're, kind of transitioning into an environment where it's a little bit less bullish for equities. So I look at it that way, long-winded, but those are the indicators that we use, just exponential moving average crossovers.
I like it. And yeah, I just set this up real quick on the Taste Trade platform. So I just use the 3 different EMAs and just change the colors and the length of each of these. So the first one, the lightest shade, is the 8-day. The next one's 13, yellow. And then the next one is purple, 21. So just like from light to dark, just so you can simply see, like when you get the crossover, when the light crosses over each of these, that's when you had this bullish momentum, and now you're like, to your point, you get this slight bearish crossover here with the light getting underneath purple.
Yeah. And these are, again, like anything, it's backward looking. It's an exponential moving average. So it puts a little bit more weight on more recent prices. But it doesn't mean that it can't change or that it's going to continue to trade in that direction. That momentum is going to persist forever, right? It's just one way to kind of see where is the momentum. And people use moving averages for what it's worth in a variety of different ways. But this is how I stay on the right side of the trend. You're not going to get it perfectly every single time. But as you can see, just simply by what you're looking at, and again, if you use this on longer time frames, weekly bars, monthly bars, there's some significance to that, and it can help you stay on the right side of that. You can also look at it sequentially, right? So we're going to follow the weekly, we're going to follow the monthly, and then we're going to get that signal from the daily. And then we'll keep an eye on whether the others change or not.
Yeah, I love it. And then I also like to use Bollinger Bands.
Yeah.
So like Bollinger Bands is a real simple one where it just creates a visualization of the range, and you can kind of see what you can see when you get closer to the bottom end and closer to the upper end. So like we can change this. Ooh, a little dotted line. Let's see that.
Nice.
Oh yeah. So yeah, the dotted line for the upper and lower, just so we can see it more easily. Let's just change this to the same color here. Actually, we gotta make this. So many colors to choose from. Yeah, we'll just do this. So yeah, it's nice that you can do like dotted lines. So now you can clearly see where we're at from the implied range with the Bollinger Band. So having something like this where you have both at the same time kind of gives you a better idea of dips to buy if you're trying to buy them, or not buying something that's at the top end with certain things moving. But yeah, I like to use both of these as just like a simple gauge of where we're at in the market. And I always like to say there's people out there that use a lot of indicators, but as long as you're pairing it with a strategy that works for you or high probability options trades, like that's where you kind of blend everything together.
Absolutely. Yeah. I think you need, as we like to say, a lot of tools in the toolkit, and this is just one way to kind of augment the process.
Yeah, for sure. What else we got in this YouTube chat here? We got about 15 minutes before we pop over to the first content piece of the day, mastering the pairs trade. And I'm excited for that. I haven't done too many straight up pairs trades, but I do like to create synergy around positions that I'm trading for sure. And even in the same products, like I still have the micro natty gas position. So I bought this contract straight up, and then I sold a call spread against it. That's going to expire today, real close to where we're at. But yeah, this is like something you can do too. Like you buy the static contract to get that static delta. You go to the larger contract, sell a spread against it, pick up $100, and just gives you some flexibility with a little bit of cost basis reduction to the downside. But yeah, excited for the pairs trading segment in just a little bit. Bands and what else? Exponential moving averages is what we had on the chart here. So from the tasty indicators, EMA, and then Bollinger Bands, there's a bunch of different ones. The EMA I just manually created, but there's other ones that are already set up, and you can just change the style. That's really what you need to do is go in, change the parameters if you need to. This one is an 8, a 13, and a 21. And then I just changed the colors for each of them. And then the Bollinger Bands, I did nothing other than just changing the lines to dotted so you can see both at the same time here.
Laughing. If you have Tom saw this, he'd be lying dead on the floor.
Yeah.
Tom doesn't use any of this to my knowledge, of course.
No, he certainly does not. Certainly does not.
But I mean, the other, like when you think about the Bollinger Band approach, right? I suppose the equivalent in terms of just using the probability is using implied volatility. is calculating that, to start with, one standard deviation move on a 1 week basis using the current implied volatility. You can switch that input up a little bit. You can model a different vol. If we know that vol has been declining, but it's not just going to go down in a straight line, maybe we use a slightly higher vol input. We look at what's the difference between implied and realized volatility. But you can model it that way, but then you still get a sense of what is a realistic or probabilistic range that this is going to trade in. And it doesn't mean that it's static, of course. It can obviously change. It's going to change with both price and volatility. You're going to get a new range, but it gives you some framework or realistic expectations for where that price could go, at least over the short term.
Yeah.
Majority of the time, right?
Yeah.
It's not perfect.
And honestly, I started using this much more with tastylive products, because my whole strategy with these products, they're so bite-sized. You can get really granular with position sizing, that I've been using this Bollinger Bands on this platform even more than I've been using it on the traditional Tasty charts. So like here, because like these positions, I'll buy them or short them when they're at Bollinger brand price extremes, and then just hold it until I'm right. Like this one I've had for a long time. But there's other positions that I've gotten in at certain extremes and held it, and you see a little bounce. So like this would have been a good example here, where you're at the bottom of this Bollinger Band range, and then you get a bounce a couple days later. Or you're at the top, and then you sell off here. So like this is just the channel that this has been trading in. And if you're waiting for these opportunities to buy or short this product, depending on what you're trying to do, you can get super granular with the position size, which is really what makes this work for me at least. But would love to see the dollar catch a little bit here, so I can get out of this position that I've been in since November 5th.
Short some pounds.
I'm just actually
I can't see. You don't have my glasses.
Oh, okay.
This morning.
So it's the dollar franc position. So I'm long the dollar, short the franc. But it's been hilarious because I've had 2 opportunities to close it for a profit, but it was at like 3 a.m. or something. But I would wake up and Glenn would be like, "Did you close it? Did you close it?" And then it would be gone. But it's hilarious because my basis on this position here is comically close to where we've gone before. So you can see before I layered into another lot, my basis was like right here where this line hit, and it got up there and then just sold off immediately. And then same story back here. Like I had one tick that it could have gotten into profitability and then just sold off immediately. So
never had a chance.
No, never had a chance. Unless I had a GTC order, in which I did not.
Yeah.
But the good thing about this is you see a positive ask here. So I'm getting paid to hold this position every single day. And we've done a rough calculation. So I think I've made around $300 just holding this position in yield, because we have a positive swap ask, and I am long this position with 20 micro lots. So getting paid to hold it, and that actually adds up over time. I mean, this if I incorporate that collection into my profit and loss, this is actually more like a scratch. And my net lick and funds just still go up because of that yield every single day. So
I love the chat, Mike. I think we've incited some activity, some action with the discussion of some of these indicators and using charts. E-media just wants the news. I'm sorry Vanetta's not here. We can read through the news. Did you see, we talking about this for a second. Did anybody see the new Ferrari?
I did not. You did bring this up. I saw someone bring it up in the chat too.
I guess it's electric Ferrari. I think it's electric.
If we have the ability to pull it up,
just makes me sad.
Yeah, they're gonna get
Ferrari.
it for us.
Yeah.
Yeah, I feel like
we'll see if we can get it. We'll just let you be the judge. It's the neon blue one, aqua blue at the top there.
Yeah, I feel like all these car companies are just going for like this straight up Tron look, you know?
Yeah, I don't know. Personally, I'm not a fan, but who cares what I think?
If you're
I can't
buying a Ferrari,
afford one, right? I'm not going to buy one of these.
There you go. But yeah.
Maybe.
Yeah. If you're buying a Ferrari, This is not the Ferrari you buy.
I just think you want the 12 cylinders.
Yeah.
You want the roar.
Yeah.
Yeah, you're buying a race car.
Yeah.
That's the point.
Yeah, I would not. This is literally like the use case for this is so specific. It's literally like the uber rich that are trying to be conscious of the environment, but also want the most expensive electric vehicle on the market. Yeah.
Stock is down. Oh, it looks like about 10, $11 pre-market here. I'm guessing on the news.
Probably.
I don't know.
Wow. Ticker symbol RACE. Nice.
Right? Hell yeah.
Oh yeah. Perfect. Yeah, I mean, this is not ideal. I would never buy that car.
What other news is going on here?
Well,
We have anything on the economic calendar this week that's of note?
great
Any
question.
notable economic events?
Jobless claims Thursday. We have some fringe Federal Reserve people speaking. Governor Lisa Cook, Vice Chair Philip Jefferson. Nothing today. Home price index tomorrow. Actually, no. Home price index at 8 a.m. Central today. Consumer confidence at 9 a.m. GDP, PCE on Friday.
Yeah, Thursday, Friday.
Yeah, there you go.
It's possibly some data that's worth looking at.
Yeah. And then, next week, June 5th, we get the unemployment report. And then next Thursday, PDT elimination. Going to be wild. But yeah, nothing too crazy. But yeah, I mean, I always just look at SPX whenever we're estimating the implied move from these things, just because SPX will have it priced in if there's something that we need to focus on. But yeah, I think it is interesting that we have 56 points today and only 98 points for the rest of the week. But then again, it is a Tuesday after a long weekend. Yeah. So people are chomping at the bit, including our friends in the YouTube chat, to start trading today. What else we got? If the Iran situation is over by September, will crude oil be at $60 or below by December? I would say absolutely not. What do you say?
Yeah, I think crude is going to hold on to some higher levels. I don't think it's going to retrace all the way back to where we were before the conflict started. We can look at the futures curve, at least just to get an indication of where it is today, right? We'll keep an eye on prices, and that can change. But we're looking at crude back out into December. It's about $78 at the moment. So absolutely could go lower. But, I almost think that here's kind of a crazy trade idea. It's like Strait of Hormuz opens up. That's the bullish catalyst, because now we're no longer focused on this jawboning and these headlines that just seemingly push it down when it's convenient. We can actually focus on the deficit, on the supply draws here, and certainly what's coming out of the United States. We'll get that EIA inventory report this week, as we do every week. You're seeing historical drawdowns. The strait opens up. Let's say it happens this second. What changes? It's going to take a long time to get all the ships out of there, for them to unload their cargoes, to come back, reload. You have to restart a lot of the production process, the supply or production that's been shut in. That's not something that happens overnight. If we look out 6 months, 9 months, sure. No idea what the price of oil is going to be at that point. But just in terms of the kind of structural setup that we have right here, I think the end of the war and the reopening of the Strait of Hormuz, if it remains open to begin with, certainly we'll see a bearish reaction in the price, which is what we've seen every single time. And the price is traded down, at least with the front month or prompt contract, has come down to 80, mid 80s, low 90s at the time. It seems like we're finding a higher low each time. But I would expect that reaction in the market. That said, I think structurally there's a lot to be bullish about in terms of the oil price. You haven't seen demand destruction. When you look at crack spreads or refiners' margins, they are $50, very, very wide. So you're not seeing demand destruction there. And I don't think that you're going to at these prices. There's no indication of that here in the United States in terms of the price of gasoline. Obviously, it's higher, but not at levels where people are really starting to no longer drive their vehicles. So I think that you will see, these prices persist, and you could see much higher prices. But the straight opening up might actually be the catalyst where now we focus on the real kind of supply issue at hand instead of just kind of ignoring it.
Yeah. And I think when you look at the futures curve here, like we've got pulled up, at the height of the war, you had a 15-point backwardation or around there between the active contract and the next contract. Right now, you only have a 3-point backwardation, 92.60, 89.60, going from the 21 to 51 day. But we've seen this backwardation. Like, I don't remember the last time crude oil was in contango. Like, this has been in backwardation for longer than the war. So, but yeah, to your point, like, to quickly answer the question, the back months here, May 17th, 2027, the curve is priced at 74. So there would have to be a seismic shift in the environment we're in now for us to get back down to the 60s, especially the low 60s. And I don't think that's happening anytime soon. And the market's telling us that we shouldn't expect that to happen anytime soon with backwardation in almost all of these contracts.
Yeah, I think it's going to take some time.
Yeah.
A year, who knows?
Yeah.
But immediately here, I don't see anything changing just because, there's possibly an end to this war. I don't think that really changed anything structurally in the very short term. But I do think that you'll see volatility come in, which has been a phenomenal trade. There's a ton of risk, of course, in that. But selling premium or selling volatility, being short volatility in oil, we could argue about whether there's a premium in there or not. But being short vol over the last couple of months has worked out. You need to manage your deltas when it moves 5 to 10% a day. And you need to certainly hedge out your Vega risk, which you can easily do by basically just owning call spreads at some strikes that are farther out. But that's been a good trade. And I think that's one that I'll continue to focus on regardless of what the price does.
And call spread specifically because the way this works is like...
Yeah, you can hedge it on both sides, but
Yeah.
I think like here, given the situation, the risk is to the upside.
Yeah.
You could get a flush lower, but is crude oil going to go to 50 or 150 from here? I think there's a higher, whether it goes to either price, I think there's a higher probability of 150 versus a $50 move.
For sure. And we've seen this vol act like crypto products, vol products, where when you get the big rip higher, that's when you get the vol expansion versus the other way around.
Yep.
And that's what we were seeing in silver and gold too during their heydays. But silver and gold specifically back down in the 50s in terms of implied volatility, 35 Ivory rank. So 50s kind of on the lower end from what we've seen. And we'll see where we go from there. But yeah, crude, great trade. And yeah, I've been trading MCL a lot, just buying static deltas there. And then with crude also, I've been using like spreads and iron condors, things like that, just taking advantage of that heightened implied volatility in a defined risk way and getting a nice channel. Like 86 to 120 was the last one I did. And that was a pretty almost a full win there.
Excellent.
So, yeah. I think we've reached the bottom of the YouTube chat for now, but we've still got a couple of hours of content with all of y'all. So stay tuned. Join us on the YouTube channel if you haven't already. Pop in your trade ideas and questions along the right side chat there. We're going to take a little 90-second break, and we will be back with the first content piece of the day, an options jive talking about pairs trading step-by-step guide. So stay tuned. We'll be back in 90 seconds.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
tastytrade's active trader interface makes futures markets your arena. Built for the bold, not the bored. Trade CME futures with a single click. From micro contracts to major ideas. And go even further with futures options. tastytrade lays out multiple ladders and charts for total visibility. Plus, hundreds of built-in indicators for traders who want a broader view. tastytrade, pro-level tools, intuitive design, total control.
I've got some huge news for traders everywhere. On June 4th, the pattern day trader rule will be replaced by new intraday margin rules. tastytrade has been advocating for an updated PDT rule for years, and we're ready to go on day one. You'll have more flexibility to manage risk when and how you want. Join tastytrade today.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, cover calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
Global markets never sleep. Explore them with Forex on tastytrade. Get in on 80 plus Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on tastytrade.
Think you know where ball's gonna go? Test your theories with backtesting. Pick from hundreds of symbols, any strategy you want, and all the data to trade smarter. Tweak the delta, dial the DTE, stack the legs, see what survives. Trade what you want, when you want with tastytrade.
First thing about tastytrade is how easy it is.
It's a very quick, light platform.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform, so I love that.
When you trade options at tastytrade, you see your probability of profit and loss right where you need it. Earn up to $3,000 in commission rebates.
It's option jive.
What's up, Tasty Nation? Welcome back to the show. My name is Mike. I'm here with Ryan Grace, and we've got an options jive for you today. Mastering the pairs trade, a step-by-step guide. Before we get into it, Ryan, do you do pairs trades all too often?
No, I really don't. Maybe I'll start.
Maybe. Yeah, I think it's. It's definitely a way to get involved in markets when there are price extremes and relationship extremes. I think one of the most important things to keep an eye on is just understanding that it has to be done in products that are super highly correlated. But there is a pairs trading feature on the tastytrade platform, which is really handy if you do go down this route. But before you do, make sure you follow this step-by-step guide, which we'll dive into right now.
Absolutely key that they do have to be correlated.
Oh, it's an absolute requirement because you can't pairs trade these two products if they are just moving in isolation because there's nothing that you can anchor your idea on. And again, they have to be highly correlated.
Yeah, I mean, it's a relative value trade among two correlated assets.
Yeah, like silver, gold, those types of things. But we'll dive in. All right, let's do it. Options dive, mastering the pairs trade step-by-step guide. Pairs trading consists of playing the spread between two correlated markets between SPY and IWM. In this example that we're going to look at on the first slide here, reestablishing the fact that we need to see a super strong correlation because the only way this works is if you see a divergence in two prices that are supposed to be highly correlated and then they converge back to a normal relationship. And if you're not seeing that, if you don't have this super high positive correlation, and I would define super high positive correlation as somewhere in this range between 0.75 and closer to 1, like SPY and the NASDAQ have a really strong correlation. SPY IWM, of course, similar as well. But when you get into other products like gold and silver, like there's also ways you can play those. Yes, there are going to be situations where they're moving in different directions, but you have a general idea of the historical relationship of these products. And when you get these extremes from a divergence standpoint, you can play both sides and play for that convergence. And there's a lot of potential benefits that can play a role when you are doing something like this, because you're not taking one-sided risk. You're trading the relationship.
And it might be somewhat difficult to see this on the chart, but right now the 90-day, 3-month correlation between the S&P 500 and the Russell is 0.96. It's going to be above 0.9 the majority of the time. Obviously, they're both equities, U.S. equity indexes. So
yeah, super strong. And again, that is a requirement for pairs trading for sure. So we can pop over to the next slide. We can talk about setting up pairs trades and what we're trying to do. So again, taking advantage of correlated names that have diverged in price, whether it be SPY and IWM, whether it be GLD or SLV, there are opportunities out there. You just have to be able to see them. And also, again, understand that it's got to be between two products that have a long history of having a strong correlation or inverse correlation for that matter. But yeah, that is how this thing can work if you are partaking. Increased occurrences during periods of low IV. So sometimes you have situations where markets aren't moving all too much, but you see something like this happen where you see a divergence in a relationship, whether it's to the upside or downside, it doesn't really matter. You're kind of just playing that relationship range. And I like to think of it kind of like the Bollinger Bands we just had on the show, where it's like you have these products that are normally moving together, and then you have this divergence. Maybe you short the one that has moved to the upside, maybe you get long the one that has sold off, and you're playing for that convergence over time. And that's really what pairs trading is.
Yeah, and I think with anything, right, when you have low volatility, that market environment allows you to take more risk, to size up your positions. But when you do see that volatility spike, when all of a sudden the instruments that you're trading, the assets that you're trading become very, very volatile, you typically want to reduce some of your size. That would be the approach I would take at least. And we see that as well when you have a low IV rank. Okay, you can do a few more contracts here, but just be conscious of the fact that that's not going to stay low forever. And when it does change, you have to readjust and, again, think position sizing, because that's ultimately your risk management approach.
100%. And last but not least, reducing risk by trading a spread. I think it's pretty self-explanatory, but again, you're not taking one-sided risk. You are taking the relationship risk, and if they're moving together, you have this idea of less notional risk at the end of the day. Speaking of notional risk, steps for setting up a pairs trade. First, surprise, surprise, find correlated underlyings that have a recent divergence in price. Find the notional value of each. So I talk about this all the time, notional value. I'm usually talking about earnings trades, like what's the implied move for a stock against its notional. So I like to look at that. 10%, 15%, super high, 5% or less is really low. But when you're dealing with pairs trades, especially two different products like gold and silver, GLD and SLV, these are different priced products. So you can't just do like 100 shares of one and 100 shares of another. You have to realize that these product sizes are completely different. And to equate one to another, you've got to match up the notional value, which we'll walk through in just a little bit. But you also need to adjust the notional value for implied volatility, because to Ryan's point, you have these products that could be low IV and some could be high IV, and you need to notionally adjust the implied volatility for each to, again, you're trying to get as close as possible to a 1-for-1 equation where you're long one, short another, and you're matching or adjusting for the greater or lower implied volatility on one side and greater or lower notional value on the other, so that you can get as close to an apples to apples conversion at the end of the day. Next slide, please. My favorite color, green.
Beautiful slide.
Yeah, beautiful slide. We'd love to see it. But yeah, these are a couple of examples. So again, we've talked about SPY and IWM on the lower left here. The Qs are also going to have a super high correlation to all three of these. But you can also get really high correlation in products that are in the same sector. So JP Morgan, Citigroup, Bank of America on the upper left here, they're all in the 80s. 65, I would say is kind of on the lower end for a pairs trade, but 75, 80, 90, golden, especially if it's a long-term correlation. 3 months is plenty.
And that's key as well, right? You don't want to look at this as a 5-day correlation or a 15-day correlation. You want to look at this on a 90-day basis. Have some sense of what is it on an annual basis as well.
Indeed. And then in the upper right quadrant here, UAL, American Airlines, Delta Airlines. So the airline sector, again, you have 3 different products that are different airlines, but they all are at the mercy of crude oil prices and at the mercy of the FAA, like all these things. So if you see one product drop and another rally, maybe you are playing the divergence of that relationship. And instead of taking direct risk by just trading one, you're taking a little bit of a softer risk, we'll call it, because you're long one, short another, and you're expecting them to move in the same direction. Next slide, please. So with these different products, all of those products we just talked through have completely different stock prices and different implied volatilities. So we need to find the notional value of each of them to start this pairs trading journey. For stocks and ETFs, calculating the notional value is easy as multiplying the stock price by 100. So the Russell at 279, that's a $27,900 notional value. And the S&P 500 SPY is $740. We're calling it 74K notional. So again, these are 2 different products that are very different, have very different prices and implied volatilities. So you can't just buy 100 shares or sell 100 shares of each and then expect to have this equated pairs trade on your hands. You've got to adjust. So what does that look like? On the next slide, please. Adjusting for notional value and implied volatility. After adjusting for IV by multiplying by the IV, we have a new notional value that we will use to equate the risk on both sides of the pairs trade. So we are not overweight on one side. And again, you're really just trying to match these up as evenly as possible to really play into the pairs trade itself, right? Because like you could be trading a binary event or something like that, but if you've got an option that's 360 days out, it's very different than trading that really isolated binary event in the 1 day or the weekly. So same story here. We need to adjust for all these things to really match up each side that we're trying to get long or short so that we're not at the mercy of one stock price moving in the same fashion as the other, but we have way more exposure in one than we do in the other.
And so in this case then, Mike, I'm probably jumping ahead.
It's all right.
We'll wait till the next slide.
All right.
Apologies.
But yeah, taking those stock prices, notional value, multiplying by IV, you've got your new notional figures here. So finding the contract ratio to match the notionals, now that you've got that correlated pair and the IV adjusted notional values for both, we can finally arrive at a ratio for the trade and implement the trade in shares or options on the 2 stocks. So IWM at 6K, SPY at, let's call it 12K. You've basically got a 2-for-1 type of situation here where you need to adjust and ultimately have more exposure in the Russell than you do in SPY, right? So we pop over to the next slide here. We can see that 52% SPY shares for deltas for every 100 IWM. So I think you can do this calculation and you can really get granular with this type of stuff, but you could also eyeball it, I would say. And even if you're not using straight up static deltas like we're talking about here, you can notionally match spreads too. Like you can do those kind of things where you're selling a 20 delta spread and taking $5 of risk on each of them. And this kind of how you can get into that sort of notionally matched pairs trade while still adjusting for IV itself. Because if you're using delta, to your point earlier, understanding those core Greeks, the delta will be adjusted for IV already.
Yep.
Next slide, please. So if you've got a 1-to-2 ratio for SPY to IWM, you'll be neutral with the current values relative to implied volatility and relative to notional risk. So if you wanted to be short, you would go short less shares of SPY to IWM. And if you wanted to be long, you would get more long shares of SPY to IWM. As you become more experienced with trading, you can do this calculation quicker in your head to approximate how you should place your pairs trade for your current assumptions. But again, if you're using deltas, like static deltas for share exposure, it's going to be a little bit more of a math situation because you want to make sure that you're notionally adjusted for IV and the notional value of the stock price. But if you're using options, it's a more complex situation, but it's kind of funny. Like you kind of do this yourself. Like you can take, again, you can sell a 5-point wide spread on either side and use a 20 delta option or a 20% probability of in the money. And that will already equate or notionally adjust based on your spread size, but also based on implied volatility in that same regard. Couple of takeaways for you. Pairs trading aims to capitalize on price divergences between correlated assets while reducing directional risk through spread trading. And by adjusting for notional value and implied volatility, traders can size positions appropriately and increase trade frequency in different environments. And if we can pop over real quick to the Tastytrade platform, I can show everyone the pairs trading feature here. So I have this super wide. You might not be able to see this, but you will be able to see the trade modes either in a drop-down menu or across like you see here. If you click on pairs trade, there's a couple of cool things here. So gold and silver is going to load probably by default, but if you click on this little booklet here on the left, you can see I've got some pairs here. We've got presets for different stocks. We've got presets for different futures. Some of these are already notionally equated and just by like a rough gauge. So 2 ZN to 1 ZB, 2 silver to 1 gold. And you can see this here, like if I've got this loaded up, you can change the exposure to it, but you can also view this on a chart, which I think is super important here. So just by looking at this gold silver ratio, you can look at a 1 day, a 1 month, a 1 year, and ultimately give yourself an idea of how these things are currently priced relative to each other. So this is actually kind of funny. SPY relative to the Qs, bottom of the barrel, all things considered, with the Qs just ripping higher. So if you wanted to get long SPY, short the Qs, you can see we're actually at a price extreme now, given the recent rally we've seen in the NASDAQ relative to SPY, all things equal with the AI boom and everything like that. So just a couple of quick ones there, but you can mess around with this. You can swap them here. And yeah, it'll ultimately route the pairs trade for you, and you can set certain prices and triggers and what have you.
But again, remember, they must be positively correlated. Gold,
Indeed.
silver, Bitcoin, ETH, IWM, SPY, NASDAQ, S&P 500.
Yeah, this is one of those things where it's like you can't really get too cute with it. It's got to be just products that have a really strong history of being positively correlated, because otherwise you just have two isolated trades, really, at the end of the day. Beautiful. Well, that is that. Hopefully you enjoyed the options jive. Got a little insight into pairs trading, and especially on the Tasty platform, how you can execute it using that pairs trading feature there. But we're going to take a quick break. We'll be back for the opening bell. Wow, already 8:20. Time flies when you're having fun.
It does.
And then we're going to have Chris Vecchio on for Let Me Explain at 8:40. And really, he's just going to explain how the New York Knicks are going to win the championship. And we'll see what he thinks about that. But join us again in just a minute. We'll be back in about 90 seconds. You're listening to Tasty Live.
In the money. It seems pretty easy to understand. If I'm in the money, I must be profitable, right? Not quite. In the money is in reference to the option's strike price relative to the current price of the stock. An in the money option is an option which has intrinsic value. For a call option, that represents an option with a strike lower than the current stock price. For a put option, that represents an option with a strike higher than the current stock price. Being in the money is a good thing for long options. It's not so good for short options.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home. Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're number one for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80 plus Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
Tasty Trade has crypto, and you can trade with zero commissions, Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
What's up, everyone? Welcome back to the show. This is the opening bell. We've got 6 minutes and 30 seconds until this market goes into blast-off mode. E-minis up 50, NASDAQ up 360, the Dow up 180, the Russell up 32. The NASDAQ and the Russell up over 1% right now. E-minis and the Dow are close, but not quite. Bitcoin up 1.29%, ETH up 2.5%, crude, the big mover to the downside, but still catching a bit here. Down 3 points, almost 4 points. Gold and silver up a little bit here, but this has been the story of the last couple of months here. Markets ripped higher, crude's been sold off, but it's been catching a bid. Like this hasn't been a situation where it just sells off and goes back down to 60. Like we've been seeing these big tails, these big wicks here to the downside get bid up like almost every single time.
Yeah, I think this is going to continue to obviously just trade off of headlines out of Iran. Most recent one I'm seeing here, Mike, Iran decries U.S. ceasefire violation after overnight port raid, insists on $12 billion fund release to advance talks. $12 billion released now, another $12 billion after MOU, 30 days runs out to open Hormuz. It doesn't quite seem like things are as positive as maybe the media or some of the headlines might have made it seem over the weekend. So maybe no surprise there. Crude traded all the way down to, looks like about $89.50 and back up to almost $93. I think you're going to continue to see the chop for sure.
Yeah.
A little poll in the chat, though. Will NASDAQ futures trade over 30,000 this week?
78% say yes.
Overwhelming majority. Yeah, we're 75 points away or so right now.
Oh, absolutely. There's not a doubt in my mind that we get over 30,000 this week. Probably today.
Guaranteed.
Yeah. It's not if, it's when. But yeah, 106 people voted. Strong majority there. Yeah, I think you could also see the other way, right? You could see a low volume week turn into kind of a bloodbath too. We've seen that before.
Yeah, you see volatility come off of these levels. Absolutely.
Yeah.
16 VIX.
Yeah. 16 VIX. Oh, man.
Surprised?
Yeah, actually. But it is interesting. The VIX is at 16 and change, but vol futures are still kind of elevated. I mean, the M contract is at 18.9, but the rest of these sitting at 20. I think we still have to remember, like, vol is going to stay elevated because we're moving 1% a day. 1% a day is basically a 19 volatility metric there. So, yeah, we'll see what happens. I mean, we'd have to really come in terms of the realized moves that we're seeing. Like, we'd have to have a couple of days or maybe a couple of weeks of E-minis up 20, E-minis down 20, and then you see vol collapse a little bit. But yeah, to your point though, crude oil catching a bid already from the lows, and we've seen this many, many times if you look at the wicks here. So maybe we play a little.
Doing anything in
upside
crude? I mean, that's definitely in play.
I feel like I need to, right?
Right. Energy stocks have been in play here, though it's been kind of a one-way train for many energy companies. If we look at XLE, XOP, you've seen a little bit of a pullback, but strong trends in these and just about, I suppose, everything that we track.
Yeah. I think what I'm going to do here is I'm going to sell a put, a 3-day put. I love these like near-term contracts when they have these multiple expirations, because I can sell this put 3 days out at 92 for $2. And if I get tested on this thing, or even if I just let it go and see if we get to Friday, I can roll this to the 10-day cycle and move it way down for a credit. So I think that's the plan here. You could go from a 3-day 92 strike to a 21-day 85 strike, or even lower for a scratch, small credit. So you have a lot of flexibility there. All three of these expirations settle to the end contract. So I think that's what I'm going to do. 225 for 3 days, just chop around here and just manipulate the strike if we sell off from here, but I'm not sure that we'll get too much lower.
It gives you some flexibility too, where you can roll out to the next expiration. You're still, like you said, using the same underlying contract or against the same underlying contract. And you're probably going to be able to do that given where volatility is and just the difference in the time periods to expiration. Probably do that for a credit at a lower strike if you get tested. You're not going to be able to for a huge credit. Certainly not the same as if you were to roll to the same strike, but you'll be able to manage that and adjust it. And then again, you have to wonder, okay, given the price action that we've seen on a lot of these, I wouldn't call them false headlines, but these, kind of positive reopening potential headlines, where have we traded down into? Well, it certainly hasn't been mid-70s and back up.
Yeah. So yeah, we'll try and sell some premium there. But either way, 3 days out, $2 and change. I was just filled at 225. But again, the nice thing about this is it still has really high implied volatility, even with a middling IV rank. But you have that flexibility to roll from the 3-day to the 21-day. Still settles to the end contract. And if I really wanted to, I can move it down and still collect more premium by moving my strike down and reducing delta and intrinsic value risk. So
just as an indication for everybody, so we go back to how we use some of these indicators and whatnot, right? So I look at a bearish trend in oil volatility right now. You can use OVX. It's been declining from 100+% down to about 75. But we look at where could it go, right? And for that to kind of get back to a bullish trend in volatility, you need to see that well above 90%. So I'll just use a 91% vol, $93 underlying price. And that's going to give you a $5 one-day expected move and a $12 1-week expected move. And then that's modeling volatility to understand, okay, where could we go versus where we are.
Absolutely. And
we're open now.
Oh, yeah. The floodgates have opened. We also have Costco earnings this week, I believe. Yeah. So 2 days from now, Costco earnings. I really want to play this to the upside. We saw it come down quite a bit over the last couple of days here, down to 1025 from closer to 1100. But kind of a wild implied move, all things considered, when you've got just not too much going on here with Costco and the expected move for earnings. But we shall see. We shall see. E-minis selling off a little bit, down 40, down to only being up 43, not down 43. That would be crazy. NASDAQ at 340, Bitcoin, ETH selling off a little bit. Crude kind of hovering around that same range. Doesn't look like I have anything that I need to adjust, at least immediately, in this portfolio. That Nike Leap doing well, up $100, but I'm going to hold that until hopefully we get to 60. That'd be nice. But yeah, Micro Mini straddle sitting at 7,600, 22 days out. Actually, you know what? I'm going to move this. Maybe I'll move this today. I have to move to the next cycle. So if I move this 7,600 to the next cycle, it's going to make me pretty flat delta. So I think I have to move this up again. But as you can see, I can pick up a ton of premium here. If I buy this back for 205, I can move this to the 7,700 for a pretty big credit here. 120 points, just adding a lot more value. I think I need to do this. Do I move it higher? 7,800? Maybe. Let's do that. Let's do 7,800 for 145. See if we get a fill here. I'm just going to let that work. But really, this has been a great trade because we've been chopping around and I've ultimately eliminated all upside risk and just continue to roll the strikes up, similar to what you can do in the crude oil contract. If we do get tested to the downside, I can just go ahead and sell that put or buy it back and sell it and roll it out. So manipulating extrinsic value, always something you can do with undefined risk. That's one of the benefits of it. But again, it is undefined risk at the end of the day. Do you have anything that you've got your eye on this fine morning?
I've got a list of things I'd like to buy, Mike, but they seemingly never move lower. I've talked about this a little bit over the last couple of weeks here during different appearances on the show, but I'm looking to buy dips in commodities. I think you're going to see, these supply constraints persist. That should lead to higher prices. We haven't seen any shift in demand, and that gets well outside of energy products. You look at some of the derivatives there, kind of what that feeds into. That's fertilizer. You're starting to see some headlines around, food shortage, and not that we want that, but in terms of like positioning around what's happening in the market, I think those are longs in some of your softs, depending on where we are within that range. I'm looking at individual equities still within kind of the industrials sector or within energy. I think natural gas pipelines are interesting longer term, but these are all things where I'm not looking at this as a short-term trade where volatility is up. I might enter the position by selling a put, and then if it does go in the money, if I'm not rolling it, maybe I'll take those shares. But I'm looking at these as kind of longer-term opportunities that kind of have this structural tailwind behind them. I also think Berkshire is interesting. Just given the massive, I believe it's like $390 billion cash pile that they're sitting on. So Berkshire Hathaway, I almost wondered, is that somewhat insulated from a drawdown because they have so much dry powder, so to speak, to put to work if you get that. So BRKB is on my list. Let me see what else here. I like a lot of the data center, or more so the crypto miner to data center transition theme. Those have run a little bit, but pullbacks in there are interesting to me. So that's things like CoreWeave, CRWV, IREN, TeraWolf. We've talked about this quite a bit. CleanSpark, anything that's going to allow you to continue to participate in this AI build out, and then more so the picks and shovels of the AI build out, the data center build out. We could argue that it could be overvalued or a little bubbly at times, but I don't think it's anywhere near being over. You probably will get a correction in there. That's what I'm waiting for. So for me, Mike, I haven't been that busy outside of my biggest position right now is short a lot of premium or a lot of volatility in crude oil, but hedging out that Vega risk in the event that we do see a gap higher for whatever reason.
I like it. And yeah, it is true. It's like there's these products you want to get long or trade in, but it's just you haven't had the opportunity to see that pullback. Like every pullback we've seen in the E-minis and NASDAQ has just been immediately bought up, whether it's intraday or the next day. It's been crazy.
Yeah, it's been really hard to be short in here. I've tried a couple of times where maybe not so much being short, but trying to be long some vol. That clearly hasn't worked. Have tried to be short semis. That hasn't worked. Have put on some shorts in the S&P. Just more kind of like tactical things. Wrongly assuming that there was going to be a negative headline here or there. We just haven't seen it throughout most of this ceasefire. So I thought markets at those levels were primed for some sort of just short-term correction, but from a trading perspective, haven't really seen much of that. A couple days here or there, like you said.
Yeah, TeraWulf's up 11% right now. Quick headline search: TeraWulf stock jumps on Kentucky data center site acquisition by investing.com.
Yeah, I mean, at some point, this has fully run its course, but I think those are still, shorter term. Those are things that you want to be on pullbacks.
Yeah. I am in this, the iron calendar spread here, converted from the crab trade. I had the 60, 80, 100 crab trade, and then into the initial sell-off after that, rolled it down to a calendar spread. But this is another one where like you can just manipulate this however you want. So same story. I'm long August, which gives me the ability to move June to July. And I think I'm going to do that right now. But this is kind of cool where you can buy back the 60, you can sell out the 70. And this trade right now has a 745 basis. So even though I'm paying a slight debit here to make this adjustment, I'm giving myself $1,000 of intrinsic value potential to the upside if it keeps climbing. And I like the fact that it's rallying on this kind of most likely sympathy with TeraWulf, since they're similar products.
Yeah, a lot of those are all going to be positively correlated, at least they have been. Speaking of buying the dip, when you do get a correction, even though it was off of pretty elevated levels, look at Micron. 838, up another $87 today. That's 12%. You had your dip, right? We were talking about this above 700. It looked a little extended, got your pullback, and boom, you're at a new high.
Insane.
So I think that's the price action that you want to continue to trade in here until you get a signal.
Yeah.
If there's anything that's changed, and as we opened the show an hour and a half ago, nothing has changed.
Yeah. And these products, and this is a great day to look at this, but like this implied volatility rank and implied volatility into this rally has spiked dramatically. Like we were looking at an 80 IV rank before, we're at 100 now, and the IV 5-day change in here is going to show a higher reading as we get into the week here. But it's nice to see that you're getting implied volatility expansions into these big rips higher. It is an $850 stock now, which is absolutely nuts. This thing was sub 100 last year. I think this is the stock where I was saying like you're gonna be walking around and you're gonna see this guy or girl in a yacht, and it's gonna just have like Micron on the back of it, and you'll be like, oh, did you buy some calls in Micron? And be like, oh yeah, crazy move, 10x in the stock price itself, which, as you can imagine, means the options have gone berserk as well. But they have earnings in about a month, 187-point implied move right now for earnings. Which is just nuts. But hey, that's what it should be really with a stock price that's 10x over the last year.
Yeah, you live by the volatility, you die by the volatility. You have to expect that, right? I mean, we talk about that in crypto at times, but this is it's a different animal here.
Yeah. But yeah, Costco earnings coming up in a couple days here. We'll definitely be trading this. We'll see if we get a nice move there, but yeah, opening bell, E-minis sold off a little bit, still up 42, NASDAQ up 300, down the Russell, Bitcoin, ETH, all still chugging along to the upside. But we're going to take a little break here, quick 90 seconds. We'll be back shortly, and we'll bring on Chris Vecchio for Let Me Explain. You're listening to Tasty Live.
We wanted to call in because recently, some traders may have known there was some crazy activity in the SPX, and for some reason they were stopped out 200 or 300%. And what happened, unbeknownst to us, is the trade desk just emailed us and said these trades have been busted, and you're not going to have to pay it. It saved us about $10,000. And then Marty calls us this morning and says, I just want to explain to you guys what a trade bust is. When you really get down into the nitty-gritty and you're in the foxhole and things are going bad, when you can reach out to the trade desk and you talk to someone that you've spoken with before who understands your account and the way you trade, that is a feature of Tasty Trade, which I think you guys need to emphasize more, because it certainly has meant a lot to us. It saved us a lot of money, and it's taught us how to trade a lot better, and that's really helped a lot.
Well, thank you.
This was not a paid, you're not getting paid for this advertisement.
I've got some huge news for traders everywhere. On June 4th, the pattern day trader rule will be replaced by new intraday margin rules. Tasty Trade has been advocating for an updated PDT rule for years, and we're ready to go on day one. You'll have more flexibility to manage risk when and how you want. Join Tasty Trade today.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Looking for market insights you can count on? Check out Option Trades Today, your go-to podcast for timely trading analysis and strategies. New episodes drop every Tuesday and Thursday at noon. Available on YouTube, Tasty Live, or wherever you listen to podcasts. Don't miss out on the trades that matter. Stick with the bat, stay ahead of the market. Watch Option Trades Today.
We built Tasty Trade's web platform for today's traders. Drill into data, find opportunity, and track the action with hundreds of indicators. Fund your account and start trading right in the app. Join the club. Tasty Trade.
I got a good feeling. I got a good feeling. Yeah, I love this life and I'm living it up. You can't stop this dreamer. I'm a mad hatter. Call me one of a kind. I'm a true believer. I got a good feeling. 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 Leaning off of that edge, don't need a green light. I got that fever. I got a good feeling. 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 I
What's up, everyone? Welcome back to the show. We've got some more content for you the rest of the day. We are bringing in Sir Chris Vecchio, the champion of the Eastern Conference himself. How you doing, Chris?
It was a tough game, but I did do it myself last night. Mike, thank you for pointing that out.
Of course.
It's glorious. You know, a week ago, I sat here and was chided by Tony for making a remark saying that I didn't know that Cleveland was still a city. And I stand by that remark. And I thank the New York Knicks for cashing the check that I wrote with my mouth.
Hey, it was crazy. I was actually shocked. I didn't think they would get swept, honestly. But then you look at the box score and like Donovan Mitchell and Harden had 3 total assists the entire game. That's not going to get it done. And that's how you get blown out by 35 points.
Harden looks old, man.
Oh, he's
and
so
I say
bad.
that as someone who's older than him. He looks old.
Did you see the meme of them like shoving each other to the ground in the back halls after the game? So good.
Yeah, I'm enjoying every minute of it.
Yeah.
And you know, people are complaining that the Knicks fans are traveling to Cleveland and they're taking it. Listen, Timothy Chalamet got one of the Kardashians to go out to Cleveland. I mean, like that's how powerful this team is right now. Okay,
That's powerful.
So it's Mets and the Yankees. It's a divided city. Jets and Giants. They're both loser teams, and it's a divided city. But the Knicks, no one cares about the Nets. So the Knicks can wage economic warfare against the rest of America as a traveling group of fans taking over your arenas. So San Antonio has no idea what's coming. Neither does Oklahoma.
Yeah, it's shaping up to be a wild finals because the Knicks have not gone to the finals since '99, I believe. And then you've got Wemby in San Antonio. That would be a crazy story. And then OKC, they're just a juggernaut, but I think they could be taken down.
None of the Spurs players were alive. Spurs starting 5. They didn't exist yet the last time the Knicks were in the finals.
They were just a thought. And now here they are battling for all of the glory. But yeah, I'm excited for you. Congrats again on the win.
What more could you want? 70, all-time highs in S&P 500 and the Knicks going to the finals. Ilya's going to have a miserable. Here's going to have a miserable day.
Hey, it's it only happens once every 25 years. We got to give it to you, right?
Thank you. Thank you. Yes. No, but we're the markets here at the start of the week. Volatility, I think volatility compression has to be the thing that stands out the most. In particular, even in the Bitcoin space right now, crypto space, I should say. I know it's rallying hard here, but at 0.2 IVR on the platform right now in Bitcoin futures, that seems really, really low. But also then we're at the start of summer. So I suppose in the spirit of this little segment that we typically do, let me explain. We're now in the summer months, guys. Volumes are going to be lower. Volatility typically dies down. This is the window when markets tend to rally. We don't say sell in May and go away. We say buy through July around these parts because the market typically goes up in June and July. In fact, over the past 10 years, if you bought in May, June, and July, you'd have returned, roughly speaking, 5.2% on the S&P 500. It's been a pretty reliable thing to do. And now we're moving past Iran. What's standing in the way right now? Mike, what are you concerned about here? I know that you're someone who tries to trade in and out of the market a little bit more than I do. I'm more of a directional guy who just rides that Bronco until it bucks me off. How are you approaching this now that we see a market near highs and the summer conditions arriving with this very low volatility?
It might surprise you, but I'm not too worried at all. I mean, I'm still wearing my permeable hat, and I think the curve of the vol futures really tells the story with the steep contango that we've got between the M, the N, the Q, the U, the V. All of those contracts are in contango. We got the VIX in the mid-teens. To your point, like the summer months are coming here, and if inflation, I think we don't emphasize this enough. Like if inflation's your worry, you have to realize that inflation increases all prices of all things, including assets. So I think we're going to be hitting new highs here unless something changes and something happens to where the vol futures will flatten out, maybe go into backwardation. But until that happens, I'm chopping up and to the right is what I think will happen here.
Yeah, Ryan, I mean, I'm thinking about what happened in 2021 and 22. We knew the inflation was coming in 21. In fact, the inflation did come in 21, and it kept rising through mid-22. And it wasn't until the Fed started hiking rates in 22 the cost of money changed, that the market and risk assets, broadly speaking, started to keel over. And so I think Mike brings up a really good point. If you're worried about higher inflation, you need to do something with your money to keep it, well, to preserve it for purchasing power purposes. And that incentivizes people that until the actual cost of interest rates moves, people can keep piling into stocks like we did in 2021. If we get the rate hikes, we may have a different problem in our hands. But I know people haven't been paying attention to Bitcoin here right now, but the low vol and this push higher today alongside stocks moving to all-time highs, that feels like maybe we have something to work with there a little bit now. The space feels dead, though. Is that your vibe?
Yeah, it really has been. I mean, you're talking about historical lows in volatility, at least over the last 1 year. Realized implieds are pretty much as low as they've been, or that we typically get in there. I mean, Chris, I think it is dead when you can go anywhere else at the moment and have a little bit more fun, make a little bit more money, right? I'm looking at Micron up 12% on the open. The AI trade is pedal to the floor. I think if you're looking at longer term, I want a little bit of this in my portfolio. It does tend to benefit from asset price inflation over time. I think there's real reasons to at least own Bitcoin, and some reasons as well, in my opinion, to own things like ETH and Solana. This gives you an opportunity to kind of dollar cost average in, try to buy a little bit on some pullbacks here and just put it away. But I would not in any way expect that you're going to all of a sudden see, a massive move higher, unless you do get some headline that maybe the rest of the market isn't necessarily focused on or paying attention to. I haven't watched all that closely around some of the headlines related to the strategic reserve, but it's those sorts of headlines that could get you that move. Otherwise, I just think there's way too many other places to go or to play. And for now, crypto is quiet. We'll put it that way. Won't be forever, but less of a reason to own it. Just given
I love what you bring up about how Micron is kind of mooning again today, up another 12% right now. It feels like the folks who are trading crypto, probably the speculators, have moved over into the semiconductors for the time being. The AI infrastructure trade is just so hot right now. But we do this series on YouTube, myself and Jamal. Jamal's been taking vacation, so I've been doing it by myself recently. But signal versus noise, where we look at unusual options activity on the tape and try to figure out if there's a bigger story there behind it. And so in that same vein, on Friday, President Trump was here in my congressional district giving a speech to help support the Republican that's up for re-election. And during the speech, which I was listening to, he only mentioned one stock, mentioned Micron.
Wow.
And that little signal versus noise bell in my head went off, went, son of a bitch, I can't buy any Micron right now because the market's closed. That thing's going up on Monday. And here we are, 12% later. So, I mean, that is what we're seeing right now. It feels like a lot of retail flow or a lot of retail activity that would have otherwise been helping put wind in crypto sales. They're being stock jockeys right now. How can you blame them?
Yeah, look, if we do get into, as maybe you alluded to, or you guys were talking about earlier in terms of the inflation dynamic, you move out of this period where, from what I can see, it looks like both growth and inflation are reflecting higher here. Well, let's say that you see that inflation stick around and growth slows down. You get a little bit more stagflationary environment. I think that's one in which crypto, given the bid into assets and to participate in that inflation dynamic, has historically done well at times, but you need to see that price signal first before you start to believe that the trade is on. That said, the market here at all-time highs, it's not like crypto hasn't but it went from 60 to almost mid-80, perfectly correlated for the most part of the last month or so with the rest of the equity market. So it has played along, but it's just not doing those things that I think historically you would expect as a crypto trader or investor you would expect to see, and instead that's showing up in many other areas of the market.
I mean, I'm continuing to trade it to the long side right now, but it's not the most exciting juice that we have in the market. I mean, Mike, one of the problems that I think a lot of traders have is when a market's sitting up at all-time highs, how do they structure their trades so they don't feel like they're chasing? I find it very difficult to look at volatile. VIX has a sub 17 handle now. And you mentioned the shape of the VIX futures curve, where when you look at 5, 6, 7 points wide from front month to back month, that is a very healthy just keep buying the dip and let this thing run higher type of attitude. So how do you structure those trades though? Do you do the short puts up here? It feels like that's ill-conceived. I'd rather reach for maybe long at the money call spreads and see if the market can keep just scratching and clawing its way to the top side.
Yeah, I've been doing kind of a blend of diagonal spreads, calendar spreads. I like the horizontal nature of short option and long option, where you can inventory delta at a lower IV, sell premium at a higher IV in the near term, and then you can actually make money on both of those legs at the same time if you get the timing right. So I'm doing that in single name equities like Microsoft, Nvidia, silver. I have some positions in. I have a macro position in the micro E-minis. I just bought the dip in crude oil, which kind of acts as a potential hedge there. But I'm also pairing that with SPX trades. So I've been throwing on these bullish single name equity trades that are, between $500 and $1,000, we'll say, in terms of total notional risk. They're almost all diagonal calendar spreads. But then in SPX, I'll put on a neutral iron condor or a downside butterfly. So I like these 100-point wide butterflies to the downside because you can buy them for $400 or $500. And if the market rallies, you can move in your furthest out of the money long put. You can move it up for like $1 or $2 and really give yourself thousands of more dollars of profit potential to the downside if we do get a wipeout in the market. But the interesting thing about these iron condors is that I currently have 3 iron condors on. One of them is 100 points in the money on the call side. Another one is 75 points out of the money on the call side at 7,600, and I have another one at 7,900. So the way I'm approaching this is I'm throwing on these neutral iron condors for like $300, $400, risking $600 or $700. But if they get the move to the upside, I'm making money on these other single name equities that I'm placing bullish trades on, most likely. And now all of a sudden I have this neutral trade that has turned into a bearish hedge. So my iron condor out in June is a 7,400, 7,420 short call spread that's in the money right now, currently trading for $1,500, the total package. But if we get a 100-point sell-off over the next 22 days, that's a $1,500 hedge back to the portfolio. So it's like I'm creating neutral trades, letting them get tested to the upside and just leaving them, in the sense that if we get a sell-off, I have the ability to hedge any sort of losses on positions that are active that I haven't closed. So long-winded way of saying diagonal and calendar spreads to the upside in single name stocks, neutral to bearish trades in SPX, defined risk, and especially the downside butterflies. You put them on for a couple $100. They've got a $9,500 max profit if you pin it perfectly. I'm not trying to do that, but I am trying to just place these trades, especially as the market moves to the upside. Like if I didn't have a butterfly on today already that I placed last week, I would be certainly placing one today into this 50-point rally in SPX.
You mentioned crude oil there. Crude oil to me is been the most reliable thing to trade over the past few months. When it dips below 90, sell some puts around 70, 75. And when it rallies above 100, sell some calls above 110, 120. Today's a good day to reorient ourselves and look to sell some more puts. It's still a 60 IVR, right? And if you see volatility falling off in other markets, the Bitcoin has below 1. Natural gas, I think, still has a 12, 13 IVR. You're not really finding the volatility in the places where it usually exists when it starts to die down in equity. So oil to me is the best place to sell premium right now. Something is going to have to go off the rails with Iran. We've seen this in recent weeks, guys. Just the language that Trump's deployed around talking about the war. Missile strikes are love taps. That's not apocalypse now kind of talk. So he doesn't want to do this. He wants to get out. He's looking for an off ramp. We see it over the weekend. He's talking about the Abraham Accords with the Gulf states, which seems highly unrealistic, but it just goes to show how he really wants to get this over with. So any opportunity still, play ping pong in oil. Oil infrastructure is not coming back online. So you think we're going to get back to 65, 70 oil like we were pre-war anytime soon? And the market still wants to give us risk 3, 4 to make 1 on those trades. We have to take them as long as the sun shines.
Completely agree.
Yeah, I think Ryan's been trading crude oil, selling premium there. I just sold a put in micro crude with the intention, and that's the nice thing about these near-term contracts too, right? Is you can sell the 3-day for $2 If you get tested to the downside, you can roll it to the 21-day and move it 10 points out of the money for a credit. So plenty of implied volatility there. And even with compressing implied volatility rank in crude oil, the actual implied volatility is still very healthy at 75, 80%. So you're getting plenty of bang for your buck there if you're selling premium, but still got to do it in a way that you can manage for sure.
Aside from that, I mean, are you guys going to take Knicks or the Western Conference Finals team in the finals?
I got to go with the
you
Knicks.
And I are. Thank you.
I'm with you.
Thank you.
I'm with you, Chris. All the way.
Thank you.
But I will say, I don't know who's doing that. I will say though, if it's the Spurs,
that's James.
It's definitely James.
We know that's James.
If it's the Spurs, Wemby will destroy Cat. So that's the weak link there. Although Cat went off yesterday, I don't think he can do that against Wemby. So that it's got to be a guard.
Cat to go off.
Huh?
You know what really, the reason why the Spurs are such a good matchup for Oklahoma, for OKC, is that they don't have a big center that can shoot.
Yeah.
So Wemby can clog the lane.
Yeah.
With Cat out there, Wemby can be drawn out of the lane. And so that allows the cutting from like Bridges and Hard, and it's going to work out. You just watch.
They are the better, more complete team for sure between both of them, especially now with some injuries on OKC front. And if they, like, best case scenario is that goes 7 games and you get guys that are tired and hobbled against a very healthy Knicks team. So congrats on the sweep. That certainly helps you for sure.
I said it last week. Rust is easier to shake off than fatigue. And that's why the Knicks were going to beat the Cavs. So it's happening. It's happening.
Yeah. Can't wait. It's going to be amazing. Well, thank you, Chris. Congrats on your win. Go sit in the ice bath. I know you probably have some sore muscles, sore joints after yesterday's win.
No, I was putting together deck furniture and I got my hand stuck. And so I got these 3 blood blisters now in my finger. So I'm going to go pop those.
Perfect. Amazing.
Yeah. Good.
Well, thank you again.
Great.
We're gonna take a little 90-second break. We'll be back with a market measures for you. Should we trade bullish strangles? Strangles. I thought it was said strategies where I said yes. The answer is yes. One slide. But yeah, we'll be back in 90 seconds. Thanks for tuning in. You're listening to Tasty Live.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
First thing about Tasty Trade is how easy it is. It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better.
In fact, I've never seen anything like it in any corporation in the United States.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Today's episode of Market Measures is brought to you by SIBO. SIBO is partnering with tastylive to provide educational opportunities for traders at all levels. Did you know index options like these can provide opportunities for diversification, lower volatility, liquidity, and other benefits? To continue your education on some of the mechanics learned in today's Market Measures, check out SIBO's Retail Trader Suite at www.sibo.com/minis.
What's up, TC Nation? Welcome back to the show. My name is Mike. I'm here with Ryan. We've got a market measures for you on this fine Tuesday morning. E-minis and NASDAQ catching a bid here. E-minis up 55, NASDAQ up to 440. Bitcoin and ETH catching a bid as well. And Micron is going straight to the moon, up 103 points, up 13%, almost 14% right now. Just an insane move to the upside. And this, I guess, is the new NVIDIA. Who would have thought?
Impressive.
Who would have thought?
Yeah.
Insanity. If you want to join us on the YouTube channel, we're streaming live there. You can throw in trade ideas, questions along the right-hand side chat. We should be able to get to a couple of them over the next hour or so. But first, the market measures of the day. Should we trade bullish strangles? What do you think, Ryan?
Absolutely. Now we're talking about, just to set the stage here, we're talking about presumably strike selection. Yeah. Obviously, a strangle is a short put and a short call, but this is likely looking at keeping that short put a little bit closer to the current stock price when you set this up, giving yourself a little bit more room to the upside.
Yeah.
And giving yourself some positive deltas.
Yeah. I think it is a super viable strategy, especially in indices, ETFs, products that you can manage more easily than an equity. But yeah, I have some strong thoughts on this that I will share at the end. But let's dive right in. Trading bullish strangles. Stock markets keep moving higher despite various global uncertainties. That is true. This strength makes bullish option strategies more appealing, like solid naked puts or covered calls, which profit from upward price movement. As you can see, this is a chart of SPX over the years, and I mean, it's nuts. In 2012 we were at 1,000 SPX. Now we're sitting at what, 7,500? Just crazy gains to the upside. Trading bullish strangles. When examining premium income potential, 30 delta puts typically generate higher premiums compared to 16 delta strangles over extended periods. The premium advantage can potentially lead to better success rates and improved performance during sustained uptrends. So just taking on a little bit more risk in terms of intrinsic value, picking up some more premium by being more aggressive. And a 30 delta put is still pretty significantly out of the money compared to a 16 delta put. But you can ultimately make up for the same amount of premium. And sometimes I say this too, like if you're looking at selling a strangle in a product and you're selling the put for, let's say, $2 and the call for like 50 cents, just get rid of the call and move the put slightly higher. Make up that premium, get rid of the upside risk. And I think that is something that you can do in this situation too. On slide 2, we can show the premium for the 30 delta put relative to the 16 delta strangle. So again, sometimes, and I would say always, if you're selling a strangle, you want to make sure that you have premium on both sides, like meaningful premium on both sides. Otherwise, just move the put up, or if you're bearish, maybe you move the call down, but I don't like selling naked calls personally. But you can make up the premium by just moving the put a little bit higher and removing all risk to the upside there relative to a 16 delta strangle. On the next slide, for those seeking upward participation while maintaining downside hedging, a bullish strangle with net positive delta would be an interesting alternative. How does this adjusted approach compare against traditional delta neutral strangles? Let's find out. We looked at 2 different 45-day SPY strangles over the past 2 decades. So we looked at these 16 delta strangles for your neutral strangle, and then a 30 put 16 delta call strangle with a bullish lean, and closed all positions at 21 days from expiration. The bullish strangles had better returns even though they were a bit more volatile and could lose more money, which makes sense. If you compare a strangle to a straddle, straddles are going to be more volatile, but you're picking up more money, and you can make more just selling straddles because you start with more premium and you can keep more premium if you get the timing right. But put side break even is closer, so market drops have more impact, but the return on capital was better than neutral strangles, and you can see this here. So very similar success rates when you look at the 1 standard deviation versus 30 delta put, 16 delta call on the right. The annualized return on capital was significantly better, so I'll take that all day. Same success rate with almost twice the annualized return on capital. A little bit less return on capital volatility with the neutral strangle. And the largest loss was just a little bit less than your 30 delta, 16 delta setup. But I think when you think about the product you're trading, right? If you're trading the S&P 500, the more it goes down, the more inclined I am to just stay in and take on those deltas, because we've seen the probabilities of reversals to the upside get substantially higher as you go down 10%, 15%, 20%. On the next slide here, we compare the bullish strangle to just selling 30 delta puts. The strangle made less money and had a lower win rate. The call side reduced the profits, but the strangle was less volatile and had smaller maximum losses. It's a compromise that gives us some upside while controlling risk better than naked puts. So just the 30 delta put relative to the 30 delta put and the short call, success rate was higher. Annualized return on capital was higher because you just don't have to deal with the upside at all in this situation. But this is where I kind of want to add in my own layer of complexity here, because I've had success with 2 separate instances of no upside strangles in IBIT, and then also in the micro E-minis, but we can touch on it at the end of the segment here. But yeah, any thoughts on the difference so far with these setups?
No, I'm not surprised. I mean, we saw the chart at the beginning. I know this study is going back, over the last 2 decades or so. We're looking at market cap weighted indices. So, the biggest companies just get bigger given the passive flow over time. Of course, there can be periods of volatility. We've had large drawdowns as a result, but not really surprised when the majority of investors and the majority of capital flows are buying assets, and there is that positive upward drift over time. I wish I could add more, Mike, but I think you hit on a great point. You go in here and at times you see high volatility, you see high IVR rank, and you want to put on a neutral strategy or a range-bound strategy that's going to benefit from that. But in doing so, if you just quickly go in there and you look at, okay, I'm going to do a 1 standard deviation move, I'm going to do 16 delta for my strike selection on both sides. Well, there's the skew that typically exists on the put side. So the puts that are that distance away, the same distance as the calls, are going to be a little bit richer in terms of the price. But quite often in these very low vol environments where you grind higher, it's not like there's massive volatility to the upside, at least not in, say, the S&P 500, maybe in individual names like Micron, which we're seeing today. But quite often you're just not selling an option for very much money. Yes, you're going to get a larger credit, but you add that risk as it just grinds up, and you go out there, you go out a month and a half, you go out 2 months, you sell that call. A lot can happen in 2 months. And so I am less prone to sell strangles personally than I am just to sell cash secured puts, naked puts, whatever. Because again, quite often you're just not getting paid to sell that upside risk. And I think as well, we often, I know I do, overlook, well, what is the implied versus realized vol anyways? Is there even much of a premium in there to sell that 40-cent call option that today, with a month and a half to go, is a one standard deviation away? But the delta move and the grind higher, even in lower volatility, ends up hurting you. So not surprised.
Yeah, especially in these super strong markets where it's just like up and to the right every single day. Like you're going to take more heat on having a short call, period. And really the only way to get out of that heat is if you do get a sell-off or just a neutral chop to where you can take that premium out. But again, I want to touch on something at the end of this segment real quick. But let's move on to the next slide here. To complete the picture, we also looked at a bearish strangle for comparison. Oh no, we just flipped the deltas from the bullish version to see how it would perform in the same market environment. And I can tell you it's not going to be good. Bearish strangles underperformed both alternatives while showing the lowest volatility among all three approaches. Returns were below expectation. The strategy appears to be better suited for traders holding bearish market assumptions, or maybe offsetting deltas. Like there's always, a way that you can make this type of thing work holistically, but not in equities, like not in Micron. You're going to have a real hard time if you're doing this in something like that. But again, doing neutral, slightly bullish, slightly bearish strategies, especially undefined risk, it's a lot easier to manage if you're doing it in an index or an ETF that doesn't move 30%, 40% in a day. Like that's when you can get into the troublesome situations. But at the end of the day, still interesting to see that you had a slightly positive annualized return on capital, likely because during those periods of downside movement and just chopping sideways, you had your ability to make some money there. But lower success rate, significantly lower annualized ROC. And of course, it's going to happen when you have this up and to the right market that we've been trading.
Well, also consider you can get near, or at least historically, you've been able to be closer to it at times, not probably over the 20-year period here because we had a period of zero interest rates. But recently, you can get a 5% or 4% return on capital on your cash position versus like perpetually being kind of betting on the market not going up.
Yeah.
Doesn't mean that it's going to go down, but not going up is tough in my opinion.
100%. Couple of takeaways here. Bullish strangles have positive delta exposure, so they perform much better when markets go up consistently. We get higher returns, but also accept more volatility compared to neutral strangles. And the bullish strangle sits strategically between selling naked puts and neutral strangles. We get solid returns from the put side while having much better downside protection and less overall volatility than naked puts alone. And I would take this one step further. IBIT. I had a year-long strangle. I do a year-long strangle every single year in some kind of product. I did it in DraftKings once. I've done it in IBIT. But my whole strategy with IBIT was I will not take upside risk. So even though I had a strangle on, instead of waiting until 21 days and just accepting the upside risk, I would shift the whole thing up. So like if I was tested on the call side, I would shift the entire strangle up. So my short call being tested turned into my short put being tested. And that really opened my eyes to a situation where you can just manipulate the whole thing. And as long as you're comfortable shifting your deltas higher, and for me, if I'm picking up thousands of dollars of premium over the course of a year, I would still rather have my put be in the money, which is going to reflect a covered call risk profile. I'm doing the same thing in the micro E-minis here this year, where I started with a 6,600, 7,100 strangle. at the end of last year. I now have a 7,600 straddle, and it's up $1,600 right now. What's crazy though is I've picked up 534 points of premium, which in SPX terms is $53,000. You could close that trade right now for a net win of 33 grand on one contract into this big rip to the upside. So
and that's through managing your deltas.
Exactly.
Yeah.
And there is something to be said about having the call on just in case there's a market sell-off. You get the premium out of the call. Even if you're manipulating it higher over and over, you just need one week 5% sell-off, and you can buy back that call and just lean along with the short put or manipulate it as you see fit. But yeah, I think this will be a core position that I have going forward, is kind of a blend of this, where I have the bullish lean, but I don't take the upside delta. If my call is getting tested or about to go in the money, I just shift the whole thing up, because especially in a product like the S&P 500, regardless of whether it's an MES or SPX or SPY, you're playing into that up and to the right drift that happens passively over time. You're still collecting more premium by keeping the call on. And even right now, this is still a position where I've made more than 50% of the premium that I've collected this year. And we've already had war sell-off, rebound, like crazy rebound to the upside. But I'm just managing my deltas, never taking on upside risk, shifting the whole thing higher, closing my eyes and just doing it. And it's been a really great trade. So kind of blending everything all at once, but just never taking upside risk in the S&P 500 in a market like this can work out. And it can really help you just offset all of those delta losses that you would have taken if you just let it go.
Absolutely. Yeah, you have to actively manage it. And I want to clear one thing up for Minute Maid in the chat, just asking about what's on the slides here. So in the trading bullish strategy slide 7, I believe, we're looking at the 30 delta put, 16 delta call. So closer there on the put side. And then on the last one, it's just flipped. So you've got the 16 delta put, 30 delta call, and that's the one where we saw a pretty poor return on capital, relatively speaking.
Yep. So yeah, the one standard deviation on slide 9 on the left there is just your neutral strangle, 30 delta put, 16 delta call right next to it, and then 16 delta put, 30 delta call. So you're just leaning slightly bullish or bearish in either direction. But if you can take it a step further and just shift your delta and adjust your delta as it moves, you can really get out of harm's way for the most part. You still got to trade small enough to where you can withstand any variance. That's the key here. But yeah, great segment. Love it. We'll take a little 90-second break now, and we will be back with live from the trade desk with the boys, Quentin and Glenn. Can't wait to hear what they have to say. I'm sure they're excited for the PDT rule elimination as well. But you're listening to Tasty Live. We'll be back shortly.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
I've got some huge news for traders everywhere. On June 4th, the pattern day trader rule will be replaced by new intraday margin rules. Tasty Trade has been advocating for an updated PDT rule for years, and we're ready to go on day 1. You'll have more flexibility to manage risk when and how you want. Join Tasty Trade today.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
First thing about Tasty Trade is how easy it is. It's a very quick, light platform.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that.
On Tasty Trade, adjusting your option positions is a right click away. Rolling just got quicker. Switch to Tasty Trade and earn up to $3,000 in commission rebates.
What's up, Tasty Nation? Welcome back to the show. E-minis catching a big bit here, up 60 now. NASDAQ up 520. Micron up 17%. Squeezing to the upside. Absolutely nuts. Bitcoin up 2,300 as well. It is time for me to try and do what Nick does every single day when he has Quentin on and Glenn. Do I hear a little... Yes, we do have Quentin in the house. How you doing?
Fellas, how's it going? I'm doing well.
Good.
Good. That was...
You like that? That was bad. That was poor.
It wasn't bad, Mike. I did like it. It wasn't bad.
A for effort, you know.
Yeah, we've been in here a lot when that happens, so we know how good Tony is at it. It was a good first shot.
Thank you. I appreciate it.
No, we'll work on it. We got plenty of time this week to work on it, right?
That's correct. That's right.
Yeah.
What's new? What's going on the desk over there? Getting ready for PDT?
Yes.
Elimination?
Cannot wait about PDT. We can go over that really quick. So right now, currently, with the PDT rule, you can only do 3 day trades in a rolling 5 business day period without being classified as a pattern day trader. Once you do more than that, so 4 round trips in a rolling 5 business day period or anything beyond that, you'll get classified as PDT. And then if your account balance is under 25,000, then you'll be restricted for trading. However, this whole PDT classification is just going away. So it's not like there's a new minimum or anything like that. Just being classified as pattern day trader just no longer exists. So there is like the $2,000 limit to get like day trade buying power, but that's like mainly for stock. You know, if you're day trading options, things like that, you can just day trade as many times as you would like now. Of course, please be careful. You know, day trading involves high risk and stuff like that. But yeah, very big day for the industry. You know, I think this rule is older than I am, actually, this PDT rule, which is crazy. But yeah, finally going away. So the whole classification is PDT going away. Day trade calls also effectively going away. As long as you're not in a margin call, you're good to go. Our system won't let you put yourself into a margin call for any opening trades, right? So you're pretty much good. And yeah, can day trade as you wish.
Yeah, day trade calls was something I was talking to Ryan about earlier. It's just like one of those things where you think you're in the clear if you have over.
Day trade calls are the worst.
Yeah, it's
day trade calls suck.
It can apply to anyone really, as long as you're with the whole starting day trade buying power thing, which is going away as well. So a lot more flexibility to trade how you want, manage risk how you want, most specifically. But yeah, next Thursday, it's going to be wild.
Yes, cannot wait for that. Yeah. Very, very excited. And you know what I was thinking about over the weekend as well is like, so you know how like, I mean, more or less the market just does nothing but go up sometimes. And it's just sort of like straight, like, I mean, today up 60 points, you know, after, you know, nice Memorial Day weekend. I hope you guys enjoyed the weekend as well, but it's like the market does nothing but go up sometimes, right? Or it sure feels like that. And so do you ever think there will be call skew in the market across indexes? Obviously, we see it in things, you know, like your Microns, Nvidias, you know, those high flyers. But do you think on indexes there will ever be call skew instead of put skew, meaning like the risk is all to the upside?
I mean, that would be absolutely insane, I think. But I mean, you kind of see call skew if you go further out now because they price in interest rates to the upside. But like the near term stuff, like 15 days, 20 days, we'd have to be in just like banana land if we had call skew there.
Yeah, I don't have any data in front of me, but I'm guessing that you've probably seen it at some point once in a while show up in the market throughout history. Not that frequently, but to Mike's point, I mean, I think you need more of a, full-blown mania. I don't believe that we're there quite yet, but you get back to kind of tech bubble 2000, where things just really get out of whack. Possible that you would see that.
Yeah, so people say like the AI, but like I remember there was a lot of talk of like the AI bubble maybe like at the end of 2025. I feel like not so much now because I feel like AI is like just real now, you know, and like AI is like really useful, but like the internet not nearly as useful compared to AI. I feel like there's like these random companies just saying like, oh, internet this, internet that in the late 90s, but like AI is fully real for sure. I use AI with my job sometimes with what I do, like interacting with customers, not super useful. Like it can't take calls for me, but with some of the stuff like writing a report done in like 10 minutes with AI. And it's like, this would have taken me hours.
Yeah.
And I'm like, wow, this is incredible,
Well, I think you look at where the spend is coming from too. If you go back to 2000 or you go back to prior bubbles, a lot of that is debt driven. Whereas here, it's a handful of very large companies that are using a large percentage of their cash flows, but it's cash. And so that's going into this build out.
Interesting.
But it's not debt driven. So that's a little bit of a difference. It doesn't mean that we can't see a sizable correction. And I think as soon as you do get the first couple mentions of, a reduction in spending by some of these hyperscalers on a conference call, I think right now it's about 35% of Mag 7 cash flow or hyperscaler cash flow is going into this build out. So that's substantial. But it is not that they're taking out massive amounts of debt for something where on the other side of it, okay, this isn't working, there's no commercial use cases, et cetera, and now that bubble has burst. So it's a little bit different in terms of what's behind it.
Yeah, right. And there's also like a lot of this AI washing for like layoffs as well, right? And so I wonder like, let's say a lot of those people that do get laid off don't necessarily get hired back if we potentially see some sort of correction based on that sort of stuff as well. And also like interest rates going higher. I don't think that will have much impact on the market. I feel like, interest rates aren't the story anymore. AI is sort of the story. But yeah, very interesting markets we have. I mean, still volatility is still so high at all-time highs, and that's like the indicator, right?
Yeah, I was looking at the skew index to your earlier question of like call skew versus put skew. So like the CBOE, the CBOE skew index, SKEW, it's near the lows of where we've seen it over the last year right now. So yeah, I mean, I was thinking to myself, like, how did we not see call skew into the rally from the war low to now? Maybe you saw it in some expirations, but it would have to be near-term expirations because, again, those long-term expirations just price up those calls to account for interest rates. So that's where you can kind of see like a call skew to the upside. But all else equal, if it wasn't this rally from the beginning of April to now, what would take?
Yeah, right. What else would it take?
Yeah.
Well, I feel like, because we've never seen call skew before or something like that, at least for a consistent period. I can't even think of like a short period where we saw call skew. Did we see call skew like during COVID? Even like, I'm sure like almost definitely not, right? When the world shut down, right? How could there possibly be call skew? But I feel, has the market sort of learned its lesson, to where it's like there are these crazy rips up sometimes. Obviously, it's typically stairs up, elevator down. But do you think the market's potentially changing? I don't know, just some food for thought out there.
I think the market has changed in the speed at which things move. Like when I first started trading 10 plus years ago, these moves were not like this. Like it was not massive V bottoms. Like now it's just V bottoms left and right. And you actually had periods of time where you would just like trickle lower. It would be months and months of just selling and selling and selling. Where now it's like you get that quick selling, and to your point, and then you just get the V bottom straight back up. But I also think that is due to the fact that you have algorithmic trading now. You've got institutional investors and traders that can do anything they want on a dime. Like you can crawl for tweets that say certain things from certain accounts, and then you have these big market moves. Like the market just moves so fast now that I find it hard to believe that a bear market would last for a long period of time unless like the actual economy was crumbling.
Yeah, right. Because I feel like we see now, like the economy may not actually be in bad shape, and like what drives the market is, the Mag 7. And as long as those stocks are doing well, it's sort of like just helps the overall market. And the market doesn't care about anything else except itself, I feel like.
Well, I think we've also, over really the last decade, have been conditioned where if something were to happen, immediately the Fed's going to come and save them.
Yeah, and then buy the dip, know.
And then beyond that, buy bonds in the open market, add liquidity to the financial markets, and it tends to result, at least it has, in asset price inflation. So when everyone is conditioned and believes the same thing, it is somewhat reflexive in nature.
It's like a self-fulfilling prophecy,
Exactly.
Yeah. And eventually, like, the more and what's crazy is, like, I would say 20 years ago, if you saw a bear market or you saw the market selling off, maybe you weren't so quick to pull the trigger to buy it. But now you have so much data. Like, you can look at the data historically and you see when S&P 500 is down 10, 15, 20%, the probability of getting back to highs 1 year, 3 years, 5 years later is in the high 90s. People see that and they are more inclined to just buy the dip, like at the lows. And that goes for retail, that goes for institutions. So I think, to Ryan's point, like, we have been conditioned to understand that this is how this works now, and everyone is participating for the most part in a very similar way. And I think that's what creates these big V bottoms that we see.
Yeah, oh, it's crazy for sure. And the velocity is just nuts.
It's crazy.
All right. Let's get down to some more business here. Got top 20 symbols going through the system and their IVR. At number 1, Micron with a 93, Tesla 20, NVIDIA 27, AMD 91, Intel 80, SoFi 18, SOXL 87, Microsoft 48, ASTS 39, SLV 33, TQQQ 56, Palantir 16, SMH 86, Amazon 18, Apple 34, GLD 31, USO 44, TLT 21, Meta 31, and Google 31.
Micron at the top of the list does not surprise me.
Yeah, I think top 5 isn't surprising.
Yeah.
Right?
Yeah, Tesla is going to be interesting. So we were just talking about the SpaceX IPO. I have been saying that when SpaceX IPOs, Tesla will sell off. Just because there's people trading Tesla to get the proxy exposure to SpaceX and like the future of what is possible for that space. But now you'll have your ability to trade it directly. I could be wrong, but we'll see. But I'm very excited for that. 1.75 trillion, biggest IPO in history. Options soon after.
Wait, 1.75 trillion.
Yeah.
IPO.
Yeah.
That is nuts.
It's insane. It's insane. But this is This is the world we live in.
Yeah, right. I mean, man, that is crazy.
We might look back, though, and the signs were all there. The $1.75, $2 trillion IPO.
Yeah, people are like, they're going to be looking back and be like, man, this is obviously like the ultimate short,
35% of hyperscaler cash flows going into this AI build out. We'll see, but there are some signs.
Yeah, wow, that'll be interesting. Yeah, we've already got customers like excited to trade it. They're like, do you have a date? Do you have a date yet? And stuff like that. And so, yeah.
Yeah, June 12th is when it's proposed to go hit the public wire. I would imagine, so I think that's a Friday. So I would imagine that the next week you'll have options because...
Yeah, options should be there very soon after, I would think.
Like, they're going to add options very soon. Like Cerberus.
Yeah, they got options like right away.
Yeah, immediately. So if they're getting options right away, you better believe SpaceX will have options right away. I just hope it's a decent stock price. Implied volatility is going to be crazy. It will be very liquid, I'm sure. but it might take a couple days to get that liquidity and the bid-ask spreads more narrow. Love it. Love it. Love it. What else are you looking at these days? You hearing anything from the peeps in terms of trading vehicles, things like that?
No, well, recently it's just been all the AI plays, the SanDisks, the Micron, things like that. Because I mean, people are playing it both ways, like taking directional shots and being neutral as well. And so that's where we're seeing most of the trading volume. But then also like a larger spike into the, like, because I mean, it's obviously always large trading volume and like the SPYs, QQQs, IWM, thing like that. But because volatility is still so high, a lot of people are like trading those more than you would think right now, where there's like, and there's so many names that play with, like when I went through that top 20 list, almost everyone is over 30 in IVR. Yeah. And you don't see that too often at all, especially at all-time highs, right? So yeah, it's very easy for premium sellers to be active right now, which is what a lot of our customers do.
Yeah, for sure. And I think, again, like the VIX is in the mid-teens here, 1688. But we're seeing 1% moves every single day. So like that is why vol, you would think that the vol futures would be in the teens and the VIX would be at like 12 or 13.
Yeah.
But the velocity of the moves that we're seeing are still so large that is what's keeping the VIX propped up here.
Yeah, I feel like VIX should be at like 10, 11, 12 right now, you know?
It feels like that, yeah.
Yeah, it feels like it should be, but I mean, clearly not like with the velocity and stuff, you know, VIX is still high at all-time highs, which is very interesting for a lot of our customers that, you know, they like the volatility, right?
Yeah, and I think that's something we've talked about before, but I mean, like just because the market's going up doesn't mean the VIX is going to go down. If the market goes up in a really grindy way, where it's only up, 10, 15 points, 20 points these days, that would create a VIX of like 12, 13.
Yeah, but we're seeing like 50, 60 a day. You know, like what are the SPOOs doing right now? 62?
Yeah. Classic. I'm going to see if we have any questions from the YouTube chat. Yeah, some people excited for the PDT rule. Yeah, we talk a lot about just like the emails and chats we would get for PDT where it's like, I have this position on, it's a winner, I can't close it because I'm in PDT. How can I hedge this? And it's like, it just creates more complexity than I think you really need.
Yeah, and so much friction, and yeah, not a great thing. But thankfully, June 4th, it's gone. And then also no action required as well. All accounts that are restricted should just be reopened. And then if you do more than 3 day trades on June 4th, for example, you will not be restricted the next day or anything like that. Should we all dress up or something like that? See, I don't know like how we can dress up for PDT necessarily, but I really want to. It's a big day.
Yeah, we can think on it. We've got a week and a couple of days here. We'll figure something out. Someone in the YouTube chat asking us to be more specific about call skew. So if we pop over to the platform real quick, skew is just where the options are priced higher than the equidistant counterpart. So SPX is at 75.36. If you look at 74.35, 100 points out of the money to the downside, and then 76.35 to the upside, you can see the value of the put is trading at $11. The value of the call is trading at $6.50. So plenty of put skew. This is a 3-day cycle I'm looking at. And this is how the market is typically priced, where you have put skew in the S&P 500, where the put that is 100 points out of the money is trading at a higher value than the call trading 100 points out of the money.
Yeah, and typically like close to double is about where it is. And then the reason the puts are more skewed than the calls, like the reason they're higher value as a hedging vehicle, is because, the velocity of the move is typically always to the downside. So people are, they're willing to pay more for that risk to protect the risk to the downside rather than paying more for the risk of the upside move.
Indeed. And
you could see this when you look at the deltas more so too, right? Yeah. Once you get out on those tails, you see that in terms of implieds.
Yeah, like the delta for that same put like 100 points out will be higher than the delta of the call as well.
Indeed. And then you see, so Micron's a good example, up 18% right now. Sorry, 135 points. If you look 100 points out of the money in Micron, I just have the 23-day pulled up here, but the 980 call, stock's at 880. 980 call, 100 points out of the money to the upside, is trading for $5,100. The 780 put, 100 points to the downside, is only trading for $3,650. So the call skew is in Micron currently because the velocity of the move has been to the upside. And that's what you typically see in high-flying tech stocks that are just mooning. You see it in crypto. You see it in volatility products after you see a big move. But what I was saying earlier in SPX is if you go to the end of this year, you see a slightly different story if you go 100 points out of the money or 200 points out of the money, because you see a lot of premium on the call side, which is pricing in the interest rates for 205 days. So if you go to 74,
and then also like positive drift as well.
Yeah. So yeah, the risk-free rate of return, positive drift, all these things play a role on the call side, and even the at-the-money calls. The at-the-money calls are trading for 45 grand. The at-the-money puts are trading for 31 grand.
Yeah, and you'll see like the 50 delta will actually be higher than like what the at-the-money strike is as well. Because and just to explain positive drift for anyone that's not sure about what that is, positive drift just means that the market's likely to go higher, at least based on the prices that we're seeing in the options market.
Mm-hmm. Yeah. So the SPX is trading at 75.37. If you look at the 76.25 call, trading for 40 grand. The 74.25 put is trading for 28 grand. So you can find options that are priced higher on the upside relative to equidistant out of the money options to the downside, but it's kind of a mirage or an illusion in the sense that it's pricing in other things relative to just the price movement. Like Micron doesn't reflect direct interest rates, and it's really just the upside move that we're seeing here, which is why you're seeing call skew to the upside. So hopefully that is helpful.
Well, I think you have other factors too, where it's like, as Q alluded to, markets don't crash up, they crash down. And when you do have high volatility or you have some premiums on the upside, quite often you see call overwrite strategies. So if we were to get to a point where, those upside call options are relatively expensive, most investors are long the underlying asset. Now you have an opportunity to generate a little bit of additional yield and sell the calls up there. And so that's going to dampen any kind of situation where, certainly in an index, you see this pronounced skew on the upside.
Yeah, and then that sort of ties into like the high options volume as well. Some people look for like the high call volume or things like that. You don't necessarily know that person's direction based on like the high call volume, just because let's say they buy a bunch of out of the money calls, they could be short the stock, and they're looking to protect their short stock, right? So it sort of all depends. Obviously they're buying it because they think it might go up, right, to protect that short position, but you don't necessarily know the overall direction of that position.
Indeed. And that's why I don't ever think of, if I'm selling a call, someone else on the other side is buying a call and they're bullish. To your point, they could be just hedging their short shares that they have, which is not a bullish situation.
Yeah, or they could be hedging a short call further out in time as well, right? So you don't really know.
You just never know. Some people saying we should wear tuxedos next Thursday. Feels like a lot for a Thursday, but
it's a big Thursday.
It's a big day.
I mean, we'll see. I'll wear something fun for sure. What it will be, I do not know. But maybe I'll come in a suit or something like that. It could be fun.
Yeah.
We should light off fireworks in the studio.
We can do a lot of things in here. It is isolated from the rest of the office.
You know where they were lighting fireworks last night? Madison Square Garden, baby. Because the Knicks.
Are you a Knicks fan?
Oh yeah, because the Knicks are going to the NBA championship. That is crazy, actually, to think. That is not. I mean, swept the Cavs. Oh no. It's gonna. So we need the Spurs to win though in the Western Conference.
Why do you say that?
Because we've beaten them during the regular season, so we can beat them in the playoffs too. If the Thunder win, we get smoked most likely.
Really?
But the Spurs win, I want Wembanyama. Have you ever seen you probably haven't, but on TikTok there's these videos that will come up of like people getting interviewed at Madison Square Garden. They're all just like yelling crazy things like into the mic. It's hilarious and I love it. They're like, oh, like I mean, a lot of expletives, so I can't really say them and stuff like that. But they're just like, go New York, you know? And it's a very exciting time to be a New Yorker for sure.
Yeah. I can't wait for that series, whoever it is, but the sweep certainly helps you get some rest.
Yeah, because they need it for sure.
Yeah. Well, I think we can just get out of here. What say you? 9:51. Markets are just stalling, up 62.5. NASDAQ up 530. Bitcoin and ETH up. Bitcoin's up 1,200 now. ETH up 50 points. Micron up 130 points, 17.5%. Just a typical Tuesday here for Micron, but just insanity. They have earnings late June, June 24th-ish, somewhere around there. Now a 200-point implied move in that cycle for the June 26th cycle. So that's going to be an earnings announcement to watch for sure. Or maybe not. Maybe he pulls in NVIDIA and just doesn't move after earnings. NVIDIA only up 2 points right now. But
the Dow underperforming here on a relative basis.
Yeah.
Is this a pairs trade setup, Mike? After the research earlier today.
A little long Dow, short E-minis.
Yeah, I wonder
that.
what component of the Dow is massively underperforming here, given that it's flat. Well, the NASDAQ's up about, well, not quite 2%, but close to it.
Yeah, let's see. It's got to be, I guess, IBM, Cisco, Johnson & Johnson, Home Depot, Amazon. Yeah, you get some decent movement to the downside with not too much offsetting upside movement. But yeah, I think that's it for us. I think we can kick it out of here. But thank you so much for tuning in this fine morning. Loved the activity in the YouTube chat. Keep it going.
Wait, are we streaming on Twitch? We need to get streaming on Twitch.
Yeah, I don't think we're there yet, but soon.
We need to do that for sure.
It's not a bad idea. It's not a bad idea. We should be.
I've been saying that for a long time. We need to get on. We need to get on all the platforms.
Yeah, I agree.
Imagine the Twitch chat.
Oh, I mean,
that would be the craziest thing of all time.
Yeah, it would be absolutely nuts. But hey, that's what we're here for, right? This market's crazy. We got to do crazy stuff. Well, thank you, Ryan, for joining me.
Thank you. Thanks for having me.
It's been great. But yeah, we've got plenty more content coming your way. Thank you, Q, for the update.
Always a pleasure.
Can't wait for next Thursday. Stay tuned, though. Liz and Jenny are coming up shortly in just about 5, 6, 7 minutes here. So stay tuned on the YouTube channel as well as tastylive.com. And we'll catch you later. Peace.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Clip thy waxen wings, thou economic Icarus. Discard these feathery adornments, thy flight's too vigorous. Rather, garb thyself with the soft fur of the bear, and dwell in low burrows of the valley fair. Forsake thy previous highs and perilous summit, for lo, I am short, so I must needs thee plummet. O market, I implore thee, make no high. Like some comic Fozzie, unclip thy bow tie. If thou dost tumble, I shall offer thee up a succulent hoagie. So, ye markets, remain as bearish as beloved Yogi. Follow thee the lead of Kipling's Baloo, and may the move be sweet as honey to Winnie the Pooh. With joy I watch descending chart lines straighten, run down with quickness and sweetness, like Lord Walter of Peyton. Let curious traders admire thy Berenstein way, and joyfully stealing some porridge, let us now say, sweet bearish market, never would I cage her, but admire her drop like some terrestrial Ursa Major. Come down, ye markets, to this sylvan glade, and let the bears have their day at Tasty Trade.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80 plus Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
Think you know where vol's gonna go? Test your theories with backtesting. Pick from hundreds of symbols, any strategy you want, and all the data to trade smarter. Tweak the delta, dial the DTE, stack the legs, see what survives. Trade what you want, when you want with Tasty Trade.
everybody, and welcome to the Tuesday edition of the Liz and Jenny Show. My name is Jenny Andrews. That beautiful blonde is Liz Deerking, and it was a fabulous Memorial Day weekend here in Chicago. I don't know, I think you had a great time, but we had beautiful weather.
I think I had a great time too, Jenny. I think I did, because it was party after party after party after party after party on top of a party. It was crazy. So yes, I'm pretty sure I had a good time. From what I remember, a good time was, you were missed. We were at a 50th birthday party with all of our friends. You were very missed.
Oh, well, we had a great time up at the lake, and it was nice because it wasn't so busy because there was rain in the beginning of the weekend, and then it turned amazing. We had amazing weather for the second half of the weekend, and the rain at the beginning of the weekend kind of kept some people away. So
good.
So
keep the riffraff away.
it was good. It was nice, and I met a Tasty Trader.
You give us more sugar. I need more sugar on this.
So I met a Tasty Trader who is up here. Also, you know who's up here and who has a place up here?
Tom?
Steve from Sex and the City, Miranda's husband.
What?
Yes. I was the only one who was excited about this. The rest of my family was like, whatever.
I mean, it took me, you saw my face. This was live on real time. It took me a couple seconds to think back to who the hell Steve was. And now I know who Steve is. Did you see him?
So there were a bunch of people. There were a bunch of people that did see him, and we were at a restaurant. We were at a restaurant, and the restaurant where our name is on the wall is the restaurant where our name is on the wall. And there was some famous bowler on the wall. And my son was like, "Oh my gosh, I can't believe he's been here. I can't believe he's eaten here." And the bartender said, "Oh yeah, well, so-and-so was just here. He's here all the time." The Steve from Sex and the City.
So does the bartender say, "That was Jenny from the Liz and Jenny Show," because there's her name on the wall?
No, he had no idea. But it is kind of fun going to the restaurant where there's the Wall of Fame, and there are a handful of famous people up there. We've got NFL players, we've got famous bowlers. Now we've got Steve from Sex and the City, and Mausch from Chicago Fire, and Liz and Jenny are on the wall.
Well, that was for those of you who've been with us for a while, you remember the story. I don't know if you remember the story, but I walked up, I go, "Hey, what does it take to get Liz and Jenny Show on that wall?" And I think it was $250 in cash. And I gave him $250 in cash, and the girl next to me is like, "Well, you're never going to get your name on the wall, and you just gave away $250 in cash."
And lo and behold, our name is on the wall.
Yep. Lo and behold, there it is.
So anyway, ran into a Tasty Trader. He recognized me from the show, and he was killing it. He is having a better year than I am. All he does is sell every weekly puts. And it was interesting because he doesn't have, like, you have scrolling positions. I have scrolling positions. He doesn't have scrolling positions. Every week he picks 4 or 5, gets into those 4 or 5 underlying, selling cash secured puts. He said cash secured. And just every week in them, and he says if he gets put the stock, then he just sells aggressive covered calls until they're gone, and every week picking some new underlyings.
He's just in the wheel. Let's go through an example of this, because I do like this. And so this is how we talk about this all the time with dividend stocks. This is how I try to get into dividend stocks that I never ever get the dividend for, because I'm aggressively selling puts, then I get put the stock, then I'll aggressively sell calls.
Wait,
so
do you want to rewind? Do you want to rewind, and do you want to do our market movers on the wheel?
I do. Yes. Okay. So the Wheel of Fortune is exactly what we're talking about. This is the market mover segment right now, where the Wheel of Fortune is exactly what we're talking about. You're selling aggressive puts, and then if something, you don't want the stock, but if you get put the stock, then you sell aggressive calls.
Right. And so I met someone over the weekend, and this is what he does every week. Picks 4 or 5 underlyings, sells aggressive puts. And then if he gets put the stock, sells aggressive calls to get out of it. And you can roll them, but if he's talking cash secured. So if he's doing cash secured puts, he doesn't care if he takes the stock. He doesn't care if he turns it into a covered call, because if you're selling aggressive, if you're in cash secured, the buying power doesn't make a difference.
The buying power makes zero difference. And that's an excellent point. Let's go through that. Let's put on an aggressive wheel. Give us an example of something that he used, or you can pick whatever you want.
Okay, he said his best performer last week was Rocket Lab. So let's go into the platform and take a look at Rocket Lab. And we're just going to talk about the wheel, or what many people do with options, using options. And he's using the weeklies.
So I just went into the Rocket Lab chart real quick, Jenny. Now, Rocket Lab in the last 2 weeks has gone from 84 to 143. So when you're selling puts, I'm just being descriptive here, because selling puts is a neutral to bullish. So all these scenarios would work. It would be fine if it was a flat line too, if you're selling puts, but
No,
puts
he wasn't
neutral to bullish.
This is an example he gave me. He wasn't in it the week before. He wasn't in it for that big run in. He just got in last week, and he does weekly. Now, here, with it being Tuesday and a holiday week and only 3 days to go, I almost think we have to go the 10-day. Do you?
You could, but there's a lot of juice here. So if I opened up the 3-day, this is the May 29th. If you go to the at the monies, now if we're being aggressive, you're going to go close to the at the monies. If Rocket Lab is trading 143.45, what if I went to just the 142s, $1 out of the money, and you get $5.50?
Okay, so this is a $143 product. If we're taking in $550, our risk is owning Rocket Lab 100 shares, $5 below our strike. So at around 137. So 137 would be our buy-in price if we had to buy into Rocket Lab. If we don't, if it stays above this 142 strike, we just keep the $560.
Now, this is an interesting one, because no, it's okay. Like, I'm just stating facts. I'm not saying cash secured is the way to go. You actually understand your notional value. Here, when we put this in, this is a margin account. It's using $2,700, $725. In a cash secured account, it would be using $13,000. I can't see that number. There's a comma there. So $13,000 for 500, but that's okay. Especially think about it from this perspective, Jenny. He doesn't have the growing positions. This isn't the risk. You understand your risk when you're in there and you're in one product. If we're just looking at it, this in a bubble.
Right. If he's not managing an overall portfolio with long SPY, long ETFs, long this, long that, he's not worried about a big market correction for his whole overall portfolio. He picks like 4 or 5 products a week, sells cash secured puts for the week, and hopefully at the end of the week, he's out of everything. If he's in, let's say he's in 4 or 5 at the start of the week, at the end, maybe he's still in 1, then he's going to sell aggressive calls until he gets out of it. The risk in a strategy like this is getting long the underlying. So you might not want to do it in a product you wouldn't want to be long, but if he didn't mind getting into Rocket Lab, it's not bad. And this is where last week he said his best performer last week, Rocket Lab weekly puts.
I mean, and that makes sense. That does make sense. Now, this is what I love about options. I love this about options, because once again, he might say, oh, Rocket Lab's in the news, in something, there's lots of stuff going on, but he's not going out there and buying it, because if he's cash secured, he could be using that same amount of capital and buying it, being like, oh, I want unlimited profit potential. The options are a smart man's way to make a bet, right? So even in this example, I don't know if this is his exact example, we've got 3 days left, a possibility of making $520. Right? That actually makes sense.
I'm curious if you go out. Now he said, I want to see if he said he was collecting about $10 a put. So if you're getting $10 a put,
these are the at the monies. They're the at the monies 10 days out.
At the money 10 days out, or if you're going shorter term of the 3-day, he's going slightly in the money and he's playing for a rally. It's almost like the buffer where he's going in the money, playing for a rally, and that's possible. Where he's almost treating it like a synthetic covered call when he gets in, either shorter term, slightly in the money, or longer term.
So I just want, and I'm going to explain. I'm going to visually talk about this, Jenny, just because.
No, I can see. I can see.
Okay, I was going to say you don't have your glasses, but so when you look at this, I'm just going to break down the 2. I'm in the 3-day right now. Remember, like I said, the at the monies and the 10-day were $10. But if I went to the 3-day, I'm bringing it all the way into the 150s. The extrinsic value of the 150s is around 450. So your break even on this trade isn't too far away from where it was on the other trade.
You're right. The other trade we were selling the 142s, and we were getting $5.
Yes.
The 143s, and now if we're selling the 150s, we're still getting almost $5 for over $4 extrinsic value. So the stack could go down $4 and we wouldn't lose. This stack is crazy. Since we started this, it's gone up another $2. It was up $7 when we started this. Now it's up $9. Rocket Lab is really on the move.
So kind of going apples to apples with the in the monies, and if you wanted to be aggressive, this does give you more profit potential. I moved it down to the 148s because then we have over $5 in extrinsic value, which is all we were getting from the other one as well. So if you've got 5 extrinsic value to extrinsic value, I kind of like the in the monies.
Honestly, Liz, so looking at this, and the only reason it's nice to hear what other people are doing. We wouldn't have looked at Rocket Lab this morning if I didn't run into this guy who said he was making, he made all his money, most of his money last week in Rocket Lab puts. I like his idea, but I also wouldn't mind just looking and comparing this to the buffer, because it's similar to the buffer where we're going with an in the money put. But what the buffer does is move our break even. And so we have a little bit more protection.
So I will start from the beginning, and I do like the buffer in the very near term. So the buffer would be buying an at the money put. So I'm going to buy the 144 and sell the, let me see here, I'm going to go 134, right?
So that's that's going to give you $10 in room. $10 in room. That's not bad.
It's not. Now, the only extrinsic value you have to cover is $4. So what you're going to do is you're going to come up.
You can go all the way up to the 152, almost the 152 and a half or 150. I guess the 150.
I'm going to do the 150 just because 150. So this gives you the profit potential here is $583. It's not as much.
No, but it's not bad because it's 500. You're getting over $500, but your break even's down to 134, $10 down.
I actually like this a lot better. I thought your profit potential is the same. Your break even is much farther.
Right.
Even if we sold that 42 for $5, our break even was 37. It gives us an extra $3 in room. And on top of that, Jenny Andrews, it's less capital.
I'm getting into Rocket Lab today.
Can I press the button on this?
Yeah, I'm going to put it on the buffer. Now there's risk here, and our risk is getting long in this buffer trade. And maybe you want to go to the curve view just to show people what this looks like. Where the buffer is, you buy a put spread. And whatever you're paying for that put spread, you're going to sell an in the money put that has the extrinsic value of the cost of that put spread. So I know that might sound confusing.
No, but for our viewers, it isn't. This is this was a very, 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 this was groundbreaking when the ETFs decided to do this, right? So they had buffer ETFs is what they were called. And this is exactly what they were doing. They were having a covered call and they added a put spread down to buffer their losses. And that's exactly what we're doing right here. And in the money put is a synthetic covered call. And we use that put spread to buffer our losses. That's where the buffer trade originated from. It's just that if you understand options, you can break it down where it doesn't sound as crazy, being like, oh, would you be willing? Because this is how they were selling those ETFs. Would you be willing to give up, to cap yourself out at 10% profit and then buffer it down to a certain percentage? And the answer usually is yes.
Yeah, I mean, here in this scenario, this is a very short-term trade. Are you just in the 3-day?
3-day. So
we're in the 3-day. If Rocket Lab keeps going up, and maybe we better push this button because it's gone up $3 since we've been talking about this Rocket Lab. So if Rocket Lab keeps going up, we could keep that $500 credit we're taking in. If it falls down, our break even or our buy-in price is at 134. I think it was 134. So $10 below where it's trading, or $11 below where it's trading.
Yeah. So we've got the 3-day trade on. And here's what I love about what we do, Jenny. Number one, use your option knowledge to kind of tweak the positions. You talk to somebody and you made it your own.
Right. Yeah. He's selling puts in Rocket Lab. They might be slightly in the money with the amount of credit he's been taking in. I thought that maybe the buffer looks like a better trade for us, gives us a little more room in case Rocket Lab falls back down.
It does. And what will we do if we are the proud owners at 137? Sell aggressive calls against it.
We're going to have to sell aggressive calls, but Rocket Lab has a lot of premium, so it should.
Yeah.
We should be all right. All right. So that I like the buffer. I like the buffer in Rocket Lab. Sometimes it works. Sometimes they make sense. Sometimes you're getting, I mean, it's kind of shocking in the 3-day that we got that much room and that much credit.
Well, I like the buffer I don't like it farther out in time. I've said this multiple times. I will have a tendency to use that trade on a product that has earnings that is already up to see if it's going to continue its momentum. If not, you're back down at a lower price point.
And that's,
I don't think it works out that well when you go pretty far out in time. I think you're locked into that position for too long.
I'm curious. So I've been short-term, buying a call spread and selling a put spread, which isn't that much different. You're going to make less money than the buffer, but it's a similar concept.
It's a similar concept, right?
Similar concept.
It is a similar concept. This market can't stop, won't stop, Jenny Andrews. Take a look at this. Suppose I texted you yesterday because I
thought they were up like 70 or something yesterday.
Yeah, they were up 74 yesterday. I got a cup of coffee, went outside. I was going to start doing a couple things before the party started. And I was like, because I opened up my computer and I heard ding, 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 ding. It was 9:00 or whatever. It wasn't at the open.
What were you getting filled on yesterday?
No, the market. You know how the bell rings?
Oh,
but it was like I just opened it up and the bell rang. I was like, oh, I guess things are open. I looked at the SPOOs were up 75 yesterday.
I know I think I was I don't know where I was, on the beach maybe, when Liz is texting me like, look at the market.
You were on the beach at 9 a.m. in 50-degree weather.
Yesterday, 9 a.m., we were probably walking the dogs out on the.
Okay, that makes sense. I was like, oof.
Yeah. No, yesterday was hot. Yesterday was a hot day.
It got warm, but in the morning it was really cold.
Oh, I know where we were at 9 a.m. yesterday, the Bloody Mary party.
This tracks. Okay. That's funny. Okay, but we do have a shortened week right now. We have SPOOs up 46. Now, they're not keeping their wings up. I want to take a look at what VIX is doing. VIX is up.
Market up, VIX is up. But still, it's only 1679. It's not like... one thing I wanted to do, we don't have a Microsoft position. I thought of selling iron condors in Microsoft just because it's one of those things that's not moving. And maybe if we look at the chart, it'll look like it's moved, but it's just
hasn't.
It's been in this range. When the market's rallying, it's not really participating. It's kind of just sitting in this range. And I thought maybe a good time to sell an iron condor in Microsoft.
I don't disagree with you. So let's take a look. What's great about Microsoft is, I'm going to go back to the table page. I want to see if there's no earnings on the horizon. Earnings are gone, 47 rank, $400 product. We have to do an iron condor because it is such a big product. So we have to define our risk on both sides. Now it's choice time though. When you open up these, I'm going to go to regular standard monthly options. I have June 18th or I have July 17th, 23 days or 52 days.
This is tough. I mean, I kind of like the 23-day, but our research would say 52.
Let's see our what we're getting. Let's go to the expected move for both $5 wide. See what we're getting versus what strikes. Deal?
Okay, deal.
Okay. So I'm going to open up the 23-day first, and I'm going to do expected move $5 wide. So I'm going to go 390, 385.
Okay.
And we're getting 78 cents. Then I'm going to go to the top, and I'm going to go 4. I'm just going to go 440, 445.
So that's only, okay, I was going to say you've got to make it $5 wide on top too.
It's 161. It's not bad.
It's not bad. Short strikes are 440 and 390.
Okay, 161.
So we've got $50 in width.
440, 390. Okay, then I'm going to close it, and we're going to go to the 52-day. And I'm going through the same exercise. I'm going to go 380, so we're $10 wide, $10 away, and 450. So you get $10 on both sides for about this.
No, I'm going 23-day, 100%.
I know. Sometimes logic, you're just like, okay. I would rather 160 and 23.
All right. I know the research might say closes to 45-day, but I'd rather go $10 in on either side, get $1.60 in 23 days. Because if it's through it, one of those, or in the middle of it, we can roll it.
I agree. So I'm going 90, 85. And then I'm going 440, 445, 164.
That's not bad.
No, it's not. Lock it, load it, ship it. And we've got an iron condor in Microsoft. Iron condors we will put a GTC in for.
Do you want to hear something funny? So now I'm still not back home, and it's my trick screen. I'm in a hotel. There's a window washer outside my window.
Oh yeah. It was me the other day in my house on the third story.
Oh yeah.
And then after when I came out, he's like, I was trying not to make eye contact. This guy
was laughing, was like flat out laughing as he just went by.
That's awesome. Yeah. That's pretty funny. But you wouldn't have even had to disclose your location except for that window washer.
That's a dangerous job. I'm very high up. Like I'm so high up that my ears popped coming up to my room.
But he has to be like harnessed in, I'm sure, right?
Well, yeah. He's not like scaling the building like Spider-Man.
My guy was just on a 3-foot ladder or 3-story ladder. I was like, he's gonna die. This is job. Crazy. Okay, let's take a look. Is there anything that needs to be managed in our account? Natural gas, we need a pullback. How much time do we have left for natural gas? It's today. Oh, it's just today.
Oh, it's today. Yeah, today. Yeah, and our highest strike is the 2.75. So I think we're out of luck, but we collected a decent amount. And let's put on a new one. Let's get started. Since these are all gonna be gone today, let's get started.
I think we created a monster. It's so fun to do these though.
30-day.
30-day. So now we start with a downside broken wing butterfly where we collect enough that we can butterfly it off. We collected quite a bit on the first one.
I know. That's why I think we need to. I know when you're doing naked options, you start at the expected move. In order to collect enough, we need to really shift it up.
So here you can collect 24 cents. We need to, we need to go like this. So here, I've got our break even to the expected move. I will describe this. So I'm buying 1, 2.
I can see it. I luckily, I mean, maybe my vision's improving because I can see it all.
Okay, good. I'm so worried about you because you don't have the glasses. But for those listening on the radio, I'm buying the 285, selling 2.8, and then buying 2.65. Our risk is $810.
That's not bad. And getting 19 cents or $190 is good. I would like to get at least $180, $190. I don't want to get only like $130 because then we have nothing to work with if we want to butterfly it off.
Yes.
The last time we were all, I think, trying to get close to $200. And that gives us the ability to spend a little money to butterfly it off.
And this is, so I'm going to lock and load this. So I want to get 18 cents for it. We are working that. We'll let it work. This is one of those we can do it again tomorrow if it doesn't get filled.
Right.
Hey, have you seen my shirt?
Okay. It looks great on you, Liz. Looks great on you. I can't remember how many years ago it was that you were really admiring that. So I gave it to you.
You did. You gave it to me for my birthday. I'm going to keep it right next to me at all times, just in case in the studio. Everything you've ever given me is around me right now.
I was wondering if you were still just like in your outfit from yesterday.
I actually forgot to wear this yesterday, so I feel bad, but it's Memorial Day week. And I've got 4th of July coming up.
We had, you should have seen everybody here. So my daughter couldn't believe it. We went to church Saturday night. We went to church. Every single girl in church that was between the ages of 16 and 22, every single one of them had a American flag sweater on. Every single one. And so Lily said, geez, Mom, I must have missed the memo. So she ran out to the mall and bought herself an American flag sweater.
Two parties I went to, every girl there, and they were over 22, had an American flag on. Yeah, but they were T-shirts. So they had tank tops with American flags, T-shirts with American flags. Yeah.
I'll text. This is the hot sweater that whoever was selling this in town really made a killing. But it was, everyone had it on. Everyone. I'll tweet it. And it was a fun Memorial Day weekend.
Yeah, it was a good Memorial Day weekend. Okay, so let's keep looking at our positions while you're about to tweet that. We are taking live tweets, but the hashtag LIZJNY, and maybe I should pop in there to see what we've got going on. So I'm going to do that now while you're posting something in there. Let's go to Twitter. I'm going to go top down. Ooh, but this is Bob 38 minutes ago. He's giving us the earnings for today. Jenny.
Yes. What do we have?
Whoa. Hold on. I've got a very important question for you. We have last call.
Whoa. Forgot about that.
I know. That's what I'm saying. We can look at these earnings in last call. Are you going to be home or are you going to be up there still?
Yeah, no, I'll be back. I'm gonna have to race back to last call.
DS Box, DKS, BBWI, Pinduo, Duo, and Abercrombie and Finch. So we'll take a look at those
in last call
today. So
I refreshed because I sent the so.
Oh, that's so cute.
Yeah, so that's the American flag. Everyone had it on. That's not my son.
I know. That's her boyfriend. He's super cute.
But everyone, we walked in the church and I was like, I'm really out of place here because I did not have this American flag paraphernalia on.
I love that you got it. That sunset looks so beautiful.
Yeah, that's on our deck. And I was actually gonna try to film on the deck, but
you have.
It's quiet now. Everybody's gone.
Yeah, but just in case. You can't have some random.
Just in case the lawnmowers go by.
Yes. That's awesome. And now Eric comes in. Blue Wackadoo. Happy Tuesday / Monday. I legged in and out of SPX Iron Condor for $345. Good. Catching a second call side swing out of the way. Love it.
Nice. Look at that. He's good. Blue Wackadoo.
I know Blue Wackadood's got it going on.
Think about with the one guy that I ran into just selling his puts every week. Then you've got Blue Wackadoo on top of it doing SPX. Like
And Jack Tucker, we know he's
Yeah.
still doing it. He's just too busy to be posting.
Yeah. Okay, Jane, did you get to put the shares of TMC from your YouTube video with Dan? Yeah, I followed you in, and it's great this morning. All right, let's take a look at TMC this morning. What
Did you
it's
get?
doing.
He's asking if you got put the shares.
I have a handful of positions in TMC. I think I have short puts and long shares because it wasn't great always. We've seen some downward momentum for sure because I have gotten put some, but I keep selling puts. So yeah, it's had a little run, 19 cents. I'll take it. I'll take it. But you know what did really well? Whose account am I in? Oh, every time I log into every time I log into an account, it's going into Logan's account, which makes a lot more sense than when I'm
want
looking.
to sell puts in TMC right now? Probably not, right? Because we would be doing him nearer term, and there's not that much juice there. You're selling him for 49 cents.
This was Dan Piazzarelli's. So he had his covered call picks of the year. This was one of them. I don't mind it. The other one has done really well.
Which was what?
Do you remember that one?
OKTA.
No. Oh yeah, but it's not. That's not the one that I'm thinking of.
It's this one.
Although that's he had another one that started with a T.
TMC.
TEC. Try TEC.
It was TMC.
No, that's the one we just looked at.
Oh.
Try TEC.
No. But OKTA was one of his. I do know that, and that was that has to be doing well. But so the person, it was trader Scotty S. If you get put the stock, which you would have here probably, you would have probably gotten put the stock right here, right in this little down move. Then you would be selling calls against it. So Jenny, did you sell calls against your stock?
No, not in TMC.
Why not?
I haven't. I just added more puts. Like if I got put this stock in TMC, it's so low price. I just added more puts.
So
TEM. Thank you, Frank. Frank said TEM. That's the other one.
TEM. So this is 43.
Sorry, I like on my phone trying to look this up.
This looks exactly like TMC.
I don't know.
It's got to be OKTA that's doing very well because you would have been put both of these stocks in TMC and TEM.
What is the other one?
It's TEM.
TMC and TEM.
And OKTA is the one that's doing really well.
Yeah, OKTA.
Yeah.
No, sorry. I'm struggling without my glasses trying to look things up on my phone.
I know. I know. Okay, so I'm gonna go back to Twitter, which we did. Then we go to Bob on Fire. Then Punish Pixels comes in. Ooh, look at this. We got Frank coming in. Good morning, ladies. Hope you had a good long weekend break. Since the market doesn't go down these days, how about a Christmas tree? And he's in ES, I'm sure, right? Buy 1 7550, sell 3 760, and buy 2 7625 calls this Friday.
Okay, so 1 7550 3 7600. Okay, go to ES, and that's this Friday.
Hold on, I'm just gonna pull it up so I can look at his strikes while I'm putting them in because I can do both. Okay, there we go. Now, okay, so this Friday. Hold on,
Go to ES.
I can't type it in yet. Now I can. Okay. Yes. No, this Friday would be
3 days.
3 days. Okay. And he is.
You're going in the money, buying a 75, right? Or no, 7550. Yeah. Buy a call. They're calls.
Buy one. I'm going to look at this. Yeah, hold on. Let me do this. So that's not in the money. That's out of the money. You're buying the 7550 call, selling
7600.
Oops, 3.
And then buy 7625. So you have an extra short here. You're long 2, you're short 3. So you have an extra
No, you don't have an extra short. You're supposed to buy 2.
Okay. So $8. Let's go to the analysis page.
This is not bad. Let's look at this. So
I'm not sure if this is a Christmas tree.
Well, 1 by 3 by 2. I thought it was 1 by 2 by 3.
I don't.
But either way, we'll call it a Christmas tree if you want to, Punch Pixels.
I'd like to go to the analysis page and see. Maybe when we take a look at it looks like we'll say, oh yeah, this really does look like a Christmas tree.
No, I don't think they look like a Christmas tree. I'm going to zoom out on this so we can see it. There we go.
Okay, so because I see his point because the market keeps going up. You're paying for this, but it's only half, right? If we're paying $760, we're paying half, $390.
Your max loss is $385. Yeah, it's $380. It keeps jumping around. So if you're paying $760, your buying power effect is higher, but your max loss is only $400. If the market continues to go up to the 7,600 level, you stand to gain a lot more.
Yeah, and then what's your max loss on the upside?
The max loss on the upside is the 390. Your max loss on both sides is the 390.
I don't mind it. I mean, Punish Pixels. He's been on fire.
I'm working it. We're working.
I think we did it right. Go back to X and see if we've got.
No, I've got it up right now. It's buy 1 77550, which we have in there. Sell 3 7600, which is right there, and buy 2 7625. I've got it on my other screen above it, just so I can make sure.
Yeah, I don't mind it.
When I didn't like it, Punish Pixels, when I put it in wrong, and it was 1 by 3 by 1 because it was $19,000.
Yeah, I thought we need to have for this account. We definitely need to have equal amount of longs as shorts. We can't have an short.
Yeah. So that's fun. We've got that in. That's a bullish trade. So if we lose on it, we lose on it. It's not the end of the world, right? Like it's a very, what I like, what Punish Pixels has set up is a risk reward scenario where you can make a lot more than you're risking.
I like it. And if the market turns around and falls out of bed, we've got only $370 at risk. That's not terrible.
Yeah. So
but to his point, if you look at the chart of the market, it just seems to keep going up.
Oh, it totally does. It keeps going up. But this is what's killing me today because, my little guy, who's not a little guy, he's a huge guy, put in the trade this morning and he's at let me tell you where he's at. He's at, this is his.
Oh, he's fine.
Oh, no, he's only $5 wide. I know, but that 7,500 level seems to be a gravitational pull.
Where were Spoos on the open or at 9 a.m. when he put it on?
They were up 59. They were up 59 when he put it on. And I was kind of like, okay. But he's a bot when he does it. And I like it.
Yeah. This is how you learn by doing it yourself, right?
Yeah.
And watching it and seeing it and
yeah, for sure.
I was telling my kids all about JD. I was telling everyone over the weekend about JD and JD's strategy. And Lily cannot wait to turn 18 and get her account. She's very jealous that Annabelle's got her trading account up and running.
I know, and we're starting next week. So this Thursday, Jenny and I are on the live show because Nick and Tony are out of time. So Annabelle's going to join us. And then we're starting our Where Do I Start? I'm going to ask what they think of names. What do you guys think of Trade Like a Mother?
Because I like that, Trade Like a Mother. I do.
Trade Like a Mother. So we're gonna do a Where Do I Start? And I'm very excited for her. But I'm gonna say this again live on air, and I'll tell about where we're coming from. But I'm gonna simultaneously teach her the basics, which is we're doing the Where Do I Start? At the same time, she's going to have that SPX trade in daily and not understand it until her knowledge gets up to it. Because JD, like I said, I've got 2 different children, and JD needed the instant gratification. He knows how to put it. He still doesn't know what it is or why it's making money, right? Annabelle's going to learn the basics. At the same time, she's going to have that in, and hopefully the knowledge will get her from point A to point B.
I think the Where Do I Start with Annabelle is going to be great. We've had some Where Do I Start shows that have been really great. And the ones that have been great are where people don't know, they don't really know much coming in, and you're teaching them. And then the new viewers, new traders can watch and learn at the same rate.
Yeah.
The Where Do I Starts that in my mind have not been great is where people have come in already with a big knowledge base of options. And then it's not really a true Where Do I Start?
Oh, like the one we did with Nick Catone, where he came in and knew everything.
Yeah, he knew everything. He knew everything. So we were never really teaching him slowly for viewers to watch and learn.
Yeah.
But I think with Annabelle, it's going to be great because she, what does Annabelle know? She knows how to quote the VIX. She knows a handful of things, but she hasn't been an active option trader because she just turned 18. So,
well, and what I love about it is I'm taking somebody who's a better teacher than me. I'm not a good teacher. I've said this a million times. I'm the world's worst teacher, but I can teach you how to implement. So we're springboarding after Dr. Jim's Where Do I Start, where she's going to watch a Where Do I Start? And then we're going to actively do what he did in there. I'm going to show her the how of what he just did.
I love it.
It's going to be pretty impressive because it's going to slow me down. And he starts from literally what is a stock? So that's why I'm excited for it, because this is basics, like literally basics 101. But we're simultaneously, and that's my whole goal, I'm simultaneously going to be having that SPX trade in for her. She's going to do it exactly like her brother does every day. And so you'll see that tally go as well with the where do I start, like learning the basics. So
I think it's great. So many people are trying to learn options, and that's probably what I'll have Lily learn. I'll just have her watch your segment.
Yeah, but Lily wants to be an attorney.
Well, she could learn how to trade too. She could learn how to trade too.
She could. Okay, let's go to one of my favorite things that we look at the SIBO's most active list. Oh wait, no. I remiss. I gotta go to this. Is that a pig?
It looks like it. Is that Mike? That's Frank.
It's Frank. Frank with a pig roast. Huh. Who knew?
Although I think a pig would be bigger, but I don't know.
I don't know what that is. I don't know.
I don't know, Frank.
More sugar. We need more information.
No, I think it probably is, but it looks small.
Maybe it's a pig. Maybe it's a small pig.
But maybe that's such a big grill, and that's why it looks. I don't know, Frank. But that was Frank's Memorial Day barbecue up in Rhinelander.
That's it. Barbecues all around. I can't believe Bob on Fire didn't send us his barbecue. Okay, no, D-Bot comes in, and then we'll go to the SIBO's most active. I'm keeping an eye on the time. What about covered calls on June MES? We just did an MES, and a covered put in September MES. So we're filled in ES. Given theta and risk in the underlying movement efficiently neutralized, given limited differences between June and September. Wait.
So if you're doing a covered call in June, you think we're going to keep going up now, and then if you're doing so that would win short term if we keep going up. The covered put in July would be losing. Then you'd really need a big. It's one's battling the other. One would lose if we go up now, but then we'd really need a big down move for the covered put to come back in. Or you're just collecting premium of that short call and short put.
Hold on. I want to do something real quick. So if you're doing. I'm just going to go June 18th. I don't know what a strikes were. But if you're doing a synthetic covered call, hold on. Synthetic covered call is this.
And selling in the money put.
And synthetic covered put is this, right? I'm just grabbing strikes. So you're technically selling two in the monies, but you're calendarizing it.
But I think you're...
Right? That would be exactly what you're doing. You're two in the monies. You're selling an in the money strangle, but calendarizing it.
But this isn't much different than just what you're playing for. I think here is just that premium. So is it much different than just selling that strangle? It's just selling the out of the monies.
Well, yeah, you're just doing the out of the monies, but you're calendarizing it. So he wants the covered call in the short term, right? So no, but you do have the problem with that is you do have. I like what he's saying, because if you just sell the premium of this and you don't do the stock with it, I guess you could have the stock with it. But I'm just saying you do have risk to the upside if you're just doing it for the premium, because you're buying the stock and selling the stock, right? Covered. If you're doing a covered put and a covered stock, you're buying the stock and selling the stock. So those net each other out.
Well, I was going to say you don't have it anymore. If you're like if you're buying a future and selling a future,
you don't have
it anymore. You don't have it anymore.
Unless they're two separate futures, which I think they might be.
But again, synthetically, and in the money short put is a synthetic covered call. In the money short call is this. So you've got both. They're kind of battling each other. It as much as it's undefined risk, definitely.
You might have broken our brains here.
You can't have a covered call and a covered put because
you can't, because they'll wash each other out. If you truly have a covered call and covered put, you just have, to Jenny's point, then you just have the strangle, because that's all you have is the extrinsic value. But you're using the out of the monies for no real reason.
I don't know. It's a little confusing, Diba.
I know. All right, let's go back, and I do want to get to see what's most active, because I found one on here that was kind of crazy. I'm gonna refresh.
But I liked his picture. I liked his Twitter.
Oh my God, I know, it's so cute. SPX is the number one in calls for today.
And I want to say he's not getting rid of it. Like he can buy one future. Like if he's buying one future, so he's right. He can buy the June future and sell the June call against it, and then he could sell the July future and sell the July put against it. So
that's what I looked at to see if there were two different ones. But look at this, the June. Oh yeah, there you go. They're two different. I just glanced and saw. I was like, "There's no way." So they are different. You can hold
like
this.
if you type in if you try to buy ESM, but then if you type in, what's the next one? ESU. Can you type in ESU?
Yeah.
So then for the other one, he'd be selling ESU. Is it not available yet? Maybe it's not.
No, but you can use but what you can do is use the options. Right? So you can use the synthetic versions of it. So in this situation, he was bullish for the long term or for the short term, right? So regular
Covered
June.
call in June.
So regular June, I'm just going to go with this one. Covered call. So I'm going to go 7,700. And then he was doing a covered.
Whoa. You got to sell it.
Oh, yeah, never mind. So sell that. And then the covered put was in July, which would be.
Yeah.
No, this has to be deleted.
It doesn't matter. I thought if he was really doing the covered call and covered put used in the future, if he, bought the June future and sold the July future.
You can. You just can't go with the 23 day. You have to go with the AM settlement because this goes from M to U right here. And then here I can go to then I can go to anywhere in July because it's U. So then I'm going to go to July 17th and I'm going to do the covered put, which would be the in the money. So that's exactly what it would be doing.
Yeah. But I think this trade has a lot of risk.
I mean, I like it. I get what he's thinking. There's a lot of extrinsic value there. And if your assumption comes
there is a lot of
fruition, you
extrinsic
make a lot of money.
value. Do you think there's a lot of risk? I don't
No,
know.
there is a lot
Let
of
us know. Eba, let us know how it
Yeah,
goes.
keep us, honestly, I like it. I like looking at things like this. Keep us posted. I want to see how this goes.
Yeah.
But I did want to go back to this because when I was glancing this morning, I saw that EWY was on there in the 250 strike. Now, I always do like to look at SPX, and the dailies for the calls are the 75.50.
Okay.
75.50 is the number one. Let's take a look.
Then
at
that's
that.
just out of the money? Yeah, that's just out of the money, right?
The
75.50. So
no, it's not. It's not just out of the money. 75.50 is all the way up here.
That's kind of crazy.
Well, this is what we've seen all the time. You see this during our show for like $1 something. And then sometimes it's back up there. Now, this would mean we're going to close almost where we opened today. Let me see where our open was.
Or they just think we're going to get a rally, and if they buy it for $1, they sell it for $2.
Yeah.
Right?
Yeah.
Like, who knows what their plan is? But they might think we're going to keep rallying throughout the day and buy it for $1 and sell it for double. But the EWY is interesting to me. I
thought that was interesting. EWY, December 18th, 250 call. So let's take a look.
But when you go into EWY, let me take a look at the chart before we look at the December call. 250 call in December.
Mm-hmm. Is this Chris Vecchio? No,
that's expensive.
That's expensive. Do you think somebody's selling this? Well, no, hold on. The open interest is only 1.3. I was thinking they could have been getting out of it.
Yeah. Well, why does it show no volume today?
I don't know.
Maybe it's the end of the year. Maybe it's the December end of year. That's December 31st.
December 18th. 20.
Oh, but see, it says 2 EY. Like this could be some kind of cross.
Yeah, it probably could be.
2 EY.
I just thought that was kind of crazy that was on there. Here we got VIX, July 22, the 60 call.
What?
NVIDIA, 217.50. I like to see that.
Anything else good on there?
I do want to look at the VIX, July 22, 60 call.
But there were VIX puts trading too, both sides. I mean, that's crazy town. That could be.
And look, the volume's right there.
That's probably a closing order. There's 130,000 open interest, probably closing.
That's insane.
Maybe closing, I'm guessing.
I mean, I would think so too.
Unless there's some real market move coming.
Okay, now I do, only because I have two screens, I do have to do this for you because you've got questions, we've got answers.
Oh.
That's Frank's barbecue.
Yeah, so that's why it looked kind of small because it's on such a big barbecue. Frank, where are you wheeling that around to?
Do you need a ladder to get in and open that thing to look in there?
Yeah, what the heck? And look at the little tray and table coming off the side of it. Or
I
That's
don't know,
insane.
Frank.
How many people did you throw a party for, Frank? And where was our invite?
This literally looks, he is in northern Wisconsin, but this literally looks like my in-laws' place at the island. The trees look just like that right on the road. Where's the invite? Oh, it's pretty far. Okay. Happy short week, ladies. Market keeps moving, so I was able to form a Twin Peaks in XSP. So Liz, can you please help close the Tokyo tune in Tokyo? Funny. I get it. Yes.
Maybe ask that to translate.
I know it.
Well, good luck, Mikey. Good luck.
Yes, he's funny. Okay, so yeah, but that's great. So he's got no risk. So he could, you want it to hit in one of these spots, but you really have no risk if it goes all the way down to 750.
Yeah. Mikey, bad news. I know I always said I'd take you out on the boat. This weekend sealed the deal. It's gonzo. It's 100% going on the market for sale. 100%.
Oh, it is?
I went to my dock. I went to the dock, and the dock there were geese all over and goose poop all over the dock. And that was the final breaking point.
That's what launched you over the edge. But I do love you, Jenny, but you're like, I'm keeping the boat, I'm selling the boat, I'm keeping the boat, I'm selling the boat, I'm keeping the boat, I'm selling the boat. Right now, we're selling the boat.
This weekend solidified it. The goose poop all over the dock and the geese all over the dock.
Why did you guys go there?
Because I told the guy to put the boat in the water. So we were going to the dock to get it set up with the bumpers and stuff. And when I got there, the dock was such a mess, needed so much work. And I said to the kids, I said, hey, you guys have to clean this dock and set up the bumpers. And everyone stared at me like I had 3 heads. Nobody wanted to do it.
So then you're selling it? I thought they took care of your dock.
Who? The marina?
Yeah.
You would think so.
They don't?
Well, I mean, from my experience, once my boat's at the dock and I'm cleaning the cobwebs. I'm cleaning. People might think it's a luxury to have a boat. No, there's spider webs. There's goose poop. There's bird poop. There is the spider webs are insane. They get all over the boat.
You're really selling this to boat owners.
If anyone wants to buy it, email me.
She almost traded it for landscaping one day.
The dock becomes, think about it, like on the water there's tons of spiders, bugs, birds.
Yeah.
It's not a glamorous life.
No, unless you have somebody taking care of it. You need to upgrade to somebody.
There's nobody there to take care of it.
Yeah, that's my brother. And when he was in Marco Island, has the best thing going. He's like, I'm going to be there in 20 minutes, clean up the boat, fill it with ice, and we'll pick it up. And then he just gets out and the driver drives it away.
Yeah, I don't have that. Look, I don't have that.
They don't have that. They might not have that service in Michigan City. But yes, thank you very much, guys. I'm going to go back. I still love those sweatshirts. I'm going to go back into our platform. We did get filled, Jenny, on
the ES.
Yes.
Okay, good.
We got filled in the ES. So that's a bullish trade. We're pulling for 7,600. Now we currently want 7,600.
And it's the end of the week.
Yeah, in 3 days.
Which isn't that far away. It's 70 points to move up.
Yeah, correct. We are still working the natural gas. We could put it in again tomorrow. This would be better for us if we get a down move in natural gas.
Yeah, we need a little down move.
Yeah.
Anything else?
American Airlines. Yeah, we have 75% profit. We have just a short put in the 23 days.
$1 today. Can you believe it's up $1 today?
Well, oil has come down. I think that was what it was coming from, right? CL.
I know. So oil's down, but oil's still in the 90s. American Airlines is back. It's back. I think at this point, I might get out of all my American Airlines. If you look at the chart, back to the 15 handle is pretty high. Yeah.
Oh, yeah. I think I got out of it around here.
I definitely lightened up. I lightened up my American Airlines position, and today's going to be the final day for American Airlines. Keep going.
What does it mean when your nose itches? Does it mean somebody's talking about you?
I think so.
My nose is so itchy right now.
It's Mikey talking about you, how he needs you to do your Genie Blink and get SPX to end up in one of the middle of his butterflies.
I did it. Okay. So we're out of AAL. That's a good one. Let's take a look if anything else. I'm just gonna sort by P&L open. There we go. Carnival Cruise Line, we sold that 6 days ago.
That was so cheap.
Yeah.
I don't know. You could take it off if you want, or we can go for 50%. Doesn't matter.
50% in.
Yeah, we don't need the 29 cents. If anything, you'd have to go to July.
No, the rest of these don't look like they're anything.
Open up that CRWV again. What I find shocking in CRWV is that there are only 20 something days left. That's the 75 put. We're so far away, trading 108, and we're only at 33%.
Yeah, that is keeping its wings up.
Yeah.
That's going to get a 50%, and that 50% could hit soon.
And Circle, we've got 30%. We have a lot of a lot of these positions we could actually close June and move to July, especially with some of these naked
Well,
puts.
we could do those. We have 23 days. This is something that we could save for Thursday's show. You know what I mean? Because we don't have a show Thursday.
No, we don't have a show. Tomorrow we're at the SIBO.
We have the trades from the research team that we could manage our account in, and that's exactly what we should do on Thursday.
Yeah, Thursday we're doing the morning show, and then Friday we have a regular show.
Yes, Friday we have a regular show. So it is going to be a busy week. It's going to be a very busy
Take a look at Rivian. What's Rivian doing today? 30 cents. It's a nice little move.
Yeah, that's not bad.
No.
And we've got 2 puts in. Those are still in the money. You know
what are all the semis doing today?
They were up, but now they're not. Let me see. I'll look at Smash because that's our best up.
Yeah.
Do we have Smash still? We're not out of it yet, are we?
It's up. So who's up today? AMD, Intel, what ones?
Intel was up and then was down. And back up again.
Up a little bit.
This is the stock that won't stop. Check out this. It's only up $6. This morning it was up 10.
Marvel up to 202. Look at the chart.
It's
been
crazy.
on fire. On fire.
Yeah, this got as high as 217.
That's crazy.
Yeah. It is bonkers. It is absolute bonkers. Okay, but while we've got the time here, Jenny, and it's we've got 3 minutes left, do you want to put on our downside ratio spread trade in the SPX?
I kind of think I almost think we save it for tomorrow because you're doing it in tomorrow's.
Oh, I'm doing it in tomorrow's. That's what I was going to say.
Sure.
You get 65 cents. It gets our break even outside the expected move. This is kind of a little bit of a hedge, saying that if it pops down to its expected move, we might be able to make something. These have been pretty good. You do them. You can usually do them at the end of the day, or we could do it in last call.
Because tomorrow we are in the SPX pit. We're going to need we need a handful of SPX trades to do tomorrow.
So we'll do that tomorrow.
If we put tomorrow's on today during our show, that won't be coming off.
Is Jacob in town?
I have. It's weird this holiday week, and it's kind of the end of. We've got a lot of people out on vacation. A
lot of people out on vacation.
Out on vacation. Liz, I'm lucky you're here, or I'd be flying solo all week.
Well, buckle up, because I was just going over my vacation days with Dan. You're gonna be flying solo a lot this fall because I've got 2 kids that are going to college, and it's my 25th wedding anniversary. So.
Yeah, I get it. Go ahead.
You might need to get a lineup of people.
I've got some amazing fill-ins that come on. All right, we have 2 minutes to go. Pop out the side. Let's see what we got filled on today.
I think we only got filled in that ES trade. Okay, no, we got Rocket Lab, which is great. I'm going to put, let's keep an eye on that Rocket Lab because that's very, very near term. So Rocket Lab, we're down $127 already.
Well, it was up $10.
Well, that will look like a loss. So in full disclosure, that will look like a loss until we know our break even is 134. We still have $7 to the downside. We really can't lose any money until you hit 134, but it's got to be in 3 days.
Yeah, that is a risky trade because we get long 100 shares of Rocket Lab at 134, but we've got enough buying power if we need to.
Yes.
And if it goes awry, I'm going to find Roy. I'm going to go find Roy on the beaches, on the Lake Michigan beach. I'll go find Roy.
Go find him. The guy from Chicago Fire. What is his name? Mooch? Smooch?
Mooch? Mouch? I don't know. And
that's the guy who I took a picture with in the Orlando airport.
Oh, is it?
Yeah. It's the guy.
And Steve from Sex and the City.
Bring them all together. But here, so we got filled in Rocket Lab, we got filled in our ES. So that both of these are a little bit on the bullish side, and we closed our AAL. So,
and a Kansas City Chiefs football player.
Which one?
Well, so up here are the Allegrettis, Nick Allegretti, who I don't know what team he's on now. He was a Kansas City Chiefs football player. I don't know if he's still on the Kansas City Chiefs. His name's on the wall too, Liz. His name's right by ours.
It is.
Yeah, he's right on the wall.
I love the pictures on the wall. All right, Jenny, we are out of time for the day. Done and dusted. These will get pushed out immediately after the show. I'll do that right now. But we've got filled in AAL, ES, and Rocket Lab. And Jenny and I are going to be taking a look at all of Bob on Fire's earnings trades at last call today.
Yeah, so everyone have a wonderful afternoon. We will see you at last call.
Remember to trade small, trade often.
Laugh with us, learn with us, and watch the Liz and Jenny show.
See you tomorrow. Or see you at last call.
See you at last.
It's option jive.
What's up, Tasty Nation? Welcome back to the show. My name is Mike. I'm here with Ryan Grace, and we've got an options jive for you today. Mastering the pairs trade, a step-by-step guide. Before we get into it, Ryan, do you do pairs trades all too often?
No, I really don't. Maybe I'll start.
Maybe. Yeah, I think it's. It's definitely a way to get involved in markets when there are price extremes and relationship extremes. I think one of the most important things to keep an eye on is just understanding that it has to be done in products that are super highly correlated. But there is a pairs trading feature on the Taste Trade platform, which is really handy if you do go down this route. But before you do, make sure you follow this step-by-step guide, which we'll dive into right now.
Absolutely key that they do have to be correlated.
Oh, it's an absolute requirement because you can't pairs trade these two products if they are just moving in isolation because there's nothing that you can anchor your idea on. And again, they have to be highly correlated.
Yeah, I mean, it's a relative value trade among two correlated assets.
Yeah, like silver, gold, those types of things. But we'll dive in. All right, let's do it. Option 5, mastering the pairs trade step-by-step guide. Pairs trading consists of playing the spread between two correlated markets between SPY and IWM. In this example that we're going to look at on the first slide here, reestablishing the fact that we need to see a super strong correlation because the only way this works is if you see a divergence in two prices that are supposed to be highly correlated and then they converge back to a normal relationship. And if you're not seeing that, if you don't have this super high positive correlation, and I would define super high positive correlation as somewhere in this range between 0.75 and closer to 1, like SPY and the NASDAQ have a really strong correlation. SPY IWM, of course, similar as well. But when you get into other products like gold and silver, like there's also ways you can play those. Yes, there are going to be situations where they're moving in different directions, but you have a general idea of the historical relationship of these products. And when you get these extremes from a divergence standpoint, you can play both sides and play for that convergence. And there's a lot of potential benefits that can play a role when you are doing something like this because you're not taking one-sided risk. You're trading the relationship.
And it might be somewhat difficult to see this on the chart, but right now the 90-day, 3-month correlation between the S&P 500 and the Russell is 0.96. It's going to be above 0.9 the majority of the time. Obviously, they're both equities, U.S. equity indexes. So
yeah, super strong. And again, that is a requirement for pairs trading for sure. So we can pop over to the next slide. We can talk about setting up pairs trades and what we're trying to do. So again, taking advantage of correlated names that have diverged in price, whether it be SPY and IWM, whether it be GLD or SLV, there are opportunities out there. You just have to be able to see them. And also, again, understand that it's got to be between two products that have a long history of having a strong correlation or inverse correlation for that matter. But yeah, that is how this thing can work if you are partaking. increased occurrences during periods of low IV. So sometimes you have situations where markets aren't moving all too much, but you see something like this happen where you see a divergence in a relationship, whether it's to the upside or downside. It doesn't really matter. You're kind of just playing that relationship range. And I like to think of it kind of like the Bollinger Bands we just had on the show, where it's like you have these products that are normally moving together, and then you have this divergence. Maybe you short the one that has moved to the upside, maybe you get long the one that has sold off, and you're playing for that convergence over time. And that's really what pairs trading is.
Yeah, and I think with anything, right, when you have low volatility, that market environment allows you to take more risk, to size up your positions. But when you do see that volatility spike, when all of a sudden the instruments that you're trading, the assets that you're trading become very, very volatile, you typically want to reduce some of your size. That would be the approach I would take, at least. And we see that as well when you have a low IV rank. Okay, you can do a few more contracts here, but just be conscious of the fact that that's not going to stay low forever. And when it does change, you have to readjust and, again, think position sizing, because that's ultimately your risk management approach.
100%. And last but not least, reducing risk by trading a spread. I think it's pretty self-explanatory, but again, you're not taking one-sided risk. You are taking the relationship risk, and if they're moving together, you have this idea of less notional risk at the end of the day. Speaking of notional risk, steps for setting up a pairs trade. First, surprise, surprise, find correlated underlyings that have a recent divergence in price. Find the notional value of each. So I talk about this all the time, notional value. I'm usually talking about earnings trades, like what's the implied move for a stock against its notional. So I like to look at that. 10%, 15%, super high, 5% or less is really low. But when you're dealing with pairs trades, especially two different products like gold and silver, GLD and SLV, these are different priced products. So you can't just do like 100 shares of one and 100 shares of another. You have to realize that these product sizes are completely different. And to equate one to another, you've got to match up the notional value, which we'll walk through in just a little bit. But you also need to adjust the notional value for implied volatility, because to Ryan's point, you have these products that could be low IV and some could be high IV, and you need to notionally adjust the implied volatility for each to, again, you're trying to get as close as possible to a 1-for-1 equation where you're long one, short another, and you're matching or adjusting for the greater or lower implied volatility on one side and greater or lower notional value on the other, so that you can get as close to an apples to apples conversion at the end of the day. Next slide, please. My favorite color, green.
Beautiful slide.
Yeah, beautiful slide. We'd love to see it. But yeah, these are a couple of examples. So again, we've talked about SPY and IWM on the lower left here. The Qs are also going to have a super high correlation to all three of these. But you can also get really high correlation in products that are in the same sector. So JP Morgan, Citigroup, Bank of America on the upper left here, they're all in the 80s. 65, I would say, is kind of on the lower end for a pairs trade, but 75, 80, 90, golden, especially if it's a long-term correlation. 3 months is plenty.
And that's key as well, right? You don't want to look at this as a 5-day correlation or a 15-day correlation. You want to look at this on a 90-day basis. Have some sense of what is it on an annual basis as well.
Indeed. And then in the upper right quadrant here, UAL, American Airlines, Delta Airlines. So the airline sector, again, you have 3 different products that are different airlines, but they all are at the mercy of crude oil prices and at the mercy of the FAA, like all these things. So if you see one product drop and another rally, maybe you are playing the divergence of that relationship. And instead of taking direct risk by just trading one, you're taking a little bit of a softer risk, we'll call it, because you're long one, short another, and you're expecting them to move in the same direction. Next slide, please. So with these different products, all of those products we just talked through have completely different stock prices and different implied volatilities. So we need to find the notional value of each of them to start this pairs trading journey. For stocks and ETFs, calculating the notional value is easy as multiplying the stock price by 100. So the Russell at 279, that's a $27,900 notional value. And the S&P 500 SPY is $740. We're calling it 74K notional. So again, these are two different products that are very different, have very different prices and implied volatilities. So you can't just buy 100 shares or sell 100 shares of each and then expect to have this equated pairs trade on your hands. You've got to adjust. So what does that look like? On the next slide, please. Adjusting for notional value and implied volatility. After adjusting for IV by multiplying by the IV, we have a new notional value that we will use to equate the risk on both sides of the pairs trade. So we are not overweight on one side. And again, you're really just trying to match these up as evenly as possible to really play into the pairs trade itself, right? Because like you could be trading a binary event or something like that, but if you've got an option that's 360 days out, it's very different than trading that really isolated binary event in the 1 day or the weekly. So same story here. We need to adjust for all these things to really match up each side that we're trying to get long or short so that we're not at the mercy of, one stock price moving in the same fashion as the other, but we have way more exposure in one than we do in the other.
And so in this case then, Mike, I'm probably jumping ahead.
It's all right.
We'll wait till the next slide.
All right.
Apologies.
But yeah, taking those stock prices, notional value, multiplying by IV, you've got your new notional figures here. So finding the contract ratio to match the notionals, now that you've got that correlated pair and the IV adjusted notional values for both, we can finally arrive at a ratio for the trade and implement the trade in shares or options on the two stocks. So IWM at 6K, SPY at, let's call it 12K. You've basically got a 2-for-1 type of situation here where you need to adjust and ultimately have more exposure in the Russell than you do in SPY, right? So we pop over to the next slide here. We can see that 52% SPY shares for deltas for every 100 IWM. So I think you can do this calculation and you can really get granular with this type of stuff, but you could also eyeball it, I would say. And even if you're not using straight up static deltas like we're talking about here, you can notionally match spreads too. Like you can do those kind of things where you're selling a 20 delta spread and taking $5 of risk on each of them. And this is kind of how you can get into that sort of notionally matched pairs trade while still adjusting for IV itself. Because if you're using delta, to your point earlier, understanding those core Greeks, the delta will be adjusted for IV already.
Yep.
Next slide, please. So if you've got a 1-to-2 ratio for SPY to IWM, you'll be neutral with the current values relative to implied volatility and relative to notional risk. So if you wanted to be short, you would go short less shares of SPY to IWM. And if you wanted to be long, you would get more long shares of SPY to IWM. As you become more experienced with trading, you can do this calculation quicker in your head to approximate how you should place your pairs trade for your current assumptions. But again, if you're using deltas, like static deltas for share exposure, it's going to be a little bit more of a math situation because you want to make sure that you're notionally adjusted for IV and the notional value of the stock price. But if you're using options, it's a more complex situation, but it's kind of funny. Like you kind of do this yourself. Like you can take, again, you can sell a 5-point wide spread on either side and use a 20 delta option or a 20% probability of in the money. And that will already equate or notionally adjust based on your spread size, but also based on implied volatility in that same regard. Couple of takeaways for you. Pairs trading aims to capitalize on price divergences between correlated assets while reducing directional risk through spread trading. And by adjusting for notional value and implied volatility, traders can size positions appropriately and increase trade frequency in different environments. And if we can pop over real quick to the tastytrade platform, I can show everyone the pairs trading feature here. So I have this super wide. You might not be able to see this, but you will be able to see the trade modes either in a drop-down menu or across like you see here. If you click on pairs trade, there's a couple of cool things here. So gold and silver is going to load probably by default, but if you click on this little booklet here on the left, you can see I've got some pairs here. We've got presets for different stocks. We've got presets for different futures. Some of these are already notionally equated and just by like a rough gauge. So 2 ZN to 1 ZB, 2 silver to 1 gold. And you can see this here, like if I've got this loaded up, you can change the exposure to it, but you can also view this on a chart, which I think is super important here. So just by looking at this gold silver ratio, you can look at a 1 day, a 1 month, a 1 year, and ultimately give yourself an idea of how these things are currently priced relative to each other. So this is actually kind of funny. SPY relative to the Qs, bottom of the barrel, all things considered, with the Qs just ripping higher. So if you wanted to get long SPY, short the Qs, you can see we're actually at a price extreme now, given the recent rally we've seen in the NASDAQ relative to SPY, all things equal with the AI boom and everything like that. So just a couple of quick ones there, but you can mess around with this. You can swap them here. And yeah, it'll ultimately route the pairs trade for you, and you can set certain prices and triggers and what have you.
But again, remember, they must be positively correlated. Gold,
Indeed.
silver, Bitcoin, ETH, IWM, SPY, NASDAQ, S&P 500.
Yeah, this is one of those things where it's like you can't really get too cute with it. It's got to be just products that have a really strong history of being positively correlated, because otherwise you just have two isolated trades, really, at the end of the day. Beautiful. Well, that is that. Hopefully you enjoyed the options jive. Got a little insight into pairs trading, and especially on the Tasty platform, how you can execute it using that pairs trading feature there. But we're going to take a quick break. We'll be back for the opening bell. Wow, already 8:20. Time flies when you're having fun.
It does.
And then we're going to have Chris Vecchio on for Let Me Explain at 8:40. And really, he's just going to explain how the New York Knicks are going to win the championship. And we'll see what he thinks about that. But join us again in just a minute. We'll be back in about 90 seconds. You're listening to Tasty Live. What's up, everyone? Welcome back to the show. We've got some more content for you the rest of the day. We are bringing in Sir Chris Vecchio, the champion of the Eastern Conference himself. How you doing, Chris?
It was a tough game, but I did do it myself last night. Mike, thank you for pointing that out.
Of course.
It's glorious. You know, a week ago, I sat here and was chided by Tony for making a remark saying that I didn't know that Cleveland was still a city. And I stand by that remark. And I thank the New York Knicks for cashing the check that I wrote with my mouth.
Hey, it was a crazy game. I was actually shocked. I didn't think they would get swept, honestly. But then you look at the box score, and like Donovan Mitchell and Harden had 3 total assists the entire game. That's not going to get it done. And that's how you get blown out by 35 points.
Harden looks old, man.
Oh, he's
and
so
I say
bad.
that as someone who's older than him. He looks old.
Did you see the meme of them like shoving each other to the ground in the back halls after the game? So good.
Yeah, I'm enjoying every minute of it.
Yeah.
And you know, people are complaining that the Knicks fans are traveling to Cleveland and they're taking it. Listen, Timothy Chalamet got one of the Kardashians to go out to Cleveland. I mean, like, that's how powerful this team is right now. Okay.
That's powerful.
So it's Mets and the Yankees. It's a divided city. Jets and Giants, they're both loser teams, and it's a divided city. But the Knicks, no one cares about the Nets. So the Knicks can wage economic warfare against the rest of America as a traveling group of fans taking over your arenas. So San Antonio has no idea what's coming. Neither does Oklahoma.
Yeah. It's shaping up to be a wild finals because the Knicks have not gone to the finals since '99, I believe. And then you've got Wemby in San Antonio. That would be a crazy story. And then OKC, they're just a juggernaut, but I think they could be taken down.
None of the Spurs players were alive. Spurs starting five, they didn't exist yet the last time the Knicks were in the finals.
They were just a thought. And now here they are, battling for all of the glory. But yeah, I'm excited for you. Congrats again on the win.
What more could you want? 70, all-time highs in S&P 500 and the Knicks going to the finals. Ilya's going to have a miserable. Here's going to have a miserable day.
Hey, it only happens once every 25 years. We got to give it to you, right?
Thank you. Thank you. Yes. No, but we're the markets here at the start of the week. Volatility, I think volatility compression has to be the thing that stands out the most. In particular, even in the Bitcoin space right now, crypto space, I should say. I know it's rallying hard here, but at 0.2 IVR on the platform right now in Bitcoin futures, that seems really, really low. But also then we're at the start of summer. So I suppose in the spirit of this little segment that we typically do, let me explain. We're now in the summer months, guys. Volumes are going to be lower. Volatility typically dies down. This is the window when markets tend to rally. We don't say sell in May and go away. We say buy through July around these parts because the market typically goes up in June and July. In fact, over the past 10 years, if you bought in May, June, and July, you'd have returned, roughly speaking, 5.2% on the S&P 500. It's been a pretty reliable thing to do. And now we're moving past Iran. What's standing in the way right now? Mike, what are you concerned about here? I know that you're someone who tries to trade in and out of the market a little bit more than I do. I'm more of a directional guy who just, rides that Bronco until it bucks me off. How are you approaching this now that we see a market near highs and the summer conditions arriving with this very low volatility?
It might surprise you, but I'm not too worried at all. I mean, I'm still wearing my permabull hat, and I think the curve of the vol futures really tells the story with the steep contango that we've got between the M, the N, the Q, the U, the V. All of those contracts are in contango. We got the VIX in the mid-teens. To your point, like the summer months are coming here, and if inflation, I think we don't emphasize this enough. Like if inflation's your worry, you have to realize that inflation increases all prices of all things, including assets. So I think we're going to be hitting new highs here unless something changes and something happens to where the vol futures will flatten out, maybe go into backwardation. But until that happens, I'm chopping up and to the right is what I think will happen here.
Yeah, Ryan, I mean, I'm thinking about what happened in 2021 and 22. We knew the inflation was coming in 21. In fact, the inflation did come in 21, and it kept rising through mid-22. And it wasn't until the Fed started hiking rates in 22, the cost of money changed, that the market and risk assets, broadly speaking, started to keel over. And so I think Mike brings up a really good point. If you're worried about higher inflation, you need to do something with your money to keep it, to preserve it for purchasing power purposes. And that incentivizes people that until the actual cost of interest rates moves, people can keep piling into stocks like we did in 2021. If we get the rate hikes, we may have a different problem in our hands. But I know people haven't been paying attention to Bitcoin here right now, but the low vol and this push higher today alongside stocks moving to all-time highs, that feels like maybe we have something to work with there a little bit now. The space feels dead, though. Is that your vibe?
Yeah, it really has been. I mean, you're talking about historical lows in volatility, at least over the last 1 year. Realized implieds are pretty much as low as they've been or that we typically get in there. I mean, Chris, I think it is dead when you can go anywhere else at the moment and have a little bit more fun, make a little bit more money, right? I'm looking at Micron up 12% on the open. The AI trade is pedal to the floor. I think if you're looking at longer term, I want a little bit of this in my portfolio. It does tend to benefit from asset price inflation over time. I think there's real reasons to at least own Bitcoin and some reasons as well, in my opinion, own things like ETH and Solana. This gives you an opportunity to kind of dollar cost average in, try to buy a little bit on some pullbacks here and just put it away. But I would not in any way expect that you're going to all of a sudden see, a massive move higher unless you do get some headline that maybe the rest of the market isn't necessarily focused on or paying attention to. I haven't watched all that closely around some of the headlines related to the strategic reserve, but it's those sorts of headlines that could get you that move. Otherwise, I just think there's way too many other places to go or to play. And for now, crypto is quiet. We'll put it that way. Won't be forever, but less of a reason to own it here. Just given the price action.
I love what you bring up about how Micron is kind of mooning again today, up another 12% right now. It feels like the folks who are trading crypto, probably the speculators, have moved over into the semiconductors for the time being. The AI infrastructure trade is just so hot right now. But we do this series on YouTube, myself and Jamal. Jamal's been taking vacation, so I've been doing it by myself recently. But signal versus noise, where we look at unusual options activity on the tape and try to figure out if there's a bigger story there behind it. And so in that same vein, on Friday, President Trump was here in my congressional district giving a speech to help support the Republican that's up for re-election. And during the speech, which I was listening to, he only mentioned one stock, mentioned Micron.
Wow.
And that little signal versus noise bell in my head went off when, son of a bitch, I can't buy any Micron right now because the market's closed. That thing's going up on Monday. And here we are, 12% later. So, I mean, that is what we're seeing right now. It feels like a lot of retail flow or a lot of retail activity that would have otherwise been helping put wind in crypto sales. They're being stock jockeys right now. How can you blame them?
Yeah, I mean, look, if we do get into, as maybe you alluded to, or you guys were talking about earlier in terms of the inflation dynamic, you move out of this period where, from what I can see, it looks like both growth and inflation are reflecting higher here. But let's say that you see that inflation stick around and growth slows down, you get a little bit more stagflationary environment. I think that's one in which crypto, given the bid into assets and to participate in that inflation dynamic, has historically done well at times, but you need to see that price signal first before you start to believe that the trade is on. That said, the market here at all-time highs, it's not like crypto hasn't moved higher off of its lows. It's just not back at 120. But it went from 60 to almost mid-80. Perfectly correlated for the most part of the last month or so with the rest of the equity market. So it has played along, but it's just not doing those things that I think historically you would expect as a crypto trader or investor you would expect to see. And instead, that's showing up in many other areas of the market.
I mean, I'm continuing to trade it to the long side right now, but it's not the most exciting juice that we have in the market. I mean, Mike, one of the problems that I think a lot of traders have is when a market's sitting up at all-time highs, how do they structure their trades so they don't feel like they're chasing? I find it very difficult to look at volatile. VIX has a sub 17 handle now. And you mentioned the shape of the VIX futures curve, where when you look at 5, 6, 7 points wide from front month to back month, that is a very healthy, just keep buying the dip and let this thing run higher type of attitude. So how do you structure those trades, though? Do you do the short puts up here? It feels like that's ill-conceived. I'd rather reach for maybe long at the money call spreads and see if the market can keep just scratching and clawing its way to the top side.
Yeah, I've been doing kind of a blend of diagonal spreads, calendar spreads. I like the horizontal nature of short option and long option, where you can inventory delta at a lower IV, sell premium at a higher IV in the near term, and then you can actually make money on both of those legs at the same time if you get the timing right. So I'm doing that in single name equities like Microsoft, NVIDIA, silver. I have some positions in. I have a macro position in the micro E-minis. I just bought the dip in crude oil, which kind of acts as a potential hedge there. But I'm also pairing that with SPX trades. So I've been throwing on these bullish single name equity trades that are, between $500 and $1,000, we'll say, in terms of total notional risk. They're almost all diagonal calendar spreads. But then in SPX, I'll put on a neutral iron condor or a downside butterfly. So I like these 100-point wide butterflies to the downside because you can buy them for $400 or $500. And if the market rallies, you can move in your furthest out of the money long put. You can move it up for like $1 or $2 and really give yourself thousands of more dollars of profit potential to the downside if we do get a wipeout in the market. But the interesting thing about these iron condors is that I currently have 3 iron condors on. One of them is 100 points in the money on the call side. Another one is 75 points out of the money on the call side at 7,600, and I have another one at 7,900. So the way I'm approaching this is I'm throwing on these neutral iron condors for like 300, 400 bucks, risking $600 or $700. But if they get the move to the upside, I'm making money on these other single name equities that I'm placing bullish trades on, most likely. And now all of a sudden I have this neutral trade that has turned into a bearish hedge. So my iron condor out in June is a 7,400, 7,420 short call spread that's in the money right now, currently trading for $1,500, the total package. But if we get a 100-point sell-off over the next 22 days, that's a $1,500 hedge back to the portfolio. So it's like I'm creating neutral trades, letting them get tested to the upside and just leaving them, in the sense that if we get a sell-off, I have the ability to hedge any sort of losses on positions that are active that I haven't closed. So long-winded way of saying diagonal and counter spreads to the upside in single name stocks, neutral to bearish trades in SPX, defined risk, and especially the downside butterflies. You put them on for a couple $100, they've got a $9,500 max profit if you pin it perfectly. I'm not trying to do that, but I am trying to just place these trades, especially as the market moves to the upside. Like if I didn't have a butterfly on today already that I placed last week, I would be certainly placing one today into this 50-point rally in SPX.
You mentioned crude oil there. Crude oil to me is been the most reliable thing to trade over the past few months. When it dips below 90, sell some puts around 70, 75. And when it rallies above 100, sell some calls above 110, 120. Today's a good day to reorient ourselves and look to sell some more puts. It's still a 60 IVR, right? And if you see volatility falling off in other markets, the Bitcoin has below 1. Natural gas, I think, still has a 12, 13 IVR. You're not really finding the volatility in the places where it usually exists when it starts to die down in equity. So oil to me is the best place to sell premium right now. Something is going to have to go off the rails with Iran. We've seen this in recent weeks, guys. Just the language that Trump's deployed around talking about the war. Missile strikes are love taps. That's not apocalypse now kind of talk. So he doesn't want to do this. He wants to get out. He's looking for an off ramp. We see it over the weekend. He's talking about the Abraham Accords with the Gulf states, which seems highly unrealistic, but it just goes to show how he really wants to get this over with. So any opportunity still, play ping pong in oil. Oil infrastructure is not coming back online. So you think we're going to get back to 65, 70 oil like we were pre-war anytime soon? And the market still wants to give us risk 3, 4 to make 1 on those trades. We have to take them as long as the sun shines.
Completely agree.
Yeah, I think Ryan's been trading crude oil, selling premium there. I just sold a put in micro crude with the intention, and that's the nice thing about these near-term contracts too, right? Is you can sell the 3-day for $2. If you get tested to the downside, you can roll it to the 21-day and move it 10 points out of the money for a credit. So plenty of implied volatility there. And even with compressing implied volatility rank in crude oil, the actual implied volatility is still very healthy at 75, 80%. So you're getting plenty of bang for your buck there if you're selling premium, but still got to do it in a way that you can manage for sure.
Aside from that, I mean, are you guys going to take Knicks or the Western Conference Finals team in the finals?
I got to go with the
you
Knicks.
And I are. Thank you.
I'm with you.
Thank you.
I'm with you, Chris. All the way.
Thank you.
But I will say, I don't know who's doing that. I will say though, if it's the Spurs,
that's James.
It's definitely
we
James.
know that's James.
If it's the Spurs, Wemby will destroy Cat. So that's the weak link there. Although Cat went off yesterday, I don't think he can do that against Wemby. So that it's got to be a guard
Cat to go off.
Huh?
You know what really, the reason why the Spurs are such a good matchup for Oklahoma, for OKC, is that they don't have a big center that can shoot.
Yeah.
So Wemby can clog the lane.
Yeah.
With Cat out there, Wemby can be drawn out of the lane. And so that allows the cutting from like Bridges and Hard, and it's going to work out. You just watch.
They are the better, more complete team for sure between both of them, especially now with some injuries on OKC front. And if they, like, best case scenario is that goes 7 games and you get guys that are tired and hobbled against a very healthy Knicks team. So congrats on the sweep. That certainly helps you for sure.
I said it last week. Rust is easier to shake off than fatigue, and that's why the Knicks were going to beat the Cavs. So it's happening. It's happening.
Yeah, can't wait. It's going to be amazing. Well, thank you, Chris. Congrats on your win. Go sit in the ice bath. I know you probably have some sore muscles, sore joints after yesterday's win.
No, I was putting together deck furniture and I got my hand stuck, and so I got these 3 blood blisters now in my finger. So I'm going to go pop those.
Perfect. Amazing.
Yeah. Good.
Well, thank you again.
Great.
We're gonna take a little 90-second break. We'll be back with a market measures for you. Should we trade bullish strangles? Strangles. I thought it was said strategies where I said yes. The answer is yes. One slide. But yeah, we'll be back in 90 seconds. Thanks for tuning in. You're listening to Tasty Live. What's up, TC Nation? Welcome back to the show. My name is Mike. I'm here with Ryan. We've got a market measures for you on this fine Tuesday morning. E-minis and NASDAQ catching a bid here. E-minis up 55, NASDAQ up to 440. Bitcoin and ETH catching a bid as well. And Micron is going straight to the moon, up 103 points, up 13%, almost 14% right now. Just an insane move to the upside. And this, I guess, is the new NVIDIA. Who would have thought?
Impressive.
Who would have thought?
Yeah.
Insanity. If you want to join us on the YouTube channel, we're streaming live there. You can throw in trade ideas, questions along the right-hand side chat. We should be able to get to a couple of them over the next hour or so. But first, the market measures of the day. Should we trade bullish strangles? What do you think, Ryan?
Absolutely. Now we're talking about, just to set the stage here, we're talking about presumably strike selection. Yeah. Obviously, a strangle is a short put and a short call, but this is likely looking at keeping that short put a little bit closer to the current stock price when you set this up, giving yourself a little bit more room to the upside.
Yeah.
And giving yourself some positive deltas.
Yeah. I think it is a super viable strategy, especially in indices. ETFs, products that you can manage more easily than an equity. But yeah, I have some strong thoughts on this that I will share at the end. But let's dive right in. Trading bullish strangles. Stock markets keep moving higher despite various global uncertainties. That is true. This strength makes bullish option strategies more appealing, like solid naked puts or covered calls, which profit from upward price movement. As you can see, this is a chart of SPX. Over the years, and I mean, it's nuts. In 2012 we were at 1,000 SPX. Now we're sitting at 7,500. Just crazy gains to the upside. Trading bullish strangles. When examining premium income potential, 30 delta puts typically generate higher premiums compared to 16 delta strangles over extended periods. The premium advantage can potentially lead to better success rates and improved performance during sustained uptrends. So just taking on a little bit more risk in terms of intrinsic value, picking up some more premium by being more aggressive. And a 30 delta put is still pretty significantly out of the money compared to a 16 delta put. But you can ultimately make up for the same amount of premium. And sometimes I say this too, like if you're looking at selling a strangle in a product and you're selling the put for, let's say, $2 and the call for like 50 cents, just get rid of the call and move the put slightly higher. Make up that premium, get rid of the upside risk. And I think that is something that you can do in this situation too. On slide 2, we can show the premium for the 30 delta put relative to the 16 delta strangle. So again, sometimes, and I would say always, if you're selling a strangle, you want to make sure that you have premium on both sides, like meaningful premium on both sides. Otherwise, just move the put up, or if you're bearish, maybe you move the call down, but I don't like selling naked calls personally. But you can make up the premium by just moving the put a little bit higher and removing all risk to the upside there relative to a 16 delta strangle. On the next slide, for those seeking upward participation while maintaining downside hedging, a bullish strangle with net positive delta would be an interesting alternative. how does this adjusted approach compare against traditional delta neutral strangles? Let's find out. We looked at 2 different 45-day SPY strangles over the past 2 decades. So we looked at these 16 delta strangles for your neutral strangle, and then a 30-put 16 delta call strangle with a bullish lean, and closed all positions at 21 days from expiration. The bullish strangles had better returns even though they were a bit more volatile and could lose more money, which makes sense. If you compare a strangle to a straddle, straddles are going to be more volatile, but you're picking up more money, and you can make more just selling straddles because you start with more premium and you can keep more premium if you get the timing right. But put side break even is closer, so market drops have more impact, but the return on capital was better than neutral strangles, and you can see this here. So very similar success rates. When you look at the 1 standard deviation versus 30 delta put, 16 delta call on the right, the annualized return on capital was significantly better. So I'll take that all day. Same success rate with almost twice the annualized return on capital. A little bit less return on capital volatility with the neutral strangle. And the largest loss was just a little bit less than your 30 delta, 16 delta setup. But I think when you think about the product you're trading, right? If you're trading the S&P 500, the more it goes down, the more inclined I am to just stay in and take on those deltas, because we've seen the probabilities of reversals to the upside get substantially higher as you go down 10%, 15%, 20%. On the next slide here, we compare the bullish strangle to just selling 30 delta puts. The strangle made less money and had a lower win rate. The call side reduced the profits, but the strangle was less volatile and had smaller maximum losses. It's a compromise that gives us some upside while controlling risk better than naked puts. So just the 30 delta put relative to the 30 delta put and the short call, success rate was higher. Annualized return on capital was higher because you just don't have to deal with the upside at all in this situation. But this is where I kind of want to add in my own layer of complexity here, because I've had success with 2 separate instances of no upside strangles in IBIT, and then also in the micro E-minis, but we can touch on it at the end of the segment here. But yeah, any thoughts on the difference so far with these setups?
No, I'm not surprised. I mean, we saw the chart at the beginning. I know this study has gone back, over the last 2 decades or so. We're looking at market cap weighted indices. So, the biggest companies just get bigger given the passive flow over time. Of course, there can be periods of volatility. We've had large drawdowns as a result, but not really surprised when the majority of investors and the majority of capital flows are buying assets, and there is that positive upward drift over time. I wish I could add more, Mike, but I think you hit on a great point. You go in here and at times you see high volatility, you see high IVR rank, and you want to put on a neutral strategy or a range-bound strategy that's going to benefit from that. But in doing so, if you just quickly go in there and you look at, okay, I'm going to do a 1 standard deviation move, I'm going to do 16 delta for my strike selection on both sides. Well, there's the skew that typically exists on the put side. So the puts that are that distance away, the same distance as the calls, are going to be a little bit richer in terms of the price. But quite often in these very low vol environments where you grind higher, it's not like there's massive volatility to the upside, at least not in, say, the S&P 500, maybe in individual names like Micron, which we're seeing today. But quite often you're just not selling an option for very much money. Yes, you're going to get a larger credit, but you add that risk as it just grinds up, and you go out there, you go out a month and a half, you go out 2 months, you sell that call. A lot can happen in 2 months. And so I am less prone to sell strangles personally than I am just to sell cash secured puts, naked puts, whatever. Because again, quite often you're just not getting paid to sell that upside risk. And I think as well, we often, I know I do, overlook, well, what is the implied versus realized vol anyways? Is there even much of a premium in there to sell that 40-cent call option that today, with a month and a half to go, is a 1 standard deviation away? But the delta move and the grind higher, even in lower volatility, ends up hurting you. So not surprised.
Yeah. Especially in these super strong markets where it's just like up and to the right every single day. Like you're going to take more heat on having a short call period. And really the only way to get out of that heat is if you do get a sell-off or just a neutral chop to where you can take that premium out. But again, I want to touch on something at the end of this segment real quick. But let's move on to the next slide here. To complete the picture, we also looked at a bearish strangle for comparison. Oh no, we just flipped the deltas from the bullish version to see how it would perform in the same market environment. And I can tell you it's not going to be good. Bearish strangles underperformed both alternatives while showing the lowest volatility among all three approaches. Returns were below expectation. This strategy appears to be better suited for traders holding bearish market assumptions or maybe offsetting deltas. Like there's always, a way that you can make this type of thing work holistically, but not in equities, like not in Micron. You're going to have a real hard time if you're doing this in something like that. But again, doing neutral, slightly bullish, slightly bearish strategies, especially undefined risk, it's a lot easier to manage if you're doing it in an index or an ETF that doesn't move 30%, 40% in a day. Like that's when you can get into the troublesome situations. But at the end of the day, still interesting to see that you had a slightly positive annualized return on capital, likely because during those periods of downside movement and just chopping sideways, you had your ability to make some money there. But lower success rate, significantly lower annualized ROC. And of course, it's going to happen when you have this up and to the right market that we've been trading.
Well, also consider you can get near, or at least historically, you've been able to be closer to it at times, not probably over the 20-year period here because we had a period of zero interest rates. But recently, you can get a 5% or 4% return on capital on your cash position versus like perpetually being kind of betting on the market not going up.
Yeah.
Doesn't mean that it's going to go down, but not going up is tough in my opinion.
100%. Couple of takeaways here. Bullish strangles have positive delta exposure, so they perform much better when markets go up consistently. We get higher returns, but also accept more volatility compared to neutral strangles. And the bullish strangle sits strategically between selling naked puts and neutral strangles. We get solid returns from the put side while having much better downside protection and less overall volatility than naked puts alone. And I would take this one step further. IBIT. I had a year-long strangle. I do a year-long strangle every single year in some kind of product. I did it in DraftKings once. I've done it in IBIT. But my whole strategy with IBIT was I will not take upside risk. So even though I had a strangle on, instead of waiting until 21 days and just accepting the upside risk, I would shift the whole thing up. So like if I was tested on the call side, I would shift the entire strangle up. So my short call being tested turned into my short put being tested. And that really opened my eyes to a situation where you can just manipulate the whole thing. And as long as you're comfortable shifting your deltas higher, and for me, if I'm picking up thousands of dollars of premium over the course of a year, I would still rather have my put be in the money, which is going to reflect a covered call risk profile. I'm doing the same thing in the micro E-minis here this year, where I started with a 6,600, 7,100 strangle at the end of last year. I now have a 7,600 straddle, and it's up $1,600 right now. What's crazy though is I've picked up 534 points of premium, which in SPX terms is $53,000. You could close that trade right now for a net win of 33 grand on one contract into this big rip to the upside. So
and that's through managing your deltas.
Exactly. Yeah. And there is something to be said about having the call on just in case there's a market sell-off. You get the premium out of the call. Even if you're manipulating it higher over and over, you just need one week 5% sell-off and you can buy back that call and just lean along with the short put or manipulate it as you see fit. But yeah, I think this will be a core position that I have going forward, is kind of a blend of this, where I have the bullish lean, but I don't take the upside delta. If my call is getting tested or about to go in the money, I just shift the whole thing up, because especially in a product like the S&P 500, regardless of whether it's an MES or SPX or SPY, you're playing into that up and to the right drift that happens passively over time. You're still collecting more premium by keeping the call on. And even right now, this is still a position where I've made more than 50% of the premium that I've collected this year. And we've already had war sell-off, rebound, like crazy rebound to the upside, but I'm just managing my deltas, never taking on upside risk, shifting the whole thing higher, closing my eyes and just doing it. And it's been a really great trade. So kind of blending everything all in once, but just never taking upside risk in the S&P 500 in a market like this can work out. And it can really help you just offset all of those delta losses that you would have taken if you just let it go.
Absolutely. Yeah, you have to actively manage it. And I want to clear one thing up for Minute Maid in the chat, just asking about what's on the slides here. So in the trading bullish strategy slide 7, I believe, we're looking at the 30 delta put, 16 delta call. So closer there on the put side. And then on the last one, it's just flipped. So you've got the 16 delta put, 30 delta call, and that's the one where we saw a pretty poor return on capital, relatively speaking.
Yep. So yeah, the 1 standard deviation on slide 9 on the left there is just your neutral strangle, 30 delta put, 16 delta call right next to it, and then 16 delta put, 30 delta call. So you're just leaning slightly bullish or bearish in either direction, but if you can take it a step further and just shift your delta and adjust your delta as it moves, you can really get out of harm's way for the most part. You still got to trade small enough to where you can withstand any variance. That's the key here. But yeah, great segment. Love it. We'll take a little 90-second break now, and we will be back with live from the trade desk with the boys, Quentin and Glenn. Can't wait to hear what they have to say. I'm sure they're excited for the PDT rule elimination as well. But you're listening to Tasty Live. We'll be back shortly.
What sparked my interest in trading was the probabilistic nature of it. I used to play poker a lot, still do, and if you understand the math for poker, you realize that it's a probability game, it's a number of occurrences game, and you want to put yourself in good spots the majority of the time and have good risk management. All of these things apply to options trading and trading in general, so that was my initial pull into the trading world. My trading style really revolves around implied volatility analysis. I like to look at specific markets, look at the differences in implied volatility between the weekly cycles and the monthly cycles, see if there's certain strategies that might play into that more than others. My favorite strategy of all time is a short put, simply because it allows you to acquire 100 shares of stock at a lower cost basis. And it's a position you can manage or push forward in time forever if your trade size is small enough.
I've got some huge news for traders everywhere. On June 4th, the pattern day trader rule will be replaced by new intraday margin rules. Tasty Trade has been advocating for an updated PDT rule for years, and we're ready to go on day 1. You'll have more flexibility to manage risk when and how you want. Join Tasty Trade today.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Rise higher, ye Taurian markets, I will thee ride. Oh, let the horned bull now be thy guide. Increase the yield, as the longs have long planned. Be not inert in flowery field like Ferdinand. Reward the longs their bulldog-like persistence. Like Lord Michael of Jordan, soar beyond resistance. Reward those who see upside positivity, as if in some ill-advised Pamplonian activity. Trip thy hooves o'er trading streets most stony, cobbled with the confidence of masters Tom and Tony. Climb with ease the line of Tim Knight's profit chart, and with thy rise make proud Slim's technical heart. Gore the matador of pessimism with thy horn. Let red capes of resistance now be torn. This market yoke to wagon now could pull to follow up the thundering of the bull. In market glory let us be arrayed. Oh, hear this exhortation now from Tasty Trade.
I am a self-taught retail trader. I didn't go to school for finance, and it's not necessary to be successful in this industry. All it takes is a little bit of dedication and a lot of time to learn the lingo and learn the strategies. So standard deviation is basically just the probability of being in the money or out of the money. So one standard deviation with options is going to be probability of 16% being in the money on one side and 16% on the other side. So if you take those two together, you have a 68% range in that spectrum. So that would be one standard deviation. If you just focus on a couple of core key concepts and go from there, it will allow you to educate yourself and propel yourself through the options trading system.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Tasty Trade's Active Trader interface makes futures markets your arena. Built for the bold, not the bored. Trade CME futures with a single click. From micro contracts to major ideas. And go even further with futures options. Tasty Trade lays out multiple ladders and charts for total visibility. Plus, hundreds of built-in indicators for traders who want a broader view. Tasty Trade, pro-level tools, intuitive design, total control.
In road trips, my family, it was like whoever could get the captain seat was it.
That's great. I'm having a great time.
Me too. But, I mean, stay a while. Take your jacket off.
No, I mean, I'll stay, but the jacket's not
Come
coming
on,
off.
take your jacket off.
Nope.
Come on,
No.
take it out.
I'm sorry. I didn't mean to.
No, I'm sorry.
You hopped on this cowboy's horse, so I guess you got to hear his tale. In '87, I took it off. There was the market crash. In '92, NBC canceled Blossom. A couple of years ago, I lost it for 2 days, and the Lakers won the NBA Finals. Bottom line is when this thing comes off, bad things happen.
You've got to take it off sometimes. I mean,
Never do.
how do you shower?
The jacket's kind of gotten used to it. In fact, every few days it needs it.
No matter what, you keep it on.
I can take my shirt off if you want, but I'm not taking the jacket off.
I just don't know if that's something that I could deal with.
It'll be like a teal tornado. Just endlessly washing up on your short.
I mean,
This is moving so fast, and I like it.
Yeah.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Wolf!
The first half of this year's market has been giving the good guys the business.
It's certainly been back and forth for sure, Pete, and I'm getting whiplash over here.
With good mechanics, we can see Team Tasty stay strong in the second half.
Absolutely. Let's check out our starting lineup.
Tony Bat Batista, the John Jay College of Criminal Justice. Number 69, because it's one standard deviation plus one. And you know, I'm the Bat.
John McLaurin, Wisconsin. Number 2, because I'm Beth's right-hand man.
Vanetta Logan, the Indiana University. Number 3, because that's how many shots of bourbon it takes to make it through the first hour.
I like the looks of that lineup.
Well, be mechanical is always better than just trying to run plays and see what sticks, Pete.
When you got skin in the game, you stay in the game.
That's right. Now get off the couch and get into the game.
Watch Tasty Trade.
What is going on, everybody? Welcome back to Risk and Reward. Today's Tuesday. We got another gap up into a new all-time highs. So let us know what you're looking at. Let us know what you're trading, how you're managing your positions. But I hope everybody had a good Memorial Day weekend. I know I went down to walk by the beach. Yes, the beach. Us Chicagoans. And yes, I say us now. I'm a Chicagoan. It was packed up, hundreds, if not thousands of people by North Ave Beach. Just that whole concrete strip kind of beach. But it was a vibe. I hope everybody else enjoyed their time. But with that being said, we can jump straight into the Tasty platform. We got a little bit of a solo day today, so we'll do a little tour to market and just see what the market's been up to lately. Gapping up into a new all-time high definitely wasn't on my bingo card, so we're going to try and manage these positions best as possible. But hope everybody else is doing well. Let us know what you're looking at and let us know what you're trading. But we can jump straight into the Tasty platform over here. See what we got going on. I'm not going to lie. Another all-time highs. It's not my favorite market to be trading. If not, one of my, maybe least favorite markets to be trading, because if you don't already have a position on, you're kind of forced to be sidelined a little bit more or, start scaling out of some of those long positions. So very passive at all-time highs. But we have a few positions on here. We have Meta. We sold the out-of-the-money put spread on Meta. We debated on taking this one off last Friday, but it is nice to have a little bit, long delta sitting in the portfolio at least. So that expires in 23 days. We'll probably see if we even want to keep this one on, come 21 days till expiration. Meta's just been a slow mover. We put this one on. It's nice that we sold the put spread. But it's definitely a slower mover. So you can just see we've pretty much just been consolidating, haven't gone anywhere. So we've been able to benefit from the theta decay on that position at least. So there we go. I guess that's why we'll sell options at the same time. We can make money in two directions, sideways or the directional assumption that we have. What's going on, Ranch? What's going on, Nice Boy? What's going on, guys? How are you guys feeling about this market today? Another all-time high. It's really nice if you have a bunch of long deltas sitting in your portfolio. But if you don't, it can either feel like you're trying to catch a runaway train, and that risk to reward can just feel so awkward and not very satisfying trying to get on some long delta at these levels. Not to mention NASDAQ poking through 30,000 for the first time today. So who knows? Maybe we get a 40,000 NASDAQ by the end of close today, maybe by the end of the week. I don't know. But all-time highs can be just such an awkward position to trade if you don't already have some long delta on at least. So that's how I've been, kind of feeling around all-time highs. But we have a little bit of a meta position on right here. We'll manage in a couple days. We really haven't gone anywhere. You know what I mean? We're up $13 on the overall position. And I think we've had this one on now for maybe about a couple weeks now. So just to show, the lack of volatility we've been getting inside Meta after the massive gap down that we had seen, what was this, April 29th? What's going on, Stan? What are you looking at? What are you trading today? We were just touching on this Meta position. This position has pretty much gone nowhere, but we're benefiting from that theta decay on the overall position. So, we'll take it. We'll take it. This was a long stock position. We might be breaking even exactly on this, or we might even be down a little bit. But we sold the 585s, we sold the 590s, bought the 585. So we got a little bit of room to work with. Also, that's not even including the break even that we could tack on to when we got into this position. So we're going to manage it in a couple days. But Meta has gone nowhere. Not much volatility at all. It's like all the volatility was sucked out of Meta, imported into like INTC, AMD, NVIDIA, all the other underlyings, including NASDAQ. Also, BB looking good. I'll take a look at that Money Mike. Money Mike Dinero. Like, it doesn't get more money than that. That's triple M's. Money Mike Dinero. Got a load. Sold puts with GTC. Close orders 90%. Hoping some close today. Yeah, I hope you get a fill. We got a few hours left. More than likely, you'll get that fill. What's going on, Ranch? This 90-95 short put spread, 23 days till expiration on Circle is my only red trade today. I hear you. That's pretty good, though, if that's your only red trade today, especially, us poking through to another all-time highs, because I think you can be on one side of the spectrum or the other for the most part. Poking through all-time highs, you might be down a little bit from a portfolio perspective, or you might be up quite a bit from a portfolio perspective. And if you're staying delta neutral, you might have to make some adjustments today since we've been really getting those directional moves in the market. But the next position that we have on, we bought a QQQ put, and this one's a little bit annoying because I think we had bought this one last Thursday we bought this one. or was it last Friday? It was towards the later end of last week. And then the market's gapping up into all-time highs. So pretty much everything that we had done for the most part, not all, that we got to do on Friday, some of the positions we got to capitalize on there, which we'll go over here in a minute. We now have to use those profits to finance this QQQ put. So by being patient with some of these trades we executed on last Friday, and again, we'll go over that in a minute, it's a little bit annoying to see, NASDAQ gapping into an all-time high and then kind of eating away of some of those profits that we made at the tail end of last week. So that's kind of how we're positioning QQQ right now. We got 3 days left to expiration. So if this is going to be another cancel crash, you can already throw that one in the garbage for the most part. But I mean, I do hope we get some type of pullback. I mean, how many cancel crashes, how many blow-off tops, can the market really put in? It's been pretty fascinating, to say the least. Very impressive, I will say. Very impressive. And then TLT, got out of this one today. This one was nice. This one helped finance a little bit of this short delta too. One of the first times I think I've traded bonds. So I know Gus and I threw on a TLT position last week. We might be 2 of 5 Gen Zers that just longed some bonds. So anyways, we might have to get this as a reoccurring position in the portfolio. But there was a lot of volatility in there. We ended up doing the zero extrinsic back ratio. Shout out to Liz and Jenny for really pioneering, that trade on the Tasty network for us. But we've had consecutive days to the upside. So never would have thought we'd get this type of volatility out of bonds. Hey, but I'll take it. We're getting a little bit of a pullback on the day, but over the weekend, bonds did gap up pretty aggressively. And we have yet to fill that gap to the downside. So it's looking that the momentum is swinging to the long side on some of these bonds. And if you got any long delta on in there, congrats to you, because that seems to be one of the larger movers outside of the indices over the weekend. What's going on, big deal? This run-up is making me nervous, but I do believe in the long-term space play. Still, everything is moving so fast and no one seems to care about the valuations. No, I hear you 100%. I know those, the space deals have been garnering a ton of attention, especially with, I believe, the IPO for SpaceX coming up here really soon. So I'm really curious how that's going to respond to the rest of the market as well, especially with all this uncertainty that we're kind of in right now. You know what I mean? It's starting to look like risk is being priced into the upside now, getting a little bit of call skew. And that's just letting us know that the velocity or the risk of the velocity of the move is being priced into the upside rather than the downside. And, one thing that we're so used to is seeing and feeling the elevator moves down. But it's seeming like that's flip-flopping a little bit here. We're getting elevator moves straight up, and the market is absolutely pricing that, velocity of risk to the upside right now. And with that being said, we can take a quick look at, the VIX right now and see what the VIX has been up to. And I will say, with the market continuing to make new all-time highs, it is interesting because, number one, in my opinion, it's kind of crazy that we're sitting around a 17 VIX with the market continuing to make a new high. You know what I mean? So again, I wasn't trading prior or around the 2008 financial crisis. I was barely looking at the volatility index come late 2019, early 2020. So whenever we start to get more of these, I don't want to say anomalies, but kind of these more so anomaly type moves, I don't think we put in 4,000 points to the upside in a market every single month like we've seen over the last 60 days. But whenever we see something like this, it's always interesting just to keep an eye on how volatility is responding to all that outside action. So with that being said, VIX sitting at 17 right now. But I won't complain. Again, we've seen slower days on the volatility index than we have, over this week or the last couple months at least. MU, yeah, we'll check out MU, check out BB as well. We'll check out Circle. BB, 41 million shares traded on the day. Wow. BlackBerry trying to make a comeback. I remember one of my first phones was the BlackBerry. I remember my dad had gotten like this new phone plan deal, whatever it might be. And that was around the time my siblings and I were getting a little bit older, into middle school, high school. Needed some type of cellular device to let them know whenever we're off practice or if somebody's going to come and pick us up. So I remember I had gotten my dad's phone. It was one of those BlackBerry Curves. I felt like the man on campus, right? Like what kid had a BlackBerry Curve when they were like, 14, 15? But I got that one passed down to me. So very memorable BlackBerry, but I wouldn't have thought BlackBerry would be making a comeback like it is today. Experiencing a lot of volatility in here. Not sure what some of these option prices look like. We got earnings June 23rd after the bell. The options chain doesn't look very attractive just by looking at it right off of the bat. But nonetheless, if we want to partake something on this, maybe we could do a zebra. But with the rally that it's on right now, we'll probably be hands off. But 852, This thing pulled back and it's still putting in a new high. Yeah, I remember BlackBerry and Nokia. I think a lot of these underlyings were, oh, wow. There we go. We got Nokia all-time highs right now as well. I don't know. Maybe it's just a comeback for the throwback phones. I feel like everything starts to trend nowadays. Like, I don't know if the older generation in the chat right now too is starting to recognize like what was popular for them when they were 15, 16, 17, maybe 20 years old, 25 years old. In terms of like fashion and style is getting popular again with the Gen Z era. So like in that case, it's kind of funny to see things that were trending in other generations start to trend as like mainstream style stuff in our generation. But I don't know, maybe BlackBerry, Nokia is in that same loop because I don't think I was even old enough to have a Nokia phone. And if I do remember, I think it was one of those brick phones, if I'm not mistaken. Somebody could correct me if I'm wrong, but insane run Nokia is going on. Not another underlying that I typically will trade, but we'll keep an eye on it. Again, I will say with my personal bias, I have a very difficult time getting long into a directional move to the upside that has already left the train station. So if I'm not already in those moves, it can be really difficult to, number one, not try and step in front of this train, but also not try and FOMO win because the risk reward doesn't seem to be too favorable. But you can say that one day and then we can be up another 15, 20 points next. So take that with a grain of salt. Nokia had to deal with NVIDIA. Okay. A lot of these companies like Joby, for example, getting that deal with Uber, seeing those smaller companies get some type of deal with these very large, relevant companies today, it's pretty cool to see what they could do on their second turn. So I won't put Nokia out of the race, but I know we saw Joby kind of do something similar with Uber and kind of using their credibility to their advantage. But NVIDIA has been another wild one. I don't think we have had any position on NVIDIA, but I know after the earnings last week, we had a very indecisive move. We had a lot of volatility to the upside, a lot of volatility to the downside, and it's looking like it's starting to play through a little bit more as we make newer lows on NVIDIA. Take a quick look at MU. MU up on the day as well. I mean, it might be maybe there's something we want to get some short delta on. Because we are selling the options, it's not as much of a directional position as something like a futures contract or a stock position would be. So not opposed if one of these are pretty attractive, but 46 million shares traded on Micron today. We got earnings June 24th. That's something to pay attention to. We'll probably hold off on MU because of that. But wow, pricing in tons of volatility into this market. I mean, look at 23 days till expiration. Look at that plus minus move. I mean, 166 points plus or minus over the next 23 days. I mean, that's insane. These are some insane markets, volatile markets. Pretty sure I could pull my old Nokia phone out of the drawer that I left on 30 years ago and the battery will still have like 20% on it. Yeah, I can pull out my brand new iPhone that was fully charged this morning and same, Jared, will probably have 20% on it. Hacky sack, I see that a lot now. I was called a loser 20 plus years ago. And that's the thing. I mean, times are changing. It's so funny. Things that you would be called a loser or a geek for back then is now becoming popular. Not only that, especially in cities like Chicago, cities like New York, cities like LA, especially those cities, niches, from what I've seen, are starting to become, I don't want to say exploited, but more so exploited for attention. Like, I don't know if anybody else has noticed this either, but like having something niche is like the thing. And it's like now the cool thing and you won't be called weird for it. So if anybody had any other niche things that they liked growing up, just know you might be, a little popular. People might gravitate towards you for it because times have changed. Just the social climate has changed too, which is fascinating. BLDP. We'll check that out. BLDP. I can only ever play hacky sack casually. Never could get very competitive with it. No, that's pretty dope. I always thought hacky sack was cool too. The thing is, my dad was born and raised in Jamaica, and soccer is like, or football, right? Soccer is like a religion out there. So growing up, right, he had me in the backyard practicing all the time as a kid, right? You score 2-3 goals, have a hat trick. I don't care. You could have had 4, right? It was one of those situations. But I remember whenever my friends had a hacky sack and I wanted to play with them, or they tried to kick it over to me, he would always come and whisper to me like, no, we don't do hacky sack. Because one thing that he hates is whenever you're juggling, using the side of your foot to keep up a soccer ball is like a big no-no. So hacky sack was one of those, it was one of those moves. You'd use the side of your foot or the outside of your foot to keep up the ball. And that was like one behavior my dad didn't want me to pick up when I was playing soccer. So funny enough, I was never much into hacky sack because of that. But a soccer ball, you know, we could juggle all day. If anybody wants to pop out to Chicago, we could play some soccer. But BLDP, another one, skyrocketing on the day, 11.6 million shares traded on the day, 64.5 IV rank. This one's a little bit of a sleeper build. I mean, we were trading down $1.88. Now we're popping back to $6.18. I'm not going to lie, these cheaper stocks, I don't find them very attractive. I mean, I think the volatility is attractive, but these directional moves can be so uncertain. And I think it's about 80 to 90% of penny stocks eventually go bankrupt and get delisted. So from a trading standpoint and getting long some of these, it can be pretty difficult to do that. You know, you can take advantage of the volatility for sure, but I think it's a different game you're playing when you're trading some of these smaller underlyings. But I used to love them. You know, back in 2020, 2021, my main thing was shorting small cap stocks. So I've just stepped away from those a little bit here, but another one, you know, putting in another all-time high, just absolutely insane. It feels like everything is putting in an all-time high. And it feels like I'm going to use but it feels like we are on the sidelines for some of the most insane moves that the market has ever seen. So it's I don't know, it's a little bittersweet, I would say. You know, not losing money into these new all-time highs is nice. Like the overall portfolio not being down into these all-time highs 6 months into the year is nice, but not capitalizing on that leaves a little bit of a bitter taste in my mouth, at least. I'm not sure how you guys feel about that. But no, with that being said, we'll quickly look through the high options volume watch list. If there's anything else anybody wants to look at, let me know. But we'll take a scan quickly through here before we switch gears. So let's go to the high options volume, and we'll just go from the largest gainers on the day. Yeah, I guess we'll go from here. See if we can find anything else we might want to get a little bit of long delta or short delta on. Make sure you keep playing. Has to be some men's league in the Chicago area. You know what, Stan? I actually seen one of my peers post something on their Instagram story the other day, and they were at the rooftop. They were at the rooftop of like this garage, and it's an entire indoor soccer field that they built, and like the backdrop of the Chicago skyline, or is the backdrop to the field. It's like one of the craziest, most creative things I've ever seen. And then I ended up looking it up. And I believe you can sign up for certain matches, and they kind of do, what is it called? Pickup games and things like that over there. If anybody else knows what I'm talking about, it's in the Chicago area, but the city skyline is the backdrop, and it's on the rooftop of, I believe it's a parking garage. I could barely tell. But if I do go there, I'll have to take some pictures and videos and put that out there so you could check it out. But it was gorgeous. And now that it's summertime, I mean, best time to start playing more soccer too. So anyways, with that being said, high options volume watch list. Let's see what we got moving over here. We got MU third on the chart, which we just took a look at. ASTS is still moving on the day. 36 IV rank. This thing gapped up over the weekend. And it's trying to put in a new high. We're sitting at 129.5 right now. Or that was the all-time high. Right now we're sitting at 124. So we'll keep an eye on this one as well. Again, one thing I'm trying to be careful with is stepping in front of these moving trains. I really don't mind once we see a crack of momentum. I don't mind getting on a little bit more short delta. But especially with some of the capital and some of the gains that we're trying to protect in the overall portfolio, right? We got about 6-7 months left of this year. We're trying to protect that cushion a little bit here. So, not that we're gonna wussy out on any of these trades. Don't get me wrong, we will absolutely pull the trigger. But in terms of stepping into a runaway train, I'm gonna be a little bit cautious for that. But ASTS, very attractive. No earnings in the way right now either if you want to get involved here. Decent IV rank, solid liquidity, solid volume. It's a really solid trading product overall. And just looking at what we can get over here, we're not getting too much meat on the bone way out there. But we could play around with it. But once again, another underlying, almost near its highs. Nothing really standing out for me today. Nothing standing out for me for the most part. Really going to wait on a pullback to get, something different into the mix here. That very long DT Joby call Gus told me about is up about 57%. Nice. Is Joby still running? There we go. Joby up on the day as well. 3 consecutive green days Joby's been putting in. So maybe Joby to the moon. Maybe Joby to the moon. We're starting to try and fill this big gap down that we had over late January. Late January. Love your show. Love to Jamaica too. ASTS and Oklo are on my radar. I appreciate that, Bryant. Yeah, big love to Jamaica. Mad love. Got the whole family still out there in Jamaica for the most part. And then I got a brother that snuck away and lives in the UK. But Terrell, the little brother that you guys know of, he's doing well. He's out in Colorado. I just went to visit him the other day for his graduation. But no, let's quickly take a look at Oklo. I know we were taking a look at the other day as well. Decent IV rank, solid volume. And I mean, we're pulling back a little bit over the weekend, but we did gap up once again. Now I'm curious, what went down over the weekend. It seems like everything was pretty bullish right now. But let me zoom out here, kind of see where we've been on Oklo. Rooftop lawn darts would be fun until it rained. Yeah, everything, yeah. Or, darts in the rain. There you go. But yeah, we'll switch gears here. We got Oklo over here, still putting in a lot of volatility. It's looking like we finally put in a little bit of a bottom. Here we have the Fibonacci tool, just to give us a little bit more perspective in terms of the range that this thing has been trading in. So we just took the Fibonacci from the high all the way to the low, and then it has it sectioned off in quarters for us. So Oklo still with some volatility in it, but we can go ahead and switch gears and jump over to the TradingView platform here. Up over 20% getting long into Oklo today. Nice boy. Great trades. Great trades. These kids with the Rubik's Cubes are nuts. Yeah, I think we have a few people in the office that are really good with the Rubik's Cube, if I'm not mistaken. I still need to sit down and really learn the Rubik's Cube. And maybe I'll have Matt or one of the guys teach me how to do it. And then maybe we could come back on stream, try to get it done at least before the segment ends. Might have to extend the segment. But no, just quickly, this was last Friday. These are some of the shorts that we had taken. I know we were a little bit more hands-off on some of the scalping since we've been at all-time highs. But this was last Friday. Some pretty solid moves to the downside that we had taken. And I mean, the whole idea behind this trade was just the fact that we were trading near our value area high over here, which we derive from a volume profile. If you're not familiar with the volume profile, it just gives us a distribution of volume. So it'll show us where there was a little bit more market interest or where there was a little bit more trading activity at specific price levels. And whenever we put that into a bell curve, it gives us more context as to what we might even be looking at, or it gives us more context to know what feels or might look cheap or what might seem a little expensive, to really break it down in simple terms. But we were trading near this value area high, so we were looking for some shorts. We took a couple shorts, just very small size, a couple contracts, and we were looking to cover into the lows. And one thing that I find very helpful with the management of a lot of these trades, because I find sometimes getting the entry isn't, I wouldn't say too difficult. Yes, the execution takes a lot of practice, but the one thing that can be so difficult, I think, for any trader is just learning how to manage the trades and like knowing when I should be looking to scale out, knowing when I should be looking to take a little bit of profit here, knowing when I should just take the loss and, eat the loss. But having some of these swing lows to the downside has always been really helpful to at least determine when to start scaling out of some of these positions. So it was nice to get this opportunity last Friday. It's unfortunate that the put that we bought last Thursday is already eating back some of these profits. So that's something to keep in mind. And then the same day, I believe we got one more opportunity near that value area high again. So we took a couple shorts. And again, the whole idea about getting outside of this position was just scaling out, as we make new lows into the market. This was such a tough trade to hold to the downside, especially whenever we get that type of, choppy price action, especially when it's kind of stair-stepping lower and the market is super choppy. Very difficult trade to sit in. But throughout the rest of the day, we sold off all the way down to the lows for the day. And then this massive gap that you guys can see right here, the market gapping up into a new all-time highs. And then you can see we really haven't done anything since then. We just pretty much been hands-off. We're going to wait for the market to pull back. If the market is trading above these levels of value that we have, it'll most likely be a no-trade week for us. It is a shorter week. We got Tuesday, Wednesday, Thursday, Friday. Unless more news comes out about the Trump wars or anything that Trump is doing, I really don't know what's going to pull this market back. And I think all we can do is pretty much just be patient for whatever the market wants to give us from there. Wanted some QCOM, but that's an up stock. That's an up only stock. Is that an up stock or an up only stock? Take a quick look at QCOM. Let's see. Take a quick look at QCOM, and I know we have just about a minute left. QCOM consolidating a little bit here on the 1 minute chart. Let's zoom out a little bit more. Back to its highs. Wow, insane moves. I'm kind of speechless, honestly, for the type of price action we've been seeing, especially over this weekend. I mean, a gap up into a new all-time highs. That's a pretty dirty move. That's a pretty dirty move. But with that being said, still a little bit of range left on some of these metal products like silver and gold. Selling back off into that monthly range we've been trading inside of. This was the high that we had put on silver. This is where the rally pretty much started. So you can kind of see we've given back about half of its gains from the highs, but it does seem to have a little bit more range left depending on wherever the market wants to shift from here. But I have no position on in some of these metals. Would love to get short again on silver if we can make it back up to an 85, maybe 86 silver. But the market doesn't really care about what we want. So we'll just trade whatever it gives us. With that being said, guys, we are running out of time here. We'll see where the market ends up before it closes. Again, 30,000 NASDAQ. Kind of crazy to see it. Not really crazy to see it. But I hope everybody else is doing well in managing those positions. Be sure to stay tuned for more segments coming on next. And we'll catch you guys next time. Peace.
In the money. It seems pretty easy to understand. If I'm in the money, I must be profitable, right? Not quite. In the money is in reference to the option's strike price relative to the current price of the stock. An in the money option is an option which has intrinsic value. For a call option, that represents an option with a strike lower than the current stock price. For a put option, that represents an option with a strike higher than the current stock price. Being in the money is a good thing for long options. It's not so good for short options.
So I see you're taking an interest in open interest. Open interest, open trades. It's right there. Imagine all the trades are in XYZ at the same strike and expiration. Day one, Brittany buys 4 options to open a trade. Dean also opens, but he only buys 2 options. And then, closing bell. Day 2, open interest is 6 because of yesterday's trades. Now, Jessica gets in on XYZ, and she buys 2 options. Day 3, since no one has closed any trades yet, open interest is at 8. Watch this. Brittany closes her trades, Dean closes his, and Jessica keeps her eyes open. On day 4, open interest is now down to 2. That's because Brittany and Dean closed their positions and there are only 2 still left open. That's how open interest is different from volume. And both of them are parts of liquidity, which is something we look for before we enter into any trade. Pretty simple.
Look who's back testing. tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at tastytrade.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
Pay for back testing? No. Pick from hundreds of symbols, any strategy you want, and all the data to trade smarter. Tweak the delta, dial in the DTE, and stack the legs. See what survives. Check out Tasty Trade today.
back. It's still Tuesday, May 26th, 2026. This is Futures Power Hour, sponsored by CME Group. I'm your host, Chris Vecchio in New York. He's your co-host, Ilya Spivak in San Francisco. One of these days, Jamal will be back, we promise. Ilya, market's off the highs here a little bit today as we're settling into an afternoon. We had a decent little 2-year note auction come out, which didn't hurt anyone's feelings. Yields are lower. Oil prices are lower. Metals look pathetic. Dollars off the lows. How's your day?
Well, it's very interesting to rattle off those things because, of course, all of them depend on counting the weekly open gap after a holiday in the US and the UK, the biggest markets for trading oil. But when you look at outside of that gap, it's a very different day. Yields are pushing higher. Stocks have erased all of their intraday gains. Oil has erased all of its intraday losses. So it's very much a tale of two cities here. Yes, of course, the market starts the week, an abridged week, with a kind of low vol melt up as we've seen, and we get a gap open. But all of the leaders that have been powering the rally, despite the fact that the NASDAQ looks relatively solid on the day, all of them are actually off intraday. So SMH is down on the day. NASDAQ, the QQ ETF, down on the day. Software down on the day. MAG's down on the day. So, yes, there's been an interesting glimmer of maybe an Iran deal hope that gave the familiar sort of catalyst here where oil falls and everybody gets happy. Well, they're not happy anymore going into the close. We'll see if we start to try to close this gap. But looking at some of these markets now, the exhaustion looks screamingly palpable. And your sound is gone.
Thank you.
Perhaps also a marker of the exhaustion being screamingly palpable.
Yeah, my voice is shot today after yelling at the TV last night. But Ilya, summer trading has begun. Signs of exhaustion, low volume in this market. We're on the other side of Memorial Day. Typically, the first day after a holiday weekend is going to produce a slower tape. This would be the case for anything, Ilya. I mean, pick a holiday out of the hat.
Oh, yeah.
First day after, it's going to be slow.
I
So
mean, we
volumes
talk
to me
about
don't
Easter
pop out.
Monday here a lot, right? And how recent volumes line up relative to Easter Monday, because that was the last time we had volumes this silly and pathetic. And so we look at them and go, we can't even get us better than Easter Monday. So you're absolutely right.
So summer trading is here now, Memorial Day through Labor Day, effectively, as we like to call it. Where is a good anchor point for this conversation? Let's talk about where the market is pricing in Fed rate hikes over the next several months. We are now officially in the Fed chair Warsh era. We now have to refer to him as Fed Governor Powell once more. Ilya, at the start of this new term, today is technically the first full trading day with Warsh at the helm, so to speak. Markets are giving us a 75% chance, we'll call it, of a hike come December. But that's really where it starts and stops. The market foresees the scope and scale of this interference and supply chain disruptions, the energy market spillover, leading to the necessity for ultimately a hike down the line. My question to you here is, that is a long way away.
Yeah.
You and I typically don't take serious much of any pricing beyond 6 months, let alone, I mean, I would even argue less than that, given how fast the market's responding to macro catalysts these days. But we have a June meeting here in which there is a smidge of a chance of a hike. We don't think we're going to get one. However, it is a summary of economic projections. Kevin Warsh is going to have a chance to kind of like lay it all out on the table there. And with the FOMC, anchor us into what the potential rate path will be moving forward. Is the market underestimating the chance of a hike this year?
It's difficult to imagine how one of these things doesn't give. So we know that inflation is sticky. We've seen it in the data. We know it's going to continue to be sticky. We've seen that in the data. We just saw consumer confidence hit the lowest on record, if you ask the University of Michigan, and continue to fall to multi-year lows if you ask the conference board. So we know the consumers have perceived that the inflation issue is as damaging as it seems. We know that the consumer, as the main part of GDP, has been slowing for 2 consecutive quarters. In fact, in the first quarter, consumption grew slower than GDP itself. So you look at this and you say, okay, well, what's the market pinned on here? Is it that there's going to be what that is going to give us the optimism that we see? And obviously, I think we look at the rally off the late March, April lows, and we say, well, the market has decided it doesn't care about doing the Fed calculus, whereas clearly all the other markets are busy doing almost exclusively that. If you look at the dollar, if you look at yields, if you look at bonds, if you look at gold, if you look at crude oil itself, frankly, as the bogey from which that calculus typically starts on a given day. But you look at this and you say, okay, well, why are stocks indifferent? And the first quarter GDP data, as we know, has given us the answer. Business investment grew so fast that weak consumption didn't matter. But of course, all of the things that are battering consumers also batter data center builders. And the weak volumes, soft participation, single story melt up now is showing cracks. So I think the question you have to ask yourself really isn't, are the markets underpricing Fed rate hike odds? It's every other market has been looking at this and going, this is a real thing now. And equities have been in la-la land, whether the probability is 75% or 65 or 55. They haven't cared. Now is the time, perhaps, where we're out of earnings season headlines, where they have to start to care.
We don't have many catalysts this week in terms of the earnings calendar. I know that you don't think Dell's a big... I mean, Dell has been an important part of the data center build-out story.
It's got to be an important announcement because the president said everybody should buy a Dell computer while owning a ton of shares of Dell. So I think you got to pay attention now. There's a whale in the market, everybody.
Stocks are holding the gap higher here at the start of this trading week. 75.20 here in the S&P 500. We closed on Friday, Ilya, at 74.84. So that open here up at 75.19. It's basically pinned. You talk about the fade off over the course of the session, which, to your point, we do have an attempt to make a move into new highs, which does occur, but the selling continues thereafter. And now we've closed that opening move higher. We hit a high of 75.69.75 in today's session. The NASDAQ is still up a little bit more than that. It's a different story here.
Holding a little bit better, yeah.
You take a look at that 4-hour candle. Sure, there was a pullback, but tech right now has been absolutely on fire. Micron at one point today was up 18% again. It's now up 19%, 893. Did you miss buying this at $675 a share last week? I did. Because it's back on the highs here, Ilya.
Does it count that I missed it if I wasn't looking to do it?
Yes. Semiconductors here closing what would be a new all-time high again, up 3.73% with that gap open higher. So depending upon where you're looking, you're starting to see certain sectors get a little bit more juice than others. It's why, Ilya, QQEW right now, for all of its warts, still up 1.42% with its gap. So tech is very, 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 very strong, as it were. The data center trade is just not dying here at the start of a new week. Certainly not because of any of the headlines that we saw over the weekend.
No, it is not dying. It is, however, lacking for all those things that you would say are the makings of something with follow through. And so the question, and that's fading volumes, that's intense concentration, and of course, an appreciation for the fact that to build data centers, you need money that you can borrow at a reasonable amount because the hyperscalers are setting their cash flows on fire to pay for all of this, to the point where Google, who does not have to spend other people's money, is about to issue their first bond in yen because they can't get money anywhere else. How incredible is that? Google of deepest pockets in the AI race has to go borrow in yen. So we're in a situation where, of course, the cost of money matters. It, of course, matters that they even have to do it. Never mind the fact that companies like Meta, companies like Amazon, companies like Microsoft are setting money on fire to such an extent to build all this stuff out that all of the cash, the free cash flows, all of their piles of money that they supposedly had, gone now, already committed. So, and you got to renew this stuff every, 3 to 5 years? Because that's the obsolescence cycle. And everything that you had to buy, probably already bought for this year. For the little building that you're going to get to do. Why little? Because 40% of the projects that were slated to come out, the data center projects this year, are now delayed at least into next year, if not further.
You're just describing a bigger bottleneck.
Well, that's right. That's right. And when you have to look at this bottleneck and say, gee, am I happy that there's a bottleneck because people can charge higher prices? To a point. But then that bottleneck starts to eat itself. You love the Ouroboros imagery. That's what this becomes, perhaps already. Because you're innocent.
For the sake of the next Micron video that's going to be hitting the site for signal versus noise, I'm going to say that I'm feeling more and more confident. A lot of other analysts out there in the past few days have been putting out the note. UBS today, in fact, the whole thesis of their note was, are we done with chips being a boom bust commodity like sector? And is it now in a permanent state of elevated perpetual demand because of AI?
Okay.
Which that's been one of my arguments, Ilya. Like if it's been elevated to the same stature as national defense or energy security policy, then it has price insensitive demand in perpetuity, at least in the short run. But it has price insensitive demand for the foreseeable future, as far as the eye can see.
You know what is the most classic sign of a bubble? When anything is thought to be a condition in perpetuity.
Is that not the case?
There is
for the
absolutely
oil
nothing that is more telling that this thing is a bubble than anybody making any kind of argument about perpetuity, anything.
Is it oil bubble? We look at the SPR levels and we look at the
of course not. The oil market goes up and down.
No, but we're approaching oil the same way, with the effect of there's a floor underneath us because they have to refill the SPRs. You know, and like that's got to happen.
They don't have to refill the SPRs. People think they have to refill the SPRs.
Sure, but that perception matters more than whatever the reality is.
100% it does. And this is exactly the thing. You can make whatever argument you like about the perpetuity of whatever. The reality of the situation is nothing is ever in perpetuity in financial markets because things get discounted. And the marginal buyer eventually is the last one until the price is fair and it's time to take the profit off the table.
What's a fair? How do you determine fair price right now for the market?
You don't. And this is the thing. Nobody knows. And a very small handful of hedge funds spend oodles of money attempting to figure it out, get it wrong about 40% of the time, and succeed because they have either incredible singular talents that can read the macro like no one else, and Stan Druckenmiller or Louis Bacon, sure. Okay, these are singular people that have not been repeated. Notice the Tiger Cubs don't do as well as Tiger. So you look at all of this and you go, okay, there's a special exception for people like that. Everybody else that's making money in trying to figure out how the markets work What they're doing is they're trying to figure out when the price is right. When the discounted cash flows from the expected value of whatever they're buying are done making sense because the price has moved there and there's nothing else to extract. Nothing is ever permanent. This idea that there is such a thing as a perpetual money-making machine is the most common fiction at the top of every single bubble ever in recorded history. This is exactly how these things end.
They've been calling it always minting dollars for AMD for like the past $300.
This is a more classic telltale sign of the world is about to eat all of these people. With the introduction of gravity, has not existed. Every bubble is different. Everything is a little bit different, but the one thing that always happens is people think there is no risk. This time is different. It can work in perpetuity. Just look at telecoms in 2000. Everything went right. The bear market happened not because something went wrong. It happened because everything went right, as Paul Tudor Jones has recently very eloquently explained. It was the most predictable bear market in the known universe, except maybe what we're about to see here.
Okay, so is this for the next 45 and 21 out cycle?
It could be, yes.
Do you think you're going to say this is going to be the top? This is it?
I think it could be. I don't know that it is. I don't think anybody knows that it is. Again, I think some people have a better idea than others because they have complicated models that have been shown to be effective at this kind of thing in the current cycle. Because again, the models have to change every cycle. And some firms are really good at that.
What are you doing here if you're ticker agnostic?
I don't think you buy.
You don't buy the breakout bull flag?
I don't think you do, no. Because I think when you look at this and the momentum indicators, what you see is the most obvious negative divergence you could imagine on the first page of any technical analysis textbook. I think you look at this and you go, low volume, fading momentum. Do I buy this high? You'd have to be crazy.
It's summer. What do you expect from the people? Everyone's
I think it's been fading. I think it's been fading since well before you could make that argument.
Well, it is. SMH could close above 600 today for the first time. This year would be a new all-time high close for the semis. I'm not in the business of calling a top. Bottoms I miss. Sometimes I try to call them. Sometimes
I don't think you can. I don't think you can call them.
But you know what, Ilya?
I think you'd be crazy to short it. I don't think you buy it.
We have a new thing to say here on Futures Power Hour for the first time. NASDAQ 30,000.
Woo!
30,000 at 10, not 25 here.
Hey now.
That's crazy, Ilya. But, it is following the inverse head and shoulders pattern breakout that we were watching last week. And sure enough, both the S&P and the NASDAQ have found a little bit of recovery here. Earlier today, the S&P 500 was at all-time highs. Where does this run to on a pure technical basis? Just keeping an eye on the measured move, which would be the distance between the head and the neckline for any head and shoulders pattern. It does give you that target still north of 30,200. So maybe, just maybe, there's a little bit. Yeah, less than 1% to go. But still maybe a little bit more juice here on the upside. And then, Ilya, we are in a bullish part of the market again. We talked about this last week there. Once you make your way through Memorial Day weekend, you get into this window May 26th through about June 10th, where the market tends to go up. Volatility tends to contract. If you look at the S&P 500, going back to 1950, this is a good window for stocks, so to speak, as it were. And we're off to a pretty decent start here. The Russell's up 1.6% today. That's been much needed. We talk about a rally broadening out. So not for nothing. Semis leading, telecoms are leading, technology's up. The growthy stuff is doing well. Home builders are doing well. I see a Russell 2000 that's going to close at a new high. And I see QQEW, which is going to close at QQEW, which is going to close at a new all-time high here. And it reinforces now, in my mind, just stay along the market where possible.
No, I don't think you try to fight this, but to try to buy it, I think is pretty crazy.
Keep putting coins in the machine, Ilya, until it stops spitting out prizes.
If you're going to keep putting coins in this machine, you'd better be very risk defined, and you'd better be losing.
Absolutely.
And you'd better be losing the absolute minimum, and knowing what that's going to be by defining it ahead of time.
So let's go to the end of next week. Let's go to June 5th. Okay. If we're going to continue to feed the machine here, one of the propositions is how do you structure the trade?
Yes.
So just as a case in point, if we wanted to do something like a short put spread here, you are risking, 4 to make 1, $1,000 versus 250, 72% probability of profit. Okay. But that's still, you're risking 4 to make 1 if the market moves 100 points against you. If you're thinking about the same move to the upside here, right? Instead of short 74.25, we're near 75.25. You're looking long 76.25. Let's get rid of actually all the other ones first. 76.25, 75.50. You're risking 1 to make 3. So the question I think a lot of folks have to ask themselves is, am I willing to do that kind of payout right now? Where if I want to be a bull, if I'm going to be short puts, or a short put spread, what's the vol profile of this market like? A VIX that's been dropping, if out of the high teens now, we're talking about what, 17 here, bouncing up a little bit today, 50 cents. You're making an argument that like the cycle low in volatility hasn't been reached yet. So
it's a very interesting thing in volatility. If you look at the volatility futures structure,
they look great.
VX futures, I think what you see is really, really interesting. There is a kind of clustering in the volatility structure when you start going out in time and you start looking at the further out contracts. And there is this really, really sharp deviation for the VXM6, so the current contract, which is really interesting because the moment you get out to VXQ, it's much higher. And there is this aggressive melt up in the volume right where that divergence starts. Where does that divergence start? Oh, right around May 15th. And that's really a very telling kind of a thing because, of course, that's exactly the top that we're currently testing in ES. And of course, VIX is a S&P 500 derived instrument. So when you look at that and you say, what's this giant jump in volume on the day that the market establishes its most recent high that we're now testing? And why is there this massive disconnect between the current and then everything else on the curve? And you start to go, well, hold on. Maybe what the market is doing here is just thinking the issue might last longer. The problem might come later. So we need to move our hedges downwind. And that's perhaps what we're seeing because the gap now is really pretty astronomical. It looks almost as silly as the gap between the NASDAQ and SMH, where you can clearly see one part of it just runs away completely. And so
the volatility futures curve right now is giving you 6-7 points of contango, which historically speaking, low volume, 6-7 point spread, summer months, positive technical drift. That is hard to fight if you're a bear. It's very hard.
Very hard. Very hard. But if you look at the shorter term contango, which is, of course, how sell-offs and shocks happen, not out to 2027, because nobody knows that far ahead in reality. But when you look at the difference, say, between, let's call it 19 on VXM6, the current contract, it's about 1885 right now. VXQ is already 21.4. And from there, it escalates. But the gaps from VXQ, it's 21.4 to VX, let's say, X, it's 22. To VXZ, it's 22. To VXV, it's 22. The VXF07, it's 22. So all of it is clustered at around 22 the moment you get past VXQ, and VXQ is only a little bit lower at about 21 and a half. And then there's
Something
a
happening.
giant leap to VXF.
Is there another big batch of earnings coming out between those contract expiries? I mean, realistically, if you're thinking about risks that are down the road, it's not going to be anything geopolitical. You're not thinking like, oh, well, in July sometime, the U.S. and Iran are going to go back to war. So let's all rush into the next big set of catalysts in that time frame.
Term
To be earnings.
premium like more so. The longer you hold, the scarier it gets. Because the car is at this point balancing on one tire.
Yeah, but the longer you're compensated for time, is that abnormal to see that?
To see these kinds of gaps where all of the risk over the course of 4 expiry months is all clustered together and the current one is way off sides, that's unusual. That's not a normal curve. That's a curve with a fat front end divot.
I'm not going to be able to convince you, at least on stocks. We can move over to oil, as it were, which slumps on deal hope again. That was the big weekend news that Saturday afternoon, evening, we find out that President Trump has something in front of Iran. Iran may be going to China, not Russia, to get control of its nuclear enriched material. But,
and just
all
look at what we have to show for it.
We have another bounce off the 50-day moving average here in oil, which we had this on April 17th.
And a goose egg of a day after the gap, just like the S&P. So please tell me that this market gives a hoot at all about anything except oil. Because, hey, earnings are over, and this is what matters now. And the moment you don't have job owning, that the market clearly is not taking all that seriously because you see what happens the moment liquidity comes back, it all runs away. So please tell me this is about the AI super cycle. Yawn. That's not what's going on here now.
Are you still long oil?
Definitely.
Yeah, I could tell.
Of course I am. And if I wasn't talking my book, why would I have that book?
I'm like, why is this guy one-upping me and interrupting me here? Oh no, he's
no.
He's long oil.
I've had a very emotional 24 hours in this market where the market was looking at yet another Boy Who Cried Wolf performance and going, oh yeah, this sounds real this time. Thankfully, when liquidity came back, all this nonsense was undone.
So you get the gap open lower, very much like in the S&P 500, which again, gaps open to 75.19. It's currently sitting at 75.23 and change. Oil here, gaps open lower with the weekend news to 93.88, and we're at 93.97. So it's much ado about nothing. It's still a 2.7% loss, but not since the open, and we've recovered. And like so many other times here, Elia, one of the hallmark, and I didn't catch this myself overnight for a variety of reasons, but check here, 1, 2, 3, 4. We're getting into the zone between the 1 month and the 50, and it's been a catch point for oil the entire time. So if that were to change, right, if we were to start to see a close below the 50-day moving average, we haven't seen that since realistically, you're going through the first week, January 8th, January 9th is when you get that close there. Otherwise, this market's been holding that 50-day the entirety of the time. And so, look, I think the way that my perspective on oil has been, if it gets a little bit high, you sell some calls. If it gets a little bit low, you sell some puts. When it got to 90 today, I really wish I tried getting filled. I couldn't get filled. I really wish I could get filled on some more of those like short 70, 71, 72, like it just this neighborhood of put spreads here, because if the market's still going to give you 4-1 to say that oil is not going to go back below where it was prior to the war, you got to take it, because the odds that we get down that low, I mean, you're talking about what? Peace among men everywhere on earth. No more geopolitical risk anywhere. Russia and Ukraine are stopping fighting, right?
Somebody should ask Moshtara Hamane, who had a nice write-up today that he released. Nobody's seen him, by the way, still.
Is he just still cardboard at this point?
At this point, that's all anybody has seen of him, but he's been writing things. And every time, it's interesting, actually, now that I think about it. There's a kind of job-owning competition here. between President Trump and the Supreme Leader Jr. There's this interesting thing going on here where the negotiators seem to be trying to get a deal. And the president is trying to boost them, even though he's usually, at least up until this point, and perhaps eventually, and maybe eventually, he'll be right. But he keeps trying to say, oh, yeah, we're almost there, almost there. We've been almost there like 10 times already. And every time that we're almost there, according to the president, some kind of screed comes out of Moshtara Khamenei, where he says, the region has been permanently remade and the U.S. has lost and the Gulf countries need to fall in line and we control the Strait of Hormuz now. We won. We're going to charge everybody a toll. It's a new day. Join the winning side.
It's an environmental fee, actually, as they stated over the weekend.
Hilarious. Which environmental risk are we trying to offset? ICBMs?
It's not a tax, it's a tariff. Right. Same energy.
It's not a tax, it's a tariff. That's right. It is the same energy. You're absolutely right.
We're not tolling you for passing through the Strait of Hormuz. You just happen to be a boat going through the strait, and therefore we need this donation for our environmental fund.
I am reminded of the scene in The Big Lebowski where the robbers look at a bowling ball and ask, what is this? And Jeff Bridges responds, well, obviously you're not a golfer.
Ilya, if we get another dip down towards that 50-day at 90, right? That's $4 from here right now. That does mean the pricing that we're currently seeing for 70.72 would be 74.76, but that's going to be messed up here. So I'm just going to go 70. Let's go 75.77. This is basically, if we get another dip to 90, this is probably what the pricing is going to look like for any given trade, risking 3 to make 1 at close to what would be a 70%, 80% probability of profit. I think we got to keep fitting this machine, coins. You may not want to do it in stocks. I'm going to do it in stocks. I'm definitely continuing to do it here in oil, wherever I can on these dips. I wasn't fast enough this morning. I couldn't get the price that I wanted. I was trying to work the trade, but that seems to be the best way to approach this still, where if you don't get demand destruction because oil doesn't run all the way up to 150, then you're going to have a market where there's, they don't have to refill the SPRs. I happen to think they will, or at least they'll be perceived as needing to for a little bit of time here. Sure. So no demand destruction, need to refill the SPRs, convince the trading public that oil needs to go much lower than where it was prior to the war starting. And that's what, 67 to 70. So if we could put spreads around $70, we got to keep feeding them into the machine across expiries, across strikes. I mean, just whatever we can do, Ilya. There's no reason to call the top in oil, but I think it's a lot. It's going to take a little bit more patience, but calling a floor underneath it has worked and has, to me, the best trade on the board still.
Yeah, I mean, I think we're basically thinking about this in similar terms, that the war shock is locked in, that oil is not going back to where it started. I think we're seeing the market structure start to reflect that. You're seeing much better performance in the out months in the futures than you're seeing at the front, because a lot of this speculation about, oh, maybe they'll have a deal is in the front, whereas in the further out contracts, they go, yeah, who cares if they have a deal? Does that matter? No. It doesn't matter in the slightest, because actually, Moshtara Khamenei is right. It is a new world. He may not be right about the ways in which it is, in which it's new. He may not be right about absolutely anything else that he said. But what he is certainly right about is we are not going to the status quo before this war began. That war has changed how the Persian Gulf works. It's changed how the Strait of Hormuz works in a permanent way.
Or the worse.
So it seems. So it seems.
But great. Yeah, it's definitely not our Suez
Now,
crisis.
by the way, jury's out on that one. Sure, I will concede. Who knows whether it's for the worse or for the better, with the benefit of hindsight in a year or two. Stranger things have happened. But as of right now, what we definitely can say is if you thought the pre-war normal was a glut as far as the eye can see and a price in the 60s, and you think that's where we're going, Godspeed. Your compass is in need of a new battery.
Ilya, this week we get some more treasury auctions back on the calendar. It's the 26th here. It's 26, which means we had the 2-year note auction today. We're going to have the 5-year note auction tomorrow and the 7-year note auction on Thursday. Kicking things off with that 2-year note auction for what it's worth, we do have a decent B-ish high yield rate, 4.071 versus the previous of 3.812. Bid to cover ratio 2.64 versus 2.65 previously. Indirects were a little bit higher, 57.6 from 56.5. It was right on the screws, so no tail, didn't stop through, right at 4.071. It's good. Not anything really to write home about. Interest rates are higher. Treasury yields have come down over the course of the day, and you mentioned it all being a trade around oil, which I'm very much inclined to agree with here. Oil prices are lower, so bond yields are lower. And that has been the track that they followed for a few weeks here now. If you'll notice on the platform, Ilya, we're now moving into the September expiries here. So M6 is no longer the default when you go over there right now. But to just highlight something that we still have here in the M6 contract, last week we pointed out that there was this little zone coming up where prices would run up towards the swing lows that we had in March, plus the 1-month moving average, and maybe that'd be an inflection point. You said you'd be interested in reloading there. And I bring that up because today the 1-month moving average is at 109 and 37 ticks. That's 307 ticks. Today's high is 109 and 110 ticks. So like, right. I mean, we want to call it 109, 31 ticks. It beats it by 1. It's right there. And then it starts to fall off as oil starts to rebound. Okay. So Ilya, we're now at the price. How do you structure this trade with a 30.5 ER? If you want to have a bearish view on bonds, how are you getting those short deltas on your book?
So I have a bunch of them already in the middle of the curve and at the end. And I think that's where you have to look because that's where the sticky inflation is. You're going to have all kinds of a debate about what happens near term. But I think you look at ZN, you look at ZB, and that's where you're going to have it. ZF, as you're showing on the screen here, looks also solid. But I think the bounces that you've had in ZB and ZN give you kind of better structure. They give you more to work with. They give you more expansive risk reward. ZN may be the better of the two, but ZB just as solid. And so I think this is where you look for it. And for me, what I need to see is I need to see this test of former support turned resistance fail. I need to see this show me some sort of clear sign of exhaustion, and we're just testing it here today. So let's see. We've got some interesting economic data later in the week, mainly the PCE inflation numbers, but there's a little bit more there. We're going to get a revised set of GDP numbers. That'll be something to look at. The personal consumption numbers that the PCE inflation figures are built into the actual consumption numbers, personal income, personal saving, all of that is going to be interesting to look at because, again, I think we're in the place where stocks went on a detour because earnings season. That's over. Salesforce is up this week. Dell is up this week. Those are not the big names.
I think you're not giving enough credit to Dell. Dell has
maybe.
Dell. I only say
we know there's a whale in the market. That's certainly something to
that aside. That aside, we've seen how if it's been Micron's earnings, if it's been Western Digital, it hasn't just been NVIDIA, right? If it's been an AMD and ARM, they all have moved the market and Cisco, right? They've all helped reinforce the narrative and kind of like, give another spin of the wheel. I'm thinking about like not Wheel of Fortune. I'm thinking about Price is Right. and not Drew Carey, but Bob Barker, where he's up there with that, so he's like another spin of the wheel. And it's these earnings are helping put coins in the machine and give people the confidence. Oh, this is still going. There's another threat in the short term to justify me chasing this higher right now.
Mm-hmm.
But about bonds, Ilya, to me, the most compelling part of this, right? If the worst case scenario happens for oil, I mean, for the economy, it's probably just high oil prices, but not like peaking and blowing out where the entire global system has to then like, okay, we've got to solve the strait. This can't stay closed.
Mm-hmm.
So are you banking on recession? Are you banking on another spec? I think the greatest risk would be if bonds stay at these levels, things are going to be fine. Rates are going to be not going to be a problem for stocks. Stocks aren't going to be bothered. If notes are clearing 108 quickly to the downside, if they're getting to like 111, 112 quickly to the upside, something problematic's happening. So I don't want to necessarily sell calls up here. I don't necessarily, although I'd be much more comfortable selling calls than selling puts. I'd rather just take downside directional exposure, because if I'm going to be chasing the stock market to the upside, what's the biggest risk to it? I think it's going to be rates. We're not quite at that tipping point yet between rates and earnings, which you and I discussed later. Technically it was earlier, but it's going to appear chronologically later in the day when the video is released on the website. Yeah. But check out today's trading trends for the deeper conversation around this point. So the risk for me, the way that my book is balanced, is that rates go up. And that might be the case for everyone's, holdings. For you, you're already leading in that direction. You're long oil. You're looking for yields to move to the upside. So, but for me, structuring a trade so I get some downside protection in rates, that being the mechanism that could derail the other things that I'm trying to accomplish, if it's with copper or any of the ags, I need to be long and out of the money put spread here. So at 59 days to expiry, which pushes us through the middle of July here, just almost 2 months out, the 108, 107 long put spread, it's risking a little bit less than 1 to make 4, a little bit more than 4, I should say, risking 1 to make a little bit more than 4. If this works out, something else has gone wrong for me. But I'm okay with adding this in because it reduces the beta weighted deltas of what's here on the follow page ultimately. But generally speaking, having a little bit of short treasury exposure at the margin, I'm happy to do so if it means staying insulated against a potential, move lower in stocks, all because hikes are coming. At least there's that.
Well, yeah. I mean, I think you have to look. Speaking of being ticker agnostic, I think when you look at a chart of ZB, when you look at a chart of Z, what do you see? You see a stair step lower. When's the last time you had a backfill and a retest of former support turn resistance? Mid-April or so. What did we see? A clean backfill retest of the same congestion area. We got to the outer end of the congestion area. We didn't stay at the bottom. So I suppose we could move a little bit higher here if we were going to test the depths of the congestion zone, not just the underside. So could get to, 110.5, maybe 110 and 30 ticks, let's say 25 ticks, something like that. If you wanted to really test deeply like you did before. But this is a textbook of a trend unfurling. And this retracement that we see is a textbook selling opportunity within that structure. Now, again, maybe that's wrong. It sure could be. Some of the best hedge funds are wrong about 40% of the time. Sure could be wrong, but the risk reward is on that side of it.
Yeah, I've seen some people that are parting themselves, and there's part of me, I enjoy the shining fruit of going over to Wall Street bets, but also everyone goes through drawdowns at some point. Rentech, I think at their worst drawdown ever was 23%, and that's like the most successful hedge fund that's ever existed, ever.
Yeah,
they really don't lose money, but even early on as they're working out their process, they have a year where just market conditions line up, and given the book, it causes a wipeout. So Ilya, we're going to go to metals here, which are just so sad still. Gold here, down 0.8% right now, just hugging that 1 week moving average, not really trying to find some space above it here. Silver prices are struggling. Likewise, we're up by a whole 0.15%, but below that 1 month, below that 50-day, below the 1 week. The only thing that has any traction right now is copper, and this is the one that I have confidence in. We had that really nice bounce off of the 1 month near the former highs at 6.2 or so. I'm looking for a move up to 6.7. We have 30 days left on this contract, 6.7, 6.8. So one more little squeeze to the upside wouldn't hurt. But the metals, to me, it's very difficult right now with a straight face to say, yeah, no, this is the next great trade. There's not a lot of momentum to the upside. If you're going to dollar cost average into it, that's a totally different conversation. Like this, sure, continue to DCA into the metals like you do for the S&P 500 if you're an investor. But as a trader, what do you see here, Ellie? I know that you're short, so I guess you're seeing opportunity to downside. 30 IVR. What's the bull case here for gold in a world where oil's staying up and rates are higher? I mean, is this just going to be a slow bleed out?
I think it's a tough argument to make. I think what we saw last year was a gold that didn't care about rates, a gold that didn't care about the dollar, a gold that only cared about really just one thing. The world was becoming a place where financial systems were getting weaponized and people needed non-sovereign vehicles to move value. And the most obvious liquid one, we saw, for example, Bitcoin did not participate in this because nobody thinks it is that. That's where where everybody suddenly realizes the emperors were not wearing any clothes. But gold clearly took that role and was a kind of deglobalization vehicle where people said, well, if the US is going to weaponize its financial system and then China is going to build up the payment rail so it can weaponize its system and in any case is going to weaponize things like rare earths and all these kinds of things. Well, we need something that is a non-sovereign value vehicle. And you saw, for example, central banks. It's not that they divested from the dollar. The deglobalization narrative was just flat out wrong. That's not what happened. But the data shows it clearly. The dollar's share in payments increased. It didn't decrease. What happened was fiat money's share of payments started to get eroded a bit when you look at not so much running economic activity, because payments themselves, that's a dollar market. It's not even close elsewhere. But when you look at central bank reserves and the capacity for future payments, the capacity to manage liquidity and manage credit, a lot more central banks have started to stockpile gold as opposed to fiat as a share of the total. China, of course, especially, but a lot of them. And so you look at that overall and you say, right, could you have something like that come back in gold here, come back in silver, where all of this acrimony is going to start to retool that idea. And it won't matter what yields are doing, and it won't matter what oil is doing, and we're just going to be de-risking against a globalization unraveling. I don't think that idea has a lot of legs anymore, near term. I was a big believer in it last year, made some good money buying gold.
The Iran war changed everything.
Around that idea, the Iran war has changed that.
Yeah, look at Turkey. Turkey's dumped basically all of its treasuries, all of them. They're all gone. They've dumped, I think, 40%, 50% of their gold. Latest estimate I saw. Crazy.
Just trying to raise cash.
Raise cash to defend the lira, which also means the longer this goes on.
And by the way, when we say raise cash, we mean dollars.
Yeah, but it's one of the problems of the market. Turkey and a number of countries like Turkey have big balance of payment crisis going on.
Yeah.
And a crisis like this where they're forced to liquidate their reserves, which they use as a shield, a bulwark against currency deterioration. Otherwise, it could lead to a major dislocation. And you talk about the inflation coming in, Elia, get those higher oil prices, get those higher agriculture prices, get a much weaker currency, and then like bing, bang, boom.
When all of a sudden you have a sucking sound.
Yeah. So right now, gold, silver, problematic. Copper continues to stay elevated. It's kind of riding its own wave. This is the place where I prefer most of my long deltas, and SLV more than SI, which, granted, trade work than didn't. It's probably going to be taken for a loss at this point. So much for dipping our toes back into silver. This is also a place where silver's been finding support since late December in this area between 60 and 70. I know that's a wide range. It's been an accumulation zone. We'll see if that continues to hold up. But we have to go over to the US dollar real quick, which is off the lows to its credit. It's not been the best of days recently for the greenback. It's a lot of chop, a lot of shuffle. I'm looking at the euro here, though, Ilya. We're still below 117, so the dollar's got that going for it. We're looking at the pound. It's still below 134 and a half, 135, although maybe that's getting
worse
tested
than
here.
the euro, too. If you look at spot markets, I mean, the futures markets are obviously augmented by, among other things, U.S. holiday closures. But take a look at spot euro, take a look at spot pound. They look much worse than the futures do.
And the Aussie's back on the up for what it's worth. The Australian dollar is up by 0.4%, which given everything that's happening in the commodity world today, I'm surprised that it's holding up so well.
And again, you look at the spot markets and it's not. It's actually down 0.1%.
So there's a lot to consider when it comes to currency. What we can consider when it comes to currency, though, is that there is still a good deal of volatility in here. IVRs across the board, except for the yen, but you're looking at 77.5, 57.5, 55.5, 52.1.
Probably not an accident that the yen is the only one that doesn't have a central bank with a very quickly changing monetary policy outlook, whereas all the other majors do.
This was a small little trade we put on a while back. I said 10 days to expiration. The short iron condor in the Canadian dollar, it really hasn't done much of anything here. I'm just going to take this off, Ilya, try to get it filled, try to get out of the way. I think that we have to consider the fact that this is a portion of the market where when rate volatility is up and currency volatility is up, it's usually not the best harbinger of things to come. It's kind of like that canary in the coal mine right now. So if currency vol subsides, then you're probably moving in a better direction. But until then right now, directional neutrality is the way that I've been playing it. I know that you're a dollar bull. I can't get myself there yet because I look at DXY.
I'm so long dollars at this point.
I know you are, but I want to see north of 99.5. We've been trading in this sideways choppy range for the past, 2 months now, month and a half, we'll call it. We're near the top side of the breakout. And so as you would say, when it comes to stocks, you buy something at the top of a range, you wait for the breakout. I'd like to see the dollar give a little bit more of an oomph.
Yeah, if you don't have it long here, this is not the place.
Not the place to get it. Other than that, Ilya, you and I will be back later on today. It is Tuesday, so we're on for overtime, 4 Eastern, 3 Central. Calendar for tomorrow is pretty light. There's some Fed speeches. We're waiting to see what happens with Iran. And of course, on Wednesday, the Dow earnings are coming up. Beyond that, though, quiet start here on the other side of Memorial Day. Light trading volumes, a market that's jostling back and forth after breaking out higher and then just not really doing anything besides give some of it up. We'll see you in an hour and a half, Ilya. Stick around, though. More Tasty Live coming at you after a brief break.
I've got some huge news for traders everywhere. On June 4th, the pattern day trader rule will be replaced by new intraday margin rules. Tasty Trade has been advocating for an updated PDT rule for years, and we're ready to go on day one. You'll have more flexibility to manage risk when and how you want. Join Tasty Trade today.
Markets today feel a little bit like a Rorschach test. Bulls see AI-driven productivity gains, strong corporate earnings, and an economy that continues to grow. Bears, on the other hand, see overextended positioning in semiconductors, a Fed boxed in by deficits and inflation, and of course, the Iran war. Somewhere in the middle, we find gold just off record highs, stocks at record highs, and bonds continuing to argue with central bankers. Joining us now is Chris Vermillion today on Trading Trends, where we're going to cut through some of the noise by focusing on price action and the charts, which tells all. Chris, you and I have had conversations before in the past, but this is the first time we've been able to do it one-on-one. It's good to have you here. We've spent the last several years post-COVID trading around inflation fears, but now the conversation is shifting towards whether or not inflation is stabilizing or moderating thanks to AI productivity gains. We do have the Iran war here as a catalyst in the background. From a technical perspective, what are the charts telling us about the upcoming inflation cycle?
Yeah, I think we're definitely seeing inflation creep into the markets. I think it's here to stay for a while. I think the Strait of Hormuz, I think it's going to drag out for a lot longer than we think. And even if it doesn't get worse, just time alone is creating, I think, a huge problem in terms of supply and demand, and people pricing of things are just going up. People are naturally expecting, people front run pricing of stocks. They also front run pricing that their products are going to cost more to get because they might not be able to get them, or it costs more to produce them. So we are seeing price go higher. The charts are telling us that when we look at crude oil, we look at inflation data, we look at interest rates and falling bond pricing. So it is a major concern. But the stock market right now isn't really that concerned about it because AI resurgence really is just, grab the bull by the horns and it is just pulling it higher. And so we're seeing technology really drag the major indices higher. And the people want to be in tech, they want to be in AI, but they're not interested really in dividend stocks or utilities or consumer staples. They're all underperforming. People are full on risk on mode right now.
One of the famous charts that goes around FinTwit every few years, as I'm sure you've seen, is the whole comparison of this inflation wave post-COVID to what happened in the 1970s. And it's been popping up a lot here. Do you pay attention to those analogies? Is that something that traders should focus on, or do you just focus on the charts that you see in front of you as opposed to what's happened in historical times of yesteryear?
Yeah, I'm more so focused on price. I don't really let the economic data, fundamental data really weave itself into what we do. I find the biggest the best way to navigate the markets is not through news and not what we think is going to happen, but to actually follow price. So I'm very much so a technical trader. I wait for price to give us a clean direction, make sure there's strong momentum, and we follow it. And typically news goes in line with the price trend of the markets. And so that's the way I really focus on it. Obviously, you listen to the news, you can hear it and feel it changing the sentiment of investors. It makes them want to kind of flip and flop between sectors. We have been in a high sector rotation phase really since COVID. We've been seeing one month, one sector's hot, the next, it's the worst. We've got a hot list that we track, and it goes precious metals are at the top, then they're at the bottom, and oil went to the top, oil went to the bottom. I mean, they're all over the place. And right now we've got a lot of different sectors just chopping around. And so the news and what's going on is affecting investors. And they're really kind of, it's like water sloshing in a bathtub. It's going back and forth between one sector or another. And so that's what news and economic data does. But really the key I like to follow is price and just follow the bigger trends at play.
So let's ignore the uneven economic data, the news, the geopolitics of it all, and focus on the tape. Is the tape telling you that this is a healthy bull market right now, or do bears have a case when they call this a liquidity-driven rally in a handful of concentrated names?
I think the bears have a very good case. I mean, I'm generally pretty bearish on the market because I like to be protective. It doesn't mean I'm short the market or I'm betting against it. I do feel like there's a good case for the bears in terms of this really is a couple sectors dragging the whole market higher. When you look at the equal weighted S&P 500, it really is putting in potentially a double top. It is not hitting all-time highs and screaming higher. It's kind of flirting with the double top. And technology has really done all the heavy lifting. And so that to me is a bearish sign. The thing is, technology is like the biggest sector, and we're in a feeding frenzy. People still want to pile in, they want to invest in the space. It is a very young space. So technology really could pull this market higher for who knows how long. When we get into these kind of euphoric bubble phases, that's where they somewhat become dangerous if you try to bet against them, because this market could just keep running higher. Technology just drags the S&P 500 and the NASDAQ up and up and up. And so you really do have to follow price. But to me, it's a sign of weakness when one sector is doing all the heavy lifting, the rest is kind of just, lagging and falling behind.
You're warning that the market could keep going up even if the bears have a legitimate case. And we've seen in other episodes how markets can go further than what the equilibrium should be. So when you're looking at your charts, what are some of the technical signals that you're seeking right now to show signs of exhaustion or maybe this bull rally failing?
Yeah, I think the thing to start looking for is the tech space and the small and the micro cap stocks, which have been performing very well, are they starting to slow down? And typically money that is, in the financial system, money managers and advisors, they pretty much have to stay invested, but they rotate where their money goes. And so I think the easy money has been made in the tech and the small caps over the past month and a half. And we're just starting to see money become defensive. They can't just move to cash, most of these people. They reallocate their money, they reinvest into another asset or asset class, which we're seeing utilities. I think we're going to start to see utilities, consumer staples, healthcare. I think the dollar is starting to firm up as well. Now, it's still a little early, but I do feel like, and we have seen early signs of money flowing to those pockets. And so when utilities, for example, like XLU ETF starts to outperform the S&P 500 and the NASDAQ, that is almost always a very strong early warning sign that we're going to see like a 5 or 8% correction in the S&P 500 and the NASDAQ. So that's what I'm waiting to see. Is the dollar going to firm up? Are utilities going to start to actually outperform the stock market on a weekly basis? And that is a really good barometer of where big money is moving and looking for protection.
So in the short term right now, we're seeing this upside chasing of return in the AI space. We haven't seen the rotation to utilities or staples just yet, but the options activity is kind of beginning to move back towards meme era behavior. From a technical standpoint, how late cycle does this behavior usually appear?
Yeah, I mean, we're seeing, like, I look at the total put call ratio and it's at a very low level. It's been low enough, long enough, like over the last 10 or 20 days, everybody's really bullish. And when the put call ratio on average is down at this level, not always, but it's a very good barometer that people have sold their shorts. They've got rid of their inverse ETFs and now they're long. They're buying options to leverage their way up because they're bullish. They're not fearful. The VIX is low. And so to me, the options market is kind of giving us that one of those early warnings that, hey, people are overly bullish. There's been a huge move. Everybody's excited about AI and technology. They're piling into all kinds of different ETFs. There's a new ETF out there, Chris, that's called, the symbol's DRAM, DRAM.
Yes.
And it's the memory, and it's gone up over 100% in the first like month and a half that it's been trading. It pulled back about 12% yesterday in one day. The volume went from obviously nothing to, I think it was either 48 million shares or like 80 million shares. I can't remember, but that is like clear signs we're in a feeding frenzy. When we get into these euphoric moves where it's super easy, just jump in and you make 5% every day, kind of like silver did at the beginning of the year, it usually ends with a little bit of an elevator shaft kind of moves straight back down. So based on the sentiment of the money flowing into these pockets, I feel like we're in this euphoric little bit of a bubble phase. And the question is, where is the peak? But you need to know, I think the easy money on this big run, like semiconductors up over 50%, that was easy money, right? Now it's like, how do you protect it? How do you keep those gains? And you got to navigate your positions, manage them.
So when we take a step back here and look at the full picture right now, inflation uncertainty, deficits, AI, central banks, what do you think the markets are misunderstanding about the next phase of the market cycle?
It's difficult. Everybody's got their own ways of viewing the markets and their own time frames and how they invest. I think generally the majority of people are just kind of buy and hold, right? And they just,
sure,
the markets climb this wall of worry, and that's what we've been seeing. The market keeps going up and everybody's really worried. A lot of people are worried the market is going to top, but they stay invested, most of them, and they really just kind of sit on their hands and they ride the kind of stock market roller coaster as an investor. Overall, I mean, I think people just get caught up in the news, and those who are active generally, make decisions based on news events and wild price swings. It doesn't take much to get people and give them anxiety and give them FOMO. For example, in the last few days, we saw silver have a big pop. And instantly everybody got anxiety. If you weren't long silver, you're like, oh my gosh, it's taking off without me. I got to get in. And everybody got all excited. But silver does that, right? And so that's the phase we're in. Everybody instantly thinks as soon as something pops and has a big move, they think it's the start of something and they pile in very quickly. And so people are jumpy. And that's because they keep seeing things pop and run huge. And they think they have to get in to try and take advantage of it because they think everybody else is making money but them. And so we're in this jumpy environment, and that's like indicative of a market top. They'll jump at anything that moves quickly. Like precious metals, I mean, gold hasn't broken out into an uptrend yet. Miners haven't. And silver is that wild card. And silver loves to do these fake outs. It'll pop and drop. It'll shake you out. I like to wait for the whole precious metal space to kind of confirm, hey, they're all in an uptrend. This is the real deal. It's not just the most volatile of the metals, giving a little bit of a shakeout and getting people sucked in when that trend may not technically have started from the whole precious metals tide kind of going up.
If you find yourself trying to keep up with the Joneses based on your market trading activity, Chris, then you're probably nearing a top in the market. This has been a great conversation. I really think you highlighted the dissonance that a lot of folks feel right now when they see the charts where things are going up, up, up. They don't want to miss out, but are there legitimate reasons to keep trading higher? Can it run? Sure. You know what? Chat, let us know below. Comment below. What do you think? This has been another episode of Trading Trends. He's been Chris Vermillion with the Technical Traders. I've been Chris Vecchio with Tasty Live. Thanks. Like and subscribe for more videos. We'll catch you next time. War, debt, commodities, those aren't just headlines. They are defining features of cycles. And few investors over the past few decades have spent their time studying those cycles than Jim Rogers. He's called commodity super cycles to a warning about the long-term risks of debt and currency debasement. His framework's rooted in history, not emotion. So the question is now, in a world of escalating geopolitical tensions and late cycle markets, what is the Jim Rogers of it all seeing? And how is he positioning for it? Better yet, let's just ask him himself. Jim Rogers, welcome to Trending Trades.
I am delighted to be here, Chris. Happy New Year.
Thank you very much. And thank you for joining us from overseas. I know you're traveling right now. So let's just go with that intro here. You've spent decades studying these kinds of cycles, debt, currencies, geopolitical stress. When you're looking at today's environment, the rising conflict, the elevated debt levels, and the policy uncertainty, where are we in this super cycle right now? And what are the signals are you relying on to make that kind of call?
Well, I have no idea. I make many mistakes, but I will say that the U.S. market has never had such a long period of upward period without a problem. So this is the longest in American history. I have sold out of most markets in the world because I know that this is one of the few times when everybody is doing well. In the past, that has historically been a time to worry. So I'm worried, and I have a huge amount of cash in US dollars.
Sure. And you've mentioned in the past that war doesn't cause the bear markets, but more or less exposes the underlying excess that's built up. So when you're looking at today's equity markets, it sounds like you're seeing those excesses built up. What's telling you that the unwind has already started that's pushed you into cash positions?
Well, just that everybody, nearly every stock market in the world is doing well. That has rarely happened in my lifetime. But when it has happened, it has been a time to be worried and to get out. So it hasn't, everything's okay now. But if you ask me, the end will probably come soon.
Say, I hope not this month. We only have about 4 days left. I have to put some positions on. But so generally speaking, in periods like this, you have typically focused on assets that survive instability, not just perform in terms of growth. Within the commodity sector today, how are you distinguishing between trades that are already priced in for conflict versus those that still may offer upside over the next 6 to 12 months?
Well, I know very few that can offer any upside. Eventually, I hope I'm smart enough to sell short. I do own silver. I do own gold. If they go down, I hope I buy more. But Chris, as I look around, everything is doing well. And usually when everything is doing well, you should ask questions and start worrying. So I have started worrying and raising a lot of cash in US dollars, not other currencies, US dollars.
In US dollars, I think is the key turn of phrase there. Why the dollar and not anything else?
Well, the US is the largest debtor nation in world history, but everybody thinks that the US dollar is a safe haven. And so when the turmoil comes, everybody will go to the US dollar. The US dollar will have another leg up, I hope. And if so, I hope I'm smart enough to sell.
Fade the trade when it comes around. All right. Well, you've said just a few seconds ago that you own silver. You know, are you the kind of person who wants to add it on weakness here? Even though this is short-term speaking, it's increasingly momentum driven. Has faced a fair degree of difficulties. How do you balance out your long-term conviction with the reality of the short-term weakness, even around the Iran war?
Well, I'm not very good at market timing, but I know that throughout history, you remember Jesus Christ? Jesus Christ was sold for 30 pieces of silver. That was hundreds of years ago. Silver, even then and now, has always been a great store of value, great monetary sense, and gold as well. So I hope that I'm smart enough to always own silver. And if it goes down, then I will buy more. I know that silver and gold will always do well, especially in bad times.
I find it interesting that you have that long-term faith where you're not looking to just time the market, but you're looking to build into a position over time so that you do have the exposure there when ultimately this event comes to pass. Speaking of this event, is it going to be U.S. debt that tips the scales as a structural issue? You keep coming back to this even throughout this conversation.
Well, I would suspect so. I mean, the U.S. is the largest debtor nation in the history of the world. It gets its higher and higher every day, every hour. So, I mean, so far we've learned to live with it. But always, historically, when somebody gets gigantic amounts of debt, eventually it causes problems. I don't know when eventually is, but I hope I'm getting prepared.
I guess that really underscores it. So if everyone's doing well right now, let's imagine we're going to go into a period where we're not doing so well. Is this going to be the straw that breaks the camel's back with respect to U.S. leadership and accelerate the trend change towards India and China, which I know have been long-term plays for you?
China's the only country in world history that's been on top 3 or 4 times. Rome was great once. Egypt was great once. Britain was great once. But China's been on top 3 or 4 times. They're rising again. Who knows? I don't know. But I do know that they're rising again. And I don't know why they've been able to do it several times, but so far they have. And I do know they're rising again.
Jim, we're having this conversation at the end of March 2026, so the first quarter is almost done for this year. For the rest of this calendar year, what's the number one issue that investors need to be concerned with? Is it the war? Is it the fact that the Fed won't be cutting rates anytime soon? Or is it something else that we're missing here?
Well, what I think I see is that nearly every stock market in the world is making new highs, in many cases all-time highs. Chris, that's great. Everybody's happy. But I know that when this happened in the past, it has been a sign you should ask questions and you should worry. So I'm asking questions and I'm worrying. I'm often too early. It's not my first time being early, but it's better to be early than to be late, in my experience.
I hear you there. My fraternity's expression was early is on time and on time is late. So there you have it. Jim Rogers, thank you so much for joining Trending Trades today. Jim Rogers, of course, the inimitable investor trading through these cycles over how many decades. You, of course, can get more interviews like this here on Tasty Live. Like and subscribe for more. Good luck trading.
Welcome to Trading Trends. I'm Ilya Spivak, head of Global Macro here at Tasty Live, joined by something of a legend. Peter Grandich is with us. He's been in markets for, over 40 years, I would say, starting in the mid-'80s, had some very big calls on the crash in 87, the one in 2000 as well, and wrote an excellent book, Confessions of a Former Wall Street Whiz Kid. If you would like a narrative that's similar in lessons, but much more positive in ending, to reminiscences of a stock operator, this is a great book you should check out. Peter, welcome.
Oh, thank you for having me.
I wanted to pick your brain a little bit about the current market environment, and in particular, what's going on with stocks around the breakout of this Iran war. Of course, we have a very curious situation here. where it seems like stocks have decided the war is over at the beginning of this month, but no other asset has. So all of the kind of war trade dynamics, higher oil, higher yields, weaker gold, stronger dollar, they've largely held up. Stocks have decided that the war is over and not only erased the war trade, but have actually pushed to record highs. What's going on here? And is this just a rocket ship that's going to keep going?
Well, I think the single biggest factor that has changed over the 42 years that I've been around is that it has been an argument which has served bulls well that no matter what decline happens for whatever reason, if you buy it, eventually you make money. And quite honestly, until that doesn't work, it's understandable why somebody could remain bullish here despite a war, despite numerous bearish fundamentals. Perhaps, certainly in my view, the most bearish fundamentals in the 42 years that I've been around. That's probably the single biggest factor. And so then when you had a president who's done a marvelous job of managing news flow, creating a perception that maybe you don't have to be as worried as possibly as we would have been otherwise. That and also the fact that, let's face facts, passive investing, which still continues, is really one of the biggest bullish aids to this bull market. Money continues to flow in net positive. It needs to be put to work. Managers really don't have any discretion sheet. They have to buy certain stocks. And that has been an overall bullish factor. Yet you would think from an old person like me that remembers wars were normally not good for stock markets, it's been a level of high complacency as well that has underpinned this move so far.
I think complacency is an excellent way to describe it. Obviously, the major kind of sticking point in this whole situation has been the idea that if you have crude oil stuck at these levels, that's probably inflationary. And against that backdrop, we've seen yields go up, we've seen gold come down, we've seen the dollar go up. We just heard from the Fed yesterday basically forswear the possibility that rates are going to get cut anytime soon because of this inflation risk. And so I wanted to talk a little bit about something you've mentioned before, which is the risk in corporate bonds. Now, higher interest rates make for higher refinancing costs on borrowing. What's going on in corporate bonds that you think is a particular vulnerability in this kind of an environment?
So we've talked recently of late about a private credit crisis or at least a concern, and the number that's tossed around is somewhere around 1.7 trillion to maybe 2 trillion of amount. And that may be a problem because people are not going to be able to get the money back as maybe they thought they were supposed to. I think people misunderstood minimally, probably more on the investor's fault than the salesperson, which is unusual for Wall Street. But the bottom line is, but when you think about the corporate bonds, just triple B rated bonds, that's the lowest level of corporate paper before it becomes junk, is almost $5 trillion worth. And it's about 5 times larger now of a market, just triple Bs, than it was in the last major financial crisis back in 2009. So when you have that concern and that group by this much can fall into the junk status, and we have a U.S. Treasury that needs to go in and raise over $10 trillion in the next 12 years on refinancing that debt, a credit crisis, and corporate paper, it's not surprising that interest rates are not going low as many people had expected because there's a great demand and we're shrinking the audience. Foreigners are no longer the buyers, whatever they can get of our debt, particularly on the Treasury end. And so therefore, the corporate bond market can play a negative role if we see a really sharper downturn in the economy. And that will eventually, as much as people can't perceive it, that will impact the stock market as well.
Absolutely. I wanted to talk a little bit about something you've mentioned in your book, which I think is an excellent narrative of what happens on Wall Street, in the 80s and going into the 90s, and tells a story that I think all of us that participate in markets can identify with, where you catch the trading bug. It is a whirlwind kind of a thing. And over time, you learn how big calls and kind of swinging positions really ought to give way to a more circumspect, risk-oriented, management-oriented approach. Of course, it seems like all of us have to learn these lessons the hard way. It seems there's no way to do it otherwise. So I wanted to look at how you think about managing in this current environment. You mentioned in the book that process beats prediction, especially in volatile markets. And needless to say, we're in those kinds of markets. What does that mean for you right now?
So, as you noted, the name of the book is Confessions of a Former Wall Street Whiz Kid. When it was first written, it was Confessions of a Wall Street Whiz Kid. But after you made and lost millions, not once, but twice, I didn't think I should call myself a whiz kid anymore, even though that was a title given to me many years ago by the media. The process I kind of learned because in year 2000, I began working with professional athletes from as a financial advisor as well as Christian sports ministry. And one of the things I noticed about the athletes, and I won't name him, and know he's very popular, he really stunk at golf. But every shot, he went through the same process before he took the shot, where most of us go up one way and then another way. And processing and preparation, if you look at any success, whether it's on professional sports, artists, whatever, they kind of go through a preparation. And I think that's kind of critical. Trading or being long-term investing, there is a process. Now, the challenge, and you and I, before we started recording this, talked about is people's duration now has shrunk so much. And the one change for me over 42 years is there's an overwhelming amount of information that comes out in seconds. And quite frankly, computers can react to it faster than the human eye or person can be at all. But some of the main processes are still important. There is a mechanism. There is guidance you have to stick to. I'll give you just a real quick example. I worked with the New York Giants for 13 years, and I was able to see how they went through a typical week. And the coaches always did the same thing, whether they lost or won the last game. They came in, they looked at film, they went through certain things, they called in players, they reviewed stuff, and they built a plan. I found even among traders now, more people are doing it from the seat of the pants, even though we're in such a computerized area. The human emotion normally is not a good time to make tough decisions on. Some of the worst decisions people made can tell you was at height of emotions. And so one of the processes I think one needs to do, especially in trading, is to remove the human emotional aspect. That's why when somebody tells me they're a technical trader, it better be 100% technical, because once you start adding fundamental thoughts and start to think, well, maybe that line isn't really going to work this way. No, when it comes like this and it says it's like this, we got to act like this. And I think that's some of the challenges now for people, that they've tried to take a major shortcut to things that take a lot of time and, like you said, a process to develop.
What's up, Tasty Nation? Welcome to the newest series that I'm hosting called Options in Action. I'm really excited about this because we're going to take some of the old whiteboard videos where we talk about the basics of call options, the basics of put options, and all kinds of concepts and strategies, and we're going to throw on a level 2 to it. So what I mean by that is, if you haven't checked out the beginner content, check out the old whiteboard series. Today, we're talking about call options. So if you are familiar with call options, great. If you're not, check out the whiteboard series on call options available on YouTube as well as tastylive.com. But we're going to add another layer to that. We're not going to talk about what call options are. We're not going to talk about the definition of call options. We're going to talk about the practical utilization of call options and how I use them today. So we're going to talk about the long side and the short side. So let's start with the long side, buying calls. if you're familiar with call options, you know that buying calls can be a high reward, low risk strategy in terms of how much money you can make relative to your max loss, which is simply your capital outlay or debit paid. But there's a couple of nuances with call options and long call options that I wanted to talk about. And really first is the question of, if I were to choose, let's say if I wanted to be bearish or bullish, what strategy would I choose? Would I choose buying calls to try and make a profit, or would I choose buying puts to try and make a profit? And buying puts and talking about put options is going to be the next video that we talk about. But just to give you a quick answer, it's absolutely going to be buying calls. That's not only because we tend to see upside drift in the markets over time, but objectively speaking, you can make more money on an upside move if you're buying an out of the money call option where you're buying a call that's above the market price and the market moves to your strike compared to the downside. If you're playing for a downside move in the market, there's one key aspect of the market that really makes a big change in that options price, and specifically a lack of profitability to the downside. And I'm going to show you that today. So we're going to look at the Tasty Trade platform, and we're going to talk about and really show you a real life example of the profitability aspect of buying a call versus buying a put option. And the one key factor that I referenced in the intro is the stock price or the index price or whatever the price is that you're buying these options against. When you look at the Black-Scholes model, you will quickly realize that it is complex. I don't need to know the Black-Scholes model. I just need to know that there are certain inputs that go into the Black-Scholes model to produce options prices, and one of those inputs is the stock price. So S&P 500 has had a massive rally from the lows. We went from 7,000 in SPX to basically 6,300 and then all the way back to 7,000, and we did it in short order, as you can see. Just an absolute face-ripping rally here. So what I want to show you today is I want to look at, let's say you perfectly timed this sell-off and you perfectly timed the rally. What would have been your profit potential on a downside move if you were buying puts versus buying calls? So let's look at buying a put first. When we look at buying a put, we are playing for a downside move, and I'm going to show you very quickly that you cannot make as much money on the downside from an out of the money to at the money move buying puts as you can with out of the money call options. And again, the reason why that is because the stock price is decreasing on the way down. And what does that do to all options around that new stock price? It decreases the extrinsic value, all else equal. Now, of course, in the S&P 500, if you get a downside move and you get an implied volatility expansion, that's of course going to help the appreciation of an option on the downside, but the stock price decreasing really dulls your profitability. So again, SPX went from 7,000, we'll call it, all the way down to 6,300, and it vaulted right back up. If we look at the Tasty Trade platform and we right click on this, you can see view option and chart. I'm going to view this option, and we're going to look at the end of February, beginning of March. This is really when the market started tanking. And as you can see, this option in June, we're going to go out to June and we're going to give ourselves a lot of time. So we're not going to cherry pick the near-term contracts that can be much more volatile. We're going to go to June and we're going to see, okay, at the low, so before the market was selling off, the SPX 6300 put was trading for about $10,000, we'll call it. You can see here, this is kind of the low region, around $10,000. And at the peak of the sell-off, at the end of March, this option got up to $26,000. Now, that's a great return. If you were playing for that move and you caught it, that's a huge return. However, when you look at the call side, you are going to see a much bigger appreciation in that option, and we're going to show you why and talk through why. So again, 10K to 26K, that is about a 2.5x in terms of the premium you paid. Going back to SPX and just looking at the June cycle, 7,000 call strike. Got to scroll all the way up here because this rally's been absolutely insane. If we look at this option, and we can even, we looked at out of the money options, let's actually go a little bit higher and let's get rid of this intrinsic value of 20 points just to keep things fair. So let's look at the 70-30 option that's still out of the money today. Let's right click on that and view the option in the chart. So the first thing that we need to realize is, okay, when the market was selling off, we're looking at a 7,300 strike call, or a 70-30 strike call. This option was trading for $2,500, $3,000. Now, the option was significantly out of the money, and the market had put skew in this cycle before this option was purchased. So put skew, or skew in general, just means that the options are more expensive on the skewed side. And if you're buying those options, you're not going to be able to get that real super strong appreciation in the price because you're buying an option that's already expensive. Now, looking at this, at the very low, at the end of March, this option was trading for about $3,000, we'll call it. And into this rally, you can see here, we got as high as today's price of $20,000. So this is almost a, 7x compared to a 2.5x on the downside. So even if you had purchased the put and you timed it perfectly, you did make a ton of cash. But the call option in terms of a percentage increase was significantly more. And it doesn't matter what stock you look at, doesn't matter where you're looking for this kind of stuff. If you evaluate perfectly timing a move to the downside and then evaluate perfectly timing a symmetrical move to the upside, in this case, it's perfect timing because SPX dropped and then it rallied. We have this nice V bottom pattern. We can quickly and easily analyze this. But again, this is to show that if you are buying call options, longer term call options, you can make much more on a percentage basis than downside puts. So now let's take that a step further. Let's say that 40% of the time I'm correct, or 50% of the time I'm correct. You're going to have a lot easier time having a net positive P&L if you assume that your win rate is 50%, but you can make 6x, 7x on the call option, where you can only make 2x, 3x, maybe 4x on the downside with the put option. So your max profit potential is, of course, unlimited with a long naked call here, but this is just to show that I don't think we talk about this enough. The value of an increasing stock price and how that affects all of the options around that increasing stock price. And again, to quickly answer the question, if I were to choose to buy calls or buy puts, it's going to be buying calls to try and, time a move or make as much as I can on my debit paid, simply because the Black-Scholes model helps us out into upside moves. And this is even into a volatility collapse. We saw the VIX drop, we saw volatility futures drop, and even with that, you're seeing a much higher multiplication potential on an upside move in SPX, or an upside move in general on anything. Because when you look at a higher priced product, the at-the-money options are going to be more expensive than a lower priced product, all else equal. So that's the long side. Buying options, buying calls, you might ask yourself, what strike do you choose? What expiration? That's where I like to say you get what you pay for. So another good example of a naked call option that I actually own in this portfolio is in Nike. So Nike, as you can see, I own this call option all the way down here, 645 days out. And a really quick and dirty answer is, Nike is at decade lows. The last time we saw Nike sub 50, it's at 45 right now, was almost 10 years ago. We have multiple years of price extremes here in Nike, and the further down we go in price, again, same story here. The further down we go in price, the cheaper these call options become because the stock price is getting depressed. So at the same time, I look at this implied volatility and I'm like, okay, we have a decade low price in Nike. Nike's at $43. These options are going to be relatively cheap anyways, just because of the depressed price point. And you have a low implied volatility here of 40%. So I went out here and I looked at the 60 strike and I was like, okay, I have 2 years for this to work out. I can buy this 60 strike by itself for $500 and it's within the expected move. And really a 15-point rally in Nike over the course of a year or a year and a half is well within the realm of possibility, at least from my assumption. So my whole thing is like, yes, buying calls, near-term calls is a high risk, high reward situation. If you want to reduce your risk and increase your probability, think about considering longer term calls. Again, you get what you pay for. The longer term your option is, the less implied volatility value you're paying for, and the more time value you're paying for that option. So this call here, trading for 500 bucks, there is a very high probability that I can close this out for some kind of profit over the course of a year or year and a half before this option expires. I'm not planning to hold this option to expiration. I'm just trying to take a chunk out of the move to the upside if we get it, and I'm giving myself a ton of time for it to work out, and we've got a very high probability of P50. This is a really cool feature of the tastytrade platform, the probability of reaching 50% of max profit at any point before expiration. In this case, it's using the debit paid. So paying $5, making $250 on it, high probability that we get there because of the time allotted to this position. And just another real quick way to show you that you are paying for a lot of time value relative to implied volatility value is to just analyze the days to expiration relative to the expected move in these cycles. So we're looking at May, 30 days to go. You've got a $2.60 implied move. If you go to the 63-day cycle, and if implied volatility were linear, which it's not, you should expect to see, since we're doubling the time here to 63 days, I should expect to see my 260 or 270 increase to 525, 530. So I'm looking for, if implied volatility was linear, in this example, I'd be looking at a 260 implied move for 30 days and a 540 or 530 implied move for 63 days. We're not seeing that. We're seeing 63 days representative of a $4 implied move. So because it's not one for one, it's actually less implied move as you go further out in time. That tells you that your ratio of time premium relative to implied volatility premium is lower. And if you're buying a call, that's what you want. You don't want implied volatility value dragging on your profit potential. You don't want a high accelerating drag on your extrinsic value premium. And if you even double this again, go from 63 days to 120, your $4.40 does not go up to $8.80. It's actually $7.60. So again, the further out in time you go, the more time value you're buying, the less implied volatility value you're exposing yourself to. And it gives you just a lot of time for you to take a chunk out of that option if you're buying calls. Now, real quick, selling calls. I don't like to sell naked calls in equities. I think we see this move all the time where, markets are down, they're depressed, and then you get an absolute rip to the upside like we saw in Microsoft, for example. Microsoft is on a tear. It hasn't stopped rallying over the last couple of days here. And these are the things that I don't like to be involved with undefined risk to the upside. Now, if I bought a call and I'm selling a call against it to try and hedge, that's totally different. But selling a naked call in an equity, I think the reward is just your premium paid, and your risk is infinite with unlimited upside risk and how high a stock price can go. So I don't like dabbling with short calls by themselves in an equity. I do like pairing them with 100 shares of stock, getting into covered calls, or getting into, again, calendar spreads, diagonal spreads like we talked about before. But another thing to consider with short calls is just the fact that same kind of story when we talked about long calls in SPX and how you can buy them more cheaply into a big sell-off. If you have a rally like this, you can actually sell the calls at a higher premium, especially if there is call skew. So Microsoft, currently trading at 418. Let's just round it to 420. May, 29 days to go. If we look at the 400 strike, 20 points out of the money, and we look at the 440 strike, 20 points out of the money, you can see in this example, they're trading for about the same value, right? 440 trading for about $1,000, 400, and the 460 trading for just over $9. So when you see this kind of premium on the upside, I'm more inclined to want to sell it against 100 shares of stock or against a call option because I'm making the most of the premium I'm collecting relative to the profitability I'm capping on the upside. In SPX, you're going to see a very similar thing. Now, interestingly enough, with SPX, short calls, the further out in time you go, the more interest rate premium you're going to get on the call side. So we used to have an environment where there was only put skew in SPX and SPY. The calls were really cheap because you had a zero interest rate environment. There was no interest rates priced in the call side. Now, you don't see that. So if we are to look at, let's say, a longer term call option, let's go to July, for example. Let's just see, we're trading at 7,000, we'll call it. Let's look at, a 7,100 6,900 here. Okay. So the 6,900, 100 points out of the money, trading for 15K. Not too shabby. But the 7,000, the 7,100, trading for 20K. So you have clearly a call skew being priced in here, and it's not necessarily skew, it's more about the interest rates that are priced into these options. So another cool way, if let's say you have 100 shares of SPY, if you sell a call option out
Hello, everybody. Welcome back from the Memorial Day weekend. Tim Knight here, and we've got. I'm having a weirdly not horrible day. It's faint praise, I know, but this was a strange weekend from a futures perspective, because the market seems to morph into one in which war news matters, but if the news is bad, then the market goes up. And if the news is good, the market goes way up. It's one way, no matter what, because we saw that this weekend. There was this announcement, rumors, progress was made. How did he phrase it? There was some term, but basically the gist is we're just about there. And they've been just about there for months now, but they're just about done. And you'll be hearing about the deal real soon now. And so when the markets did open, Bitcoin flew up thousands of dollars, and when the futures markets opened, they were ready to fly too. But in the midst of all that, after all that chatter on Saturday about how we're just about wrapped on this thing, then the bombs started going again, and the fighting and so forth. What happened? Well, in a rational world, the thing would completely reverse and everything would plunge. No, it just was up a little less than it was in the first place. So I guess there's this underpinning idea that they are working on it. So and like I've said over and over again, if they just keep doing this, the market will go up forever. Just keep saying we're almost done. The only bearish thing that can happen would be like, we're done, and they all get on TV and hold the notarized document up and it's complete. That'll be the sell the news moment. Until then, as long as they can just keep saying 99%, 99.1%, 99.2%, it'll just keep going up, just like today. It's not uniform. The NQ and the RTY are up quite strongly, like up 1 2/3% each. The ES is up also, but about less than a third of that amount. And the YM, the Dow, is actually down hundreds of points. So, bit of a mix. Like I said on Friday, chips and ships.
is what it's all about. Microchips and rocket ships, same deal. SpaceX IPO, I guess, is 3 weeks away, and it's all anybody's talking about. And you've got a mix of most people saying that these are insane valuations, and there's a portion of people which are saying that, oh, this is an insane opportunity even at these prices. So it's going to be a really interesting IPO, probably the most interesting IPO of our lifetimes. It's going to be mayhem. Really, really cool stuff. And I will, as I've alluded to, definitely be, I'm definitely invested in that and have a stake in that. And so I'm excited to see what's coming. And I, like a lot of people, are of the mindset of like, I'm getting out as soon as I possibly can because there are lockups galore. And I will be beating a path to the exit, but that's just my nature anyway. We might as well look at some charts together. It's been a few days. So the cubes, lifetime high. How about that? Same usual suspects, as they say. Everything's just blasting higher. Whether it's Micron or AMD or anything else, it's just mayhem, crazy. So here's the cubes. There was our weakness there early last week. Just a couple of days of a little bit of selling, and then zoop, up it goes. AMD, just one example of the kind of perma-rising stocks happening. Another lifetime high, another $37, accrued 8% plus. I won't even show you Micron. It's even more extreme. It's just jaw-dropping stuff. And short amount of time, this is just, it's gone up hundreds of percent in a few weeks. And I'll just emphasize, as I so often do, these are not micro-cap pink sheet stocks. These are like huge companies going up 400 and 500% in a few weeks' time. Why not? You know? There at some point will be an unraveling of this whole thing that will be epic. It could be a decade from now. It could be next week, probably a decade. But it is also intertwined, interlocked, codependent. Once that first thread unravels, it's going to be like really interesting to watch too. As to when that's going to happen, very few people want it to happen. The powers that be are going to keep it from happening as long as they possibly can. And as I wrote over the weekend, I don't think any bear market of any size will possibly start until probably three things happen. One, the mega IPOs get out of the way. Two, it is abundantly clear that interest rates ain't going down for a long time. And three, and this is probably the weakest one, this is the one I'm willing to give up easiest, until the midterms are behind us. If 1 and 2 can happen before the midterms, and if SpaceX shocks everyone with how lame it is, and if rates just keep chomping higher, people aren't going to wait till the midterms. Because keep this in mind, there's this, oh boy, I'm getting talkative again, I'll run out of time, but there's this supposition that, well, the market won't go down because such and so doesn't want it to go down. Oh yeah, tell George Bush that back in 2008. You know, do you think he wanted the market to crash? Or tell it to, I guess it was Bill Clinton back in 2000. You know, what could he do to stop the crash? Nothing. Yeah, he can jawbone, he can prod the Fed into doing stuff, but there comes a point where not only are you helpless, but all the stuff you've done before to prop things up comes back to bite you. And it's much worse than before, which is why you get a NASDAQ down 82% after the internet bubble popped. So, yeah, but those are my three things. And the third one, like I say, I'm iffy on. But what I certainly will say about that third one is the impetus to keep things propped up will plunge after the election, no matter what the results are. So there's that. EWY, South Korea, lifetime high. What a surprise. 10% plus rise. It just keeps raging higher. Shocking stuff. And of course, fear has completely left the building. Here's the UVIX, down 6.4%. It's a leveraged fund, so it tends to go down anyway. But this was the ramp up to the war, and you got a brief bout of excitement. And since then, this thing has crumbled by about 60%. As far as the spider goes, as I said, it's up, yes, but it's up 0.5%. So less than a third of what, say, the NQ is up. So there it is, but nothing to write home to your mother about. It's just kind of incrementally inching higher each day. In contrast to, say, the IWM, which is 1.71% rise, blasting higher. And as I keep saying, the gap closure, which actually took place twice, here and then here, is clearly support. And if we ever break that, it'll be a fairly big deal because that's proved to be very strong support. As far as the diamonds go, this is the odd man out. He's actually red. The diamonds are down more than 1/3%. And this was the former lifetime high. We had beat it on Friday, and we beat it again today, but it's not exactly holding up that well. We've got a bearish engulfing pattern here, and if indexes do start getting weak, which seems like science fiction now, this probably will be the rush quite quickly lower. What else is cooking out there? Well, crude oil, with this talk about, we're really close to a deal. Crude oil is down, but not nearly as much as it was. It was down like 7% at some points during the weekend. Now it's down, but only 2.77%. I went ahead and covered my energy shorts this morning. APA, SLB, HAL. They're not great patterns, and I just took my profits and went home on that. Although I will say regarding XOP, remember back last week, we had this gap, went up, sealed the gap, pushed a little above it, but since then it's been blank, down we go. And all this, of course, is the relaxation from those tensions about, the war. Let's see. I'm going to throw a wallet at my dog, one of my dogs, to tell him to shut up. It won't work, but we'll see. Okay, moving on. EFA. This is the Equities Outside North America Fund, kind of a clumsy term for it, but the real term is a lot longer than that. And this is an interesting critter too, because it sealed its price gap up. This was a very substantial price gap back in the days when stocks used to fall. This was the gap created right when the war began. So this was the February 27 before there was a war, and this was the Monday after the war started. Big gap. We sealed it for the first time today. Okay, so there's that. But even though it's up, we're up about 1%. It's not exactly following through. So we've got a little red candle there. So another thing worth keeping an eye on to see if this just slumps below that line, because it doesn't even deserve the moniker breakout. It just sort of sealed the gap up, and it's just kind of hanging around there. As I mentioned, it's not. I was sort of bracing myself for today based upon what we saw this weekend. But two things helped. One, I've been light. I continue to be light. And two, some of these picks are working out pretty good. It's not like, as I glance over here now at my positions, most of them are down. And some down pretty decently, especially on a day like this. I'm not showing it today, but like DraftKings, for example, DKNG is down almost 5%. But by way of example, here's Amazon. Amazon's down almost a percentage point. That's pretty cool, considering the NQ is up hundreds and hundreds of points at a lifetime high. I like that exception. I mean, that is underperformance. So I've got my puts range from anywhere from September to more and more January of next year. So scads of time, Amazon is among those. So Amazon's slipping in complete contradiction to tech stocks in general. American Express is also down about 0.25%. It's been slowly sinking. My old friend Meta, let's go back to charts. I hate when it does that. I'm not trading this. Italy. Okay. Hope we haven't lost it here. Waiting for the chart. Sooner or later. I'm on a fiber optic cable, believe it or not. It's not like I'm on a 300 baud modem. Sometimes things take time. But Meta is, there we go. Meta is down 0.2%, just a little bit hanging out there. And these are not dramatic moves, but I will happily take them. On a day like this, any red is fine by me. And the other thing I want to point out is, since we're heading on to these IPOs, let's look at CBRS. This was the last big IPO everyone was chatting about. Look at that. What a mess. That's Cerebus. Not only a very hot IPO, but a semiconductor IPO. What could be hotter than that? But look what it's doing. It's down like 40%. Just eyeballing this real quick. Approaching 50%. It stinks. But that's what it's done so far. And this, I mean, if say SpaceX looks like this after a couple of weeks, you're gonna have some people sweating. Back to the thing about chips and ships, rockets continue to be hot. Although I got to tell you, I composed this list early in the day. LUNR used to be blasting higher. Look what it's doing now. It's a huge bearish engulfing pattern. So I'm not sure what point to make about this because it was up a lot earlier. But this sort of SpaceX proxies, whether it's PL or RKLB or what have you, they've generated very strong. For some weird reason, maybe something peculiar to this one company, LUNR is slumping. Planet Labs, though, PL, is up double-digit % to a lifetime high. As is so often the case, I'm getting close to the end of my time here, but let me just wrap up super quick. Bitcoin, God bless it, it's down 1/100 of a percentage point right now. It was up quite strongly over the weekend based on the news, but it has thrown that off. And the key is we got to break this level right here. This is what I'm looking for. Hasn't gotten quite there yet, but it's encouraging to me that this is just shrugging off this news after having been up thousands during the weekend, because this is a big short of mine. But if we look at IBIT, the gap was not violated. If we look at BITI, which is the upside down version of that, the inverse, it was nowhere even close to violated on that one. And last one, bonds, TLT. These are up, but modestly 0.43%, and the gap was not violated. It's still intact. And I actually added to this position today, which is September 30, $83 puts on TLT, because I think bonds will eventually lead the way. That is it. And shorter week, of course, this week. That wraps up Tuesday's show. I'll see you tomorrow. And I hope you're doing all right, and I hope you had a relaxing holiday weekend. I'll see you tomorrow. Bye-bye.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better.
In fact, I've never seen anything like it in any corporation in the United States.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Investors Business Daily raves about us. Stockbrokers.com says we're best in class for futures trading, and Broker Chooser thinks we're pretty great too. So what else can we say other than trade like a trader? Tasty Trade.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. only at Tasty Trade.
When you trade options at Tasty Trade, you see your probability of profit and loss right where you need it. Earn up to $3,000 in commission rebates.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Ring the alarm, hey, ring the alarm, boys. Turn up the charm. Listen up, y'all. Get out the damn stall. It's the last call. Hey, the last call. The last call. The last call.
Hello, everybody, and welcome to Liz and Jenny Last Call. How you doing, Jenny Andrews? You made it home from the lake?
I made it. After the last show, I said, everybody pack up, let's go. They wanted to go out to lunch. I was like, no lunch, waiting in the car.
Did all 16 drive together?
4 of us drove together. 2 of us stayed up. 2 people stayed up there.
Oh, I know which 2.
Yeah.
Oh, hey, Jenny, you didn't leave the high schoolers, did you?
No. No, but we made it. We made it in the nick of time. Turned on my computer at 10 after 2. So we made it. We're here. Before we get into earnings, let's talk about tomorrow. Tomorrow's Wednesday. What's your assumption?
Yes, we do. It is, you know what? I don't know if we can pop in. I know the Bat Brothers are gone. I like to call them the Bat Brothers. They're gone this week. So it's a different lineup. I wonder who it is. It's going to be doing What's Your Assumption tomorrow. Whoever it is, they're going to be up for the task. Give them your best and your brightest trade ideas.
Yeah, so send it into tastylive.com/assumption. And I hesitate to say boys because you never know who's coming on tomorrow.
Well, I think it is 2 boys.
I think so, but I didn't know. I never know if Julia. I know with Julia, we're gonna have Julia on Thursday with us, I believe, or she's putting together something for us.
Yes.
She may not be live in person, but she's putting together something for us. And tomorrow probably is 2 boys. I'm at a loss for the schedule, but it's gonna be a great show.
I think it's Jamal. I think it's Jamal and Mike Butler, maybe.
Sounds right. Sounds right. Tune in and be surprised. Okay, Liz, Spoos are down 42. Not too much action between our morning show and the afternoon. Everything's been holding around here.
They have been holding. I mean, they were up a little higher than this, but this seems to be kind of where they've, kind of burrowed in and are sitting here. I'm knocking on wood as I say this because my son needs SPX above 10.
Oh, let me pull up SPX. So SPX, he needs it above 75.10 and we're 75.17. So I think it's looking good.
This is anything goes. Because right now it's still a loss. Like when you look at his trade, it's a loss.
Oh, okay. So he has the 75.10, 75.05.
Oh, I lied. Right now it's a $25 winner.
So small winner.
Yeah, but that just happened as I looked down. Like it wasn't like that before.
Decay in the last 30 minutes. It's a crazy thing.
It is a crazy thing. It's crazy.
It's a crazy thing. I want to look at XSP since we have that XSP guy. I can't remember what he says at the very end of the day. Oh yeah, look at these. It's like 8 cents. So cheap.
No, but he said that you try to do that when they have some type of earnings, right?
Yeah, I was just looking to see when you look at that rapid decay in the last 30 minutes, 25 minutes. I wanted to see if there was anything here, but really in the out of the money put, nothing. This at the money, the 752, 69 cents.
That seems like a lot.
69 cents.
The only reason I'm saying that is
that's just like a $6 SPOO move.
Yeah, that's right. That's what I'm saying because in SPX it'd be $6.
Yeah, like a $6 SPOO move. That doesn't seem like much.
Yeah.
$6 SPOO move, right?
No, I guess it's not that much.
Is that what it is? Just $6
right.
here? The 52?
Yeah, it'd be $6.
Yeah, $6.
Yeah. Hold.
I mean, it's 2:37. Anything can happen in the last 23 minutes.
I know. No, we do have some earnings. Do you want to take a look at them?
Yes. So today, ZS, I think it's Zscaler. Fox,
Zscaler.
Dick's, BBWI. That might be Bath and Body Works. That's a shout out to Mikey.
Oh yeah, doesn't he love Bath and Body Works?
Pinduoduo and ANF. Let's start with ANF and work our way backwards.
Sounds great. I love a reverse. Reverse.
ANF $74.
Are you surprised it's $74? Because I am.
Well,
I don't look at it that often, but in my mind, it's $40. When was it $40? Go back and look.
Okay, so long ago.
Yeah, like it wasn't that long ago. It was $40. So
yeah, but it got as high as 200, which was.
I know, but I don't trade it. I never traded it when it got up high. I just remember being like, oh, it's only like a $30 stock.
Okay, so my trade, the only trade that I had, been doing was my ANF American Eagle pairs trade, and this was, I think ANF at one point was up to like $6 billion in market cap or $7 billion in market cap, and AEO American Eagle was half. Now they're about the same. Now they're both about equal companies. So if you think ANF is gonna. I don't know what's going on in ANF. I don't shop there, except my daughter has she bought one sweater from ANF that I steal and wear all the time.
Which one? That's not the clearance sweater.
No, it says salty. So if you find me at the lake, I've got the salty sweater. I don't mind. I really don't mind putting on a bullish trade in ANF.
Sure. At $74, fine. At $112, no.
Yeah. At $74 at 3 point whatever billion market cap.
Can we look at only because it's fresh on my brain? Do you want to see? And I don't know if it's going to work. So we did not bet this. A buffer.
Okay. Yeah. The $10 expected move, it might work. Usually you need a decent move for it to work. 74.66. So that's $8 wide.
Okay.
And then buffer, you buy a put spread, 74.66. Now we need to cover that $3 extrinsic value. So we find a call that's worth that.
79.
Yeah, 79, even the 80.
Even the 80 is fine.
And we sell that corresponding put. Here, we're getting $5 credit. If it goes up over 80, we keep $5. If it goes down, our break even's around 66. I know we might have a small loss in between here. Let me go to the analysis page. I don't hate the.
There is. I would like to say this isn't the end all be all, because you could probably sell something for $5 and it'll give you $5 in room. Do you know what I mean? This needs to go up. And now our break even is farther, but it needs to go up.
Our loss to the downside is $95, and then more once we hit that decline.
All you got to do is pull that one up. You got to pull the 74 to the 75.
Then we're getting $5. We're getting
there you go. There you go.
We still have a loss of $55.
Every
time we pull it up, what I hate is we're getting less and less profit potential. So we went from $5 to $4.45. Maybe if I make this narrower.
Yeah, you got to make that a little narrower. There you go.
There we go. Just about no loss. And then at the 67 level, we'd get long.
Right. I don't mind this. No, I just want to compare apples to apples. I like this. I think these are great for earnings trades. It has to go up. See where it's trading right now is you can see that little flag, barely see that little flag. It's trading right at, 74.50. So it's got to go up in order for us to make money, but it smooths out our break even to the bottom. Now, if we were just going to can you just go to the table page? Don't clear this. Just go to the table page. If we were just going to try to get 480 in premium, you're just selling that 75. And in that case, your break even would be 70. So it's giving us, so you see what I'm saying? Like if you just sold that 75 put, your break even is around the 70 level. So it gives us $3 additional in break even. But if it goes down, you can still make a little bit of money. It does buffer it by a little bit more.
Right. And so if we just sell the 75, it doesn't even have to move. It could stay right here and we could keep that $5 this week versus it has to go up for us to make $5. To your point, we're getting $3 extra in room to the downside. Like it could fall to 67 before we really start losing at Friday at the end of the week on Friday. Versus this 70 is our break even. I think either one
So I kind of like the buffer. This is just an opinion, and I don't know if we can do any research on this, but I kind of like the buffer when you have the momentum behind you. I don't know about going into an earnings cycle. I kind of like it when it's up and it's like, okay, well, I still want to ride the wave, but if it comes back down, I don't mind getting in at that cycle.
And so here we can get $500 profit, and let's compare because they're similar, but this one's not defined risk. So here we have $500 in profit potential, and it's undefined risk. We'd get long 100 shares at 67 versus the diagonal where I can sell the 85, buy the 75. So I've got $10 wide for 360. If it goes up, this has $650 and $40 in profit potential.
Yeah, you can make more. You can make more. So you kind of got to weigh
your
the
risk
pros
is
and
only
cons.
360. Your risk is defined at 360.
So I do like the buffer I like the buffer for riding the wave, in my opinion.
I like the buffer for riding the wave. We kind of like diagonals on earnings because it's defined risk. So
and it's lower. Yeah.
is all we could lose. We could even make it cheaper and give up a little bit. I was going to move it down, but what do you say? 350 on a diagonal?
Take a fill, Phil.
Then it's defined risk. Then if ANF drops to 50, we're only out $350.
Yep. There you go. Either direction, we need it to move up. And maybe we'll put it. Oh, good.
And if this wins, we're at the SIBO. I was going to say, if this wins, I'll wear my salty sweater tomorrow.
You can't wear it under your blazer.
It's not going to fit under my blazer.
You would be sweating.
You should have seen me, Liz. Wait till you see me in my blazer tomorrow. I went to there's an outlet mall in Michigan City, and I went to the Ralph Lauren store, and they had blazers on blazers.
How many did you get?
I actually only bought one because most of them, it's perfect for you. Most of them, the sleeves were too long on me.
Oh, I can't get things that the sleeves are long enough. I'm built like a gorilla.
Every time I tried one on, the sleeves were way too long on me. And so it was kind of a disappointing day, but I'll have to take you there. Blazers, and their sleeves are long.
Well, and I always say this, like I'm a small tall. So like everything is short on me. So that like things come up to here and like the pants are always short.
Yeah.
So yeah.
But it makes sense that would fit you, that the Ralph Lauren models and the Ralph Lauren clothes are made for like taller.
Tall. Because, they should make everything for tall people because you can cut it down. I can't extend it.
Right.
Do you know what I mean?
I know.
They should make everything for tall people because short people have a way to do it.
All right, so we're filled on this ANF earnings trade here.
I did want to look at Zscaler too. Will you cancel that Microsoft that we've been working it all day and we didn't get filled?
I know. Cancel order. Oh, here they are. I missed the garbage pickup. Called them. They're coming back.
I can't believe, Jenny, you are just a trailblazer that I want to be like when I get older. I had no idea that I could call the garbage man and make him come back.
I said, bill me whatever you want. Just please send back the garbage man.
And I called Jenny the other day and I was like, you are a genius. I went through the McDonald's drive-thru. They were like, it's a Diet Coke. I was like, give me a water. Give me anything else. I'm not going anywhere.
They wanted you to pull up for a Diet Coke?
Yes. And within half a second, the Diet Coke was out the window.
Yeah, for our newer viewers who don't know this story, if you pull up in the drive-thru and it's something that you know is quick, it's not like you ordered something custom, something you know is quick, and they say, oh, pull up, we'll bring it to you. Don't buy it. Sit right there.
You're going to stand your ground. I'd never seen anybody do it before you, and I'm so proud of you. But I didn't for the Diet Coke. It came out so fast. I was like, give me anything. I'll take a Sprite. I don't care. I just want to leave here. I'm not pulling into that spot. I'm not going to a second location.
I remember I felt like the guy in Office Space when they're like, you're going to have to pull up. No, I'm not going to.
No, I'm just going to put a pin in that.
All right, next, working backwards, ANF Pinduoduo.
Oh, I do want to look at PDD.
Yeah.
You want to know why? Because it's Temu. And I, for the life of me, can't figure out how to get past that spinning wheel to order something from Temu. Because there's this one thing that I want for the garden, and I can't figure out how to order it.
I'm done. I'm done with Shein. I'm done with Temu. I'm never going to order anything from any of these places again. Never.
Well, I want one garden ball that I saw, and it keeps popping up everywhere. And every time I try to buy it, I have to go through that wheel. And then I was like, forget it.
So PDD down to 97.
And there's a reason, Temu. Shame on you.
I was going to say, I feel like this is when PDD got hot, and all the kids were on it, it was trading right around 100. This was its level. It's back.
Yeah.
It's back to its level, which I don't hate. I don't hate puts in there. Or a Jade Lizard. It's a good Jade Lizard candidate.
It is a good Jade Lizard candidate.
We've got the 103, 104, 90.
Yeah.
Or yeah, that's not bad.
No, I don't mind.
The buying power is not great.
No, I don't want this. If the wheels fall off scenario and I have to look at this thing every day, I will not be happy. I will not.
And all you're gonna think about is that garden ball that you didn't get.
The garden ball that I want, but I cannot put my hands on.
Okay, things don't come. I'm not saying things don't come, but everything. If I ordered 10 things from Shein, is it Shein? Shein?
I have no idea.
If I ordered 10 things from Shein, 8 of them went to Goodwill. I'm done.
Always. Yeah. Yeah, for sure.
I've had it. That's why I was happy to walk into Ralph Lauren until I realized it wasn't made for me.
Until you had to walk out with it.
All right.
You know, the good news is, as I'm looking at this, I'm not sweating it out anymore. Both mine and my son's will be full profit. We let them go.
Oh, excellent. The SPX.
Yeah.
Excellent.
Do you want to know what I've been doing? We can talk about it again tomorrow on the show. In SPX, the 0-day Jade Lizard.
Oh, but don't we have a short-term study?
We do. That's what I'm saying. And I've been doing it, and I've been doing really well with it. So in the morning when you put it on, you get about 570.
Nice. Yeah. I think we're doing a study, and you could talk about that. I'll pull up SPX. You can talk about it because I want to put in, because I'm in our show account here. I actually want to put in the what were your strikes for the 0-day Jade Lizard? I want to put in the A and F diagonal into my account.
Okay, so the strikes for the Jade Lizard were 7,500, 74.80. So I'm $20 on the bottom and $10 on the top, and I collect about $6 for it. Then the top was
7,500,
74.80. 74.80, $20 wide. 7,500, 74. No, you're on the the puts.
Okay. But so that's how far you got this morning.
Yeah, this morning, and it was the expected move, 74.80, and then to the top side, it's the 75.50, 75.60. So I do $20 by $10, and you get around $6 or $7. But these have been expiring. Like this is expiring, completely worthless. I'm a certified badass option trader who did not put a GTC in to close it, and it was tempting to close it throughout the entire day.
No, that's nice. So you got full profit.
Yeah. So it's been kind of nice.
I hope I did this right. I just quickly threw this on my phone. Filled.
Oh, okay. So let's put on some fun trades. We got to do something because we need to, we have 10 minutes. 10 minutes. Let's put as many as we can.
Okay. So PDD, BBWI, that's Bath and Body Works. That's
Bath and Body. Is it Bath and Body Works?
Bath and Body Works. Yeah. It's got all over it.
Let's speed trade.
It's okay. Yeah, let's go. Let's just sell some puts in here. Bath and Body Works, 3 days. Wait, speed trade. Do we really? What time is it?
No,
we have plenty of time.
I'm just saying the chat wants us to put in as many trades as we can.
Bath and Body Works. I'm going to sell the 16.5 put for $45. What do you think of that?
I mean, can I call you TP?
Well, okay, here.
I like it. I think that's exactly what we should be doing. It's a low price product, 16.5 put for $45, high probability trade. When you break it down, you're not using $600, you were using $200. So you're using about 25%.
BBWI. I know you complain, but I don't hate these. So it's in the 3-day.
I don't, that's what I'm saying. I'm breaking it down. If you break it down into its smallest parts, like you try to tell your kids on that from a percentage wise basis, it's not bad.
Yeah.
I'm going to tell you, it is insanely hot in my house because we don't have any air conditioning right now.
Sell to open. I'm done. I'm doing it mine. So I'm doing 10. So if I sell 10, that's $450.
Jenny, I cannot control the computer right now. Can you please manipulate?
This is why like hear me now or hear me later. I like to trade in my own account, which is why I
know I should run that call because I can do both.
So here's my order. Here's my little order for selling these puts at 45 cents, not getting filled. But I'd be happy to take.
Now carp your market by putting them in for 40.
No way,
40. Yes. 45. No, now we're after you.
35 cents. That's why I had to get mine in first.
You should have just curbed it.
Okay. Next up, HPQ.
Wait, are you on the right day? No, that's Wednesday.
Oh, what did I just do? Oh, but here, ANF, PDD, BBWI, Dix, Box, and Zscaler.
What is Box with a 1X? Because I know.
Box Inc.
Of course.
Box Inc. I don't know what it is. I've never traded it. Box Inc.
I haven't either. But it's got a 95 rank. There's no weeklies. 4 million shares have traded. 95 rank. Did we see the chart? I'm going to bet that this is going to be a lot of capital.
Well, and okay, open this up and these numbers I see like $1.90, 60 cents. This is what I'm looking for in weeklies, not in a monthly.
Yeah. But can you see how much capital is still a put? I just want to see.
Oh, sure.
I don't want to sell it. I just want to see if I'm right in the capital department. No, it's not bad.
It's not.
It's not bad.
I want me to put this in 65 cents on a box.
No, I don't care. I don't care. I just want to see how much buying power it was.
Box Inc.
Because like I said, I always have BOXX in my account because it's replicating the box.
Oh, yeah.
And I'll go in each night and actually use whatever capital I have and put it in box, BOXX.
So we're down to the last one, Zscaler, with 7 minutes to go.
Woo!
7 minutes to go. We're down to the last one, Liz. What do you want to do?
No, but I mean, I just wanted to put in more trades. We could also go to the watch list and trade from that perspective as well.
I also want to add some DraftKings positions.
Oh, yeah, we could do that. Did you want to do anything in Zscaler? So Zscaler's got almost a $24 expected move. That's a lot for a $185 stock.
Yeah, that's a lot for Zscaler. Has Zscaler been? No, look at Zscaler.
Huh. Let's take a look.
Okay. $24 expected move is a lot. If you go down to it, let's say we go the 16 delta. Oh, and that is, I will say, now it's all coming back to me. The conversation with Roy, he said he likes the 16 delta, which makes no sense in Rocket Lab.
You forgot that when you're talking about Roy today.
All right, so if I go to delta and I just go to 16 delta here, do you want 250 in Zscaler? Although there's a lot of buying power.
No, I'm not. No way do I want 250 using $6,000. No, thank you.
Okay, then, I'm in the 10-day. Could have been in the 3-day. I just want to see how expensive the 185
calendar
210.
Oh, that's a diagonal.
$25 wide for $1,000.
I mean, it's not bad.
It's
not. This is too much buying power for us to have to. Like, the problem with the buying power is if you hit it and you're stuck with it, you're stuck with it. What about a $5?
$5.60 put spread for $1.
What about a $5 and add a $250 on the top? Let's see what we can get.
Oh, $5 on the bottom.
$250 on the top. You'd have to go 202, 205.
So then you're within the expected move. It's not terrible. Zscaler, but these markets are wide.
No, let's go back to DraftKings because I kind of like your DraftKings idea.
Well, we have DraftKings. We have a Bob on Fire in DraftKings, and DraftKings is looking like a dog this week. Oh, filled in BBBI. Did I get filled? I better have.
I hope not.
No. Not BBB. Yeah, I'm still working my 10 lot.
That's insane. You should have had a 9 lot.
I had it in first.
You did. Did you put an all or none order in?
Wait a second. Oh, no. I'm filled.
Okay, good.
I'm filled.
Because that's the only way that it would not fill is if you had an all or none and somebody hit a 1 lot.
No, I don't even know how to put all or none.
Don't you remember this from the trading floor?
But in this trading, I don't think we can hear. Like, I don't think it gives us an option. Oh, let me sell, 10 of these 24 puts, all or none. Does it?
I don't know. Go to limit. No. Day.
No.
I want a line that I can write in all or none.
All or none. All or nothing. Okay. DraftKings 2388.
I made a bonehead move today in DraftKings, and you can tell me that I'm wrong. So my account and my DraftKings position is bigger than a bread box, because if you look at this chart, what I did was sell puts. And do you know what I did as it was going down? So I kept getting longer and longer. And guess what I did again today, Jenny Andrews?
What? The downside ratio spread?
No, sold additional puts.
That's all you can do with $23. One day, Liz, one day, I feel it. I feel it. One day, now this is for legal purposes, I have no idea. But one day I feel like DraftKings is gonna get their act together and it's gonna be something. It's gonna be something someday.
For legal purposes, you shouldn't listen to us. Yeah.
For legal
No, I
purposes,
have been telling.
I have no idea what DraftKings is ever gonna do. But in my heart of hearts, I'd like to think that one day it's gonna go up. What puts did you sell today?
I will look right now, Jenny.
Hey, was that you just getting filled on BBWI puts?
That was our account, BBWI puts.
No, I just heard a ding in your background.
No, it was like a delay. It was my other computer. And it says, I didn't put any BBWI puts in. Okay, DraftKings, what did I sell in here? Today, I sold the 24 puts.
What? Oh, yeah, and that's what I was looking at.
The 3-day 24 puts.
Yeah, who couldn't use an extra $54?
Exactly.
You just made fun of me for getting 45 cents in BBWI.
Well, I know. I told you that this is my bonehead move that I did today.
I don't think
because this is puts on top of puts on top of puts, which is probably a bad idea.
I don't mind. In the 10-day you get to the 23, and in the 3-day you're at the 24.
I don't mind either one. Those are 6 of one, half dozen of another. I'm fine with either of those.
Yeah, we'll just add this little 3-day
and that one got filled. I don't
filled immediately.
Why did it say partial?
Did it? So we added that. We have 2 minutes. We usually have added puts on our IBIT, and right now all we have is our Zebra, which is
actually. Take a look at that Zebra. Here's what I did on my Zebra, which is also bad trading 101. I bought back my short call.
Oh, that's not bad. Okay, so here's the Zebra. We had two longs, one short. The short.
Jenny, I've been trapped up here in this room for a long time, so I've made some bonehead moves in my account.
No, that's fine. The Bitcoin's down, crypto's down. You take a look at I know in my mind it feels like it's down more than it looks, but it had.
When I saw that the long was the right there, I was like, ooh, I'm gonna just take advantage for a little bit. I'm not gonna leave it forever.
So here, if we're gonna buy this back and pay 71 cents, let's just go to the end of the week and get 50 cents. Then we're only paying 20 cents to get it back.
And Jenny, we also got filled on our natural gas as I was pushing these out. So you should put an order in to butterfly it off.
So I'm paying 20 cents. Basically, I'm going to sell this 3-day 43 put. We're getting crazy with these short terms.
You can still put in natural gas.
I just got filled in IBIT at 301. Look at that timestamp. What was the timestamp?
I don't know. What does it say? Hold on.
300.01.
Yeah, are we going to get a call from the trade desk to bust that trade?
It literally got filled after the bell.
I know. Here, I know we're cutting the boys' times. I apologize. Can you go to the natural gas position that we got off on there? It's a broken wing butterfly.
I will, but maybe IBIT trades after, like some products do.
Possibly.
So this is all expired.
They're all expired. We got filled in the other one. So you're going to want to move the 65 to the 75.
Do we have to do this right now?
No, I just want to see if it'll go through. We can do it later. It's fine. We're filled.
I know, because the NGM expired today. That ended at 2.893. So
yeah, and the boys are waiting in the wings. All right.
Yeah, boys are ready to roll. We will be back live from the SIBO tomorrow, and the first thing I'll do is put in that natural gas position that Liz wants me to put in.
Sounds like a plan. All right, everybody have a wonderful night. Good luck with your earnings, and we'll see you tomorrow on the SIBO floor.
Have a great day. Bye, everybody.
I've got some huge news for traders everywhere. On June 4th, the pattern day trader rule will be replaced by new intraday margin rules. tastytrade has been advocating for an updated PDT rule for years, and we're ready to go on day one. You'll have more flexibility to manage risk when and how you want. Join tastytrade today.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
In the 20 plus years you and I have been working together, our trading has really evolved.
Yeah, no question.
Completely.
Yeah.
And one of the things is that we're not married to a strategy.
No, of course, yeah.
If we can do something better, we will do it better.
One of the misconceptions there is about being a professional trader is that we do such complex strategies, and that's just not the case. What we do are simple things very frequently every day. That might be taking 50% profits, that might be rolling a position to a different expiration or a different strike price, that might be selling some premium to improve the cost basis of a losing trade. What I want people to learn is an effective way to approach the financial markets and to use options to their fullest advantage.
Think you know where vol's gonna go? Test your theories with backtesting. Pick from hundreds of symbols, any strategy you want, and all the data to trade smarter. Tweak the delta, dial the DTE, stack the legs, see what survives. Trade what you want, when you want with Tasty Trade.
NASDAQ 30K. It's still Tuesday, May 26th, 2026. This is Overtime. I'm your host, Chris Vecchio in New York. He's your co-host, Ilya Spivak in San Francisco. We're here to take you through the next 26 minutes as we wind down this trading session. A trading session that was once again defined by the semiconductors and tech leading the way higher. Micron up nearly 20% today, passing $1 trillion in market cap after UBS upgrades its price target from near 800 to 1625, which would give it a $1.8 trillion market cap. In any event, here we have those names that have been squeezing higher, continuing to squeeze higher, your SanDisk, your Western Digital, your Seagates of the world, but it's also the broader tech space. NASDAQ here, as we go to the charts, 30,068, that's 75 here. In our after hours, it's a 1.72% gain over 509 points. The S&P, not quite as strong as your NASDAQ, still up by 0.62%, and off the lows that you and I were seeing about an hour and a half ago, closer to 75.20 there. But nonetheless, it is the semis. It's the semis, because that's where we're looking here today. Semiconductors are up at a new all-time high. SMH closes in at 602.14. That's a little bit of a breakout. And if it's not the semis, then it's oil, which fell out of bed and then recovered over the course of the trading day here, Ilya. So we're now post-holiday. We're now in the summer months. When does the madness end? You and I have been on opposite sides of this view. I keep saying that Micron, who cares? 6, 7, 8 forward PE. Everything's different now. This time's different. You think that's the hallmark of a bull gone mad? When does the madness end?
I think there's two different thoughts that you have to have here. The first thought you have to have is this is indeed madness. Not because you think it is, but because what's happening in stock markets and what's happening in every other market is fundamentally different. You have to start to think about what's going on just out of a general practice of good, clean analysis. When you have the stock market being driven by one runaway sector on diminishing volumes, and then bonds and oil and gold and the dollar are all doing something else, and they're all doing it together. So that's, I think, where you have to question this and go, okay, wait, hold on. This doesn't make a whole lot of sense. At the same time, I think you have to have the tactical thinking to say it is excruciatingly painful to try to pick the top on a good day in a strong momentum market. If this is a bubble and you truly believe that, then you really can't fight it, because it can go up in your face for no reason at all. So any of your logic as to why it is a bubble is all the evidence in the world not to try to top tick it. So the only thing you can really do, if like me, you are skeptical, is see opportunities where there's some pockets of weakness and take a stab and say, is this maybe the time it runs? Oh, nope, that's not it. And in order to be able to sustain that kind of an approach, to eventually hope for an outsized swing that subsumes your losses and then some, you have to be really militant about risk, reward, and size.
DRAM, the memory ETF, which is not just American stocks for what it's worth. Ilya, you have SK Hynix, Samsung is also in here. Those are the two largest holdings between the two of them, 47.5%. But SanDisk, Seagate, Western Digital, they've all been on fire right now. It's interesting that this happens on the other side of a weekend where we really just don't have a catalyst that drives us forward. Maybe we do. Right. Friday, you have the announcement from Micron that they're unveiling production of some new DRAM at this Manassas, Virginia facility, which is finally opening up after the $200 billion investment from the CHIPS Act in the Biden administration. That was nice for Friday, but that was Friday. And why today? Why today? I mean, it's almost as if the market is still going through this dramatic repricing, we talk about commodities being a snake eating its own tail frequently. That's one of my favorite analogies here. It almost feels like the snake has spit out the tail and realized it can slither forward because it's not behaving like a commodity all of a sudden, the way that those forward PEs are moving. Typically with memory stocks, historically speaking, you get these very large trailing 12 months TTM PE ratios, okay, because there are problems in the supply chain. There wasn't a lot of demand there. Demand has now risen in the current window, and then forward.
Very much so, as a matter of fact.
Then you get so you get lower forward PE because the market thinks you're going to get this big increase in price. You're going to have all these additional earnings, but the chip stocks themselves, this is all part of the boom bust cycle. So you don't get too far ahead of ourselves and think that you can extrapolate it into the future. Ilya, when we first had this talk, Micron had a 6.5 forward PE. It's now only up to 9 with today's move. Now it's trading north of $900 a share. This is one of the reasons why, as a trader, there's a difference between like the investor and CFA charter holder part of my brain, and then like the trading 0 DTE, like let's look at the 45 and 21 out part of my brain.
Yes.
Like that. The 45 and 21 part of my brain says, why would you try to step in front of this? This is just, you wouldn't runaway train. You either get on long and hope that this thing keeps running, or you don't do anything at all, because if you're wrong and you're short, you're going to get slammed.
Yes.
And it's also the hottest trade in the world. So like if you're long and you're wrong, no one's going to fault you for jumping in, particularly if you're a professional. The forward PEs though, that's this CFA charter holder part of my brain that's speaking up and going, if this is fundamentally changed, then an 8-9 forward PE for this particular stock or the sector is ridiculous. That's still way underpriced. Time frame here matters most. I just don't know how you stand in front of this right now. We keep looking at signal versus
I don't think
noise.
you do.
Today, by 11 o'clock this morning, you had $113 million of call buying activity that had already taken place across the tape. I think by the end of the session, it was about $145 million. That's enormous for a single day in the options market.
Yeah. No, I don't think you stand in front of this. I think the choice you really have to make here is a different one. Because it's like what we've just said. If the price action is going to give you evidence that there is some sort of a break in the momentum, let's say, and you want to take a shot and the risk reward is good and you want to stay small and risk defined, and you can take 10 of those in a row before you start to get concerned, okay, that's a viable approach. That's oftentimes how I fine-tune the macro timing issue, because macro is notoriously bad at timing. It doesn't say anything, as a matter of fact, about timing, because you never know when the market is going to start to care about whatever macro thing you think is going to happen. And so there's a lot of trial and error. So you can do that. But you look at Micron here, where is your downtick against which to benchmark risk reward for that kind of a thing? It's just not there. Now, if you look at the S&P, you have that. You have a really ugly candle that fails at the high, fading momentum. Okay, I get it. If you wanted to see if maybe this is a double top of sorts in the S&P, I'm very sympathetic to that idea. But attempting to fight Micron?
You would trade this as a double top in the S&P, given what we're seeing in the Nasdaq right now?
I mean, I would understand how, looking at that S&P chart, you would go, okay, yeah, I see this setup. You couldn't, I think, do that in Nasdaq today, although you have a lot of the same markers. I wouldn't feel as good about it technically, because again, if you think this is a bubble, then you must think that it can do ridiculous things for no reason. And if it can do ridiculous things for no reason, why in the world would you stand in front of it? There's no edge there.
Right now, the market is, there's no edge there right now. I mean, I can't trade an S&P 500 like a double top here. I know that we poked through, we pulled back in, but the context of even the equal weighted NASDAQ today up 1.26%, closing at a fresh all-time high. RSP there as well, right? Maybe this is one of those, what is it, a bandit island reversal, runaway babies. I don't know what they're called when you have the gap open higher, but
see if this makes sense to you, because I've been thinking a lot about this actually. Given how one-sided the market is, if money was coming out of the leaders, one of the things that you would see, not because the market was broadening or the rally was expanding, but because money was getting shuffled around from very loved sectors to those that have been forgotten, because the market is so skewed. So the first part of distribution would be a breakout higher in the equal weighted index. And when we've seen the volumes as low as we've been seeing them, we go, well, is this just money shuffling around? IGV has suddenly popped up. Has the story there changed at all? No.
Yeah, but when we look at stocks, I mean, Ilya, so much of the market volume has shifted.
And I'm long IGV, by the way.
No, so much of this market volume has shifted to options. So like SPY, there were 40.1 million SPY traded today. That's not to say anything about the options activity. And we know that the market's now heavily 0 DTE and like 1 to 3 DTE.
Well, what does that tell you?
People are not
more speculative and looking for more leverage.
Cool.
How do bubbles end? So again,
but that's been the case.
That's
for 3
not
years.
to say you want to fight it, but this is bubble behavior. Everything you're describing. Would you not then? Let's entertain for a second that nobody knows when the bubble blows, and it might have another year in it. Who knows, right?
It could be today. It could be a year from now.
It could have started already. It could be a year from now. Nobody knows.
It could be the last gasp, but yeah, no one knows.
Impossible. Nobody in their right mind would fight these runaway things that have 3, 4 vertical bars pointed up. There's no edge in that. But if you were looking at this market starting to feel a little bit worrying, a breakout higher in the equal weighted names against this kind of activity might actually be the wrong kind of signal.
Why is that?
Because it would tell you that money is not actually broadening the rally. It's chasing the thing that hasn't increased yet. It's become a churn. It's the same hot money just churning around.
We have a market mix today, Leo. I'm looking at the sector performance, and it looks pretty dang bullish from my view. XOP, XLE, IYE, OIH are 4 of the 7 worst performers of the day, and there are only 7 sectors that are in the red. The others include IGV, which is down a smidge, 0.02, and then XLF, XLP. So XLF is interesting. It broke out at the end of last week. It's in a little bit today. XLP, on the other hand, that's consumer staples. And then when you flip this around, it feels good. DRAM, XME, SMH. We can avoid GDXJ, but XTL, telecom, has that been a problem? Technology, home builders. If I'm looking at this on a pure sector rotation basis, I'm starting to see the names that we've been so lacking that a week ago we're saying, where are these folks? How come they're not participating?
Sure.
And now after, it's not like the money's leaving semiconductors.
No.
Right? You're getting now semiconductors pushing to a new high with the broadening out of the rally. To that point, right, one of the stats that we've looked at here in recent sessions has been the number of stocks trading above their 20-day moving average. Back on April 17th, that had a high of 81.1%. A few weeks ago, May 15th, Friday, May 15th, we hit a low of 35.2%. Lots of folks were saying at the time, this rally's standing on stilts. Where's the participation? With today's close, it's now 57.6% of stocks are back above their 20-day moving average. So the rally is broadening out. The breadth is improving. It's not just the AI infrastructure trade. It's giving those, there are second order beneficiaries that are now coming into play. The batteries, the cooling, the memory, obviously. We moved away just from the GPUs and the TPUs of it all. But now you're seeing it on a broad economic basis. So Atlanta Fed GDP now, for what it's worth, 4.3% for the second quarter. That's got to be good in the context of oil not punching through 100 and 120, 130 and staying up there. Oil at 90 with 4.3% growth is going to create inflation, vibe session, uncomfortable.
Okay.
But not falling apart, right? Isn't that like 2023 and 2024 again?
I don't think so. And I think you saw very clearly today that the answer is no. Because let's consider what we saw today. Oil gaps down and runs and has a long attempt at a breakdown. The market really wants to believe the weekend news. And we're at least the part of the weekend news that is supportive. Then all of it unwinds, but all of it unwinds in unison. You get the gap down in oil, you get the gap up in stocks. Stocks extend up, oil extends down, bonds extend up. Dollar gets a knock. All of it synchronized. Not a word about, oh, South Korea is doing this or these chip stocks are doing that. It's just when stocks go up now, these are the stocks that go up. Notice Mag 7s barely turned a flat performance today. They were down most of the day. So when stocks do their thing now, it's just a very small subset of stocks that are essentially the proxy for the entire market. And that thing is now the same kind of sentiment football as everything else, apparently, as of certainly how today's performance worked out. And so I think you have to ask yourself, okay, is this really a trade about fundamental AI earnings, yada, yada, anything? It will be at some point, again, almost assuredly. This is a story for decades, not months and weeks. But if the behavior today is any indication, then we're through the window where the earnings subsumed the stock market's attention. In fact, we've been seeing that happening now for the past 4 days as crude oil has kind of had its ructions. And now we're back into a stock market that cares about inflation and the war. And that does not make for happy thoughts, and that's why you have the S&P looking the way it does.
What does the market's reaction coming out of the weekend's news tell you about our attention span for the war? I know we're off the lows here.
Yeah.
And the headlines looked ridiculous. I like to do a little thing when
ridiculous.
When I have like holiday weekends where I turn off my phone effectively.
That was me this weekend.
I take phone calls, but I don't respond to text, email. I don't check social media. My kids are home, wife's here, family time. That's it. Staying centered and focused. Saturday night, I got a phone call. Like, oh, yeah, because someone was calling to complain, like, oh, what do you think the market's going to do? I said, I have no idea. What are you talking about? Oh, Trump just announced an Iran deal. Okay, now I've got to break this stupid thing. So now I have to go back into the social media pool to see what's going on and get a grip on this. And so from when I checked in on Saturday night, I had my phone back on for 2 or 3 hours. It looked like there was a deal coming together of sorts. Then when I checked again yesterday afternoon after 5 o'clock, when I finally reemerged from my hibernation, I saw that the U.S. had changed its tone dramatically, that Trump was walking back a lot of things, that we had conducted defensive airstrikes, which, again, framing them that way, it's kind of like the love tap language, Ilya. There's a read-through that they're not trying to escalate once more. But there's clearly been a lot of pushback from, lack of a better phrase, the neocon foreign policy establishment. Ted Cruz has been up in arms talking about how this was a bad deal, and then name every single senator like him. Lindsey Graham basically had a stroke over the weekend on Saturday night looking at the Iran deal and was much happier yesterday when everything was coming to settle down before the futures market opened up on Monday night. So, there's part of me that says Trump really wants to get out of this. I see this Trump wanting to get out of this, and I look at this bearish rising wedge in oil, and the market is really, it doesn't want to fall off. There's a reason why it's not going to fall off back down to 65 or so where we were pre-war. But it really also feels like it needs something different to happen for it to go up sustainably. We're going to need a catalyst to get us like pushing dramatically higher again. If we go higher, it's going to be scratching and clawing. The odds of this being like tomorrow we wake up and we're at 115, a bomb's going to have to go off in Tehran, Karg Island, somewhere. Something will have had to happen, but that does not seem to be Trump's appetite right now, for better or for worse.
Well, I mean, this is a duality that we've explored thoroughly over the past 24 hours. What did we see? The president came out and said, we're closer to a deal than ever. And then we shot some things. So, and one of them was Lark Island, not just a little bit off to the side from Karg. So, okay, which thing is it then? I think there is a kind of duality that's going on here, and it's unclear what's what. Because at the same time as you have this kind of confusing back and forth, you have a statement out from Iranian Supreme Leader Moshtara Khamenei saying, welcome to the new Persian Gulf, welcome to the new Middle East, we've won, we now control the strait, there's going to be tolls now, it's not a tax, it's a tariff type of language, as we've discussed. And so we have a situation here where it seems like there is push and pull on both sides of the belligerents here, from a kind of let's just figure out a way to settle this thing and get back to business camp, and a much more hawkish camp. And that seems to exist in both Washington and Tehran. And so who knows what this is? But I think from a market's perspective, the much more interesting thing, you see that big green doji looking thing that is the top of your red line there, the top wick where your line starts? Oil hasn't really deviated from that as its kind of center line for a while. And the bottom line here really has been that this has the sort of relative stasis around an axis. It's occurred while countries have spent down huge amounts of their reserves, especially in Asia, and all manner of special dispensation has been made for Russian crude that was already seaborne. It was quietly allowed to be delivered, and maybe sometimes not so quietly. So the situation has been relatively flattering, actually, as far as supply. And yet the price is stuck here. And this seems to look like a kind of new normal. The larger idea here is what all of this means for rates, for central banks, for currencies. And we're already seeing those effects. As we said before, the markets have been on this time for a while. It's just stocks that are over here dreaming about AI data centers.
And reason they have Micron here up 19.3% today, in a very signal versus noise kind of way. Friday afternoon, we were looking at, I was paying attention to President Trump's speech because he was here in my neck of the woods, in my congressional district, giving a speech to help boost the incumbent Republican congressman. And he spoke to my ear. Only two companies' names made appearances during his remarks, Micron and Palantir.
Mm-hmm.
And Micron here is up 19.3% today. Ilya, what a world. What an absolute world. Hey, that's not even
way
my
with the
favorite
market, everybody.
It's not even my favorite stat of the day. You know what my favorite stat of the day is, Ilya? The New York Knicks have won 11 straight playoff games. That's a pretty good stat. It's also a pretty depressing stat if you're a Cleveland Cavaliers fan. Cavs won 8-10 in the playoffs this year. It's the worst record for any team to emerge on the other side of a conference final. It's statistically the worst record you could have on paper if you go to a conference finals. 2 7-game series where you go 4-3 and then you get swept in the Eastern Conference Finals. It's a miracle. Nothing ever good happens in my sports life, Ilya. And you're a Golden State Warriors fan, so you know what this is like.
I remember.
Maybe this is the year. Overtime's out of time. I'll be back tomorrow, same time, same place, 4 Eastern, 3 Central, right after last call. I'm on tomorrow morning, Ilya. I'm doing the morning show with Jamal. So be sure to tune in at 8 a.m.
Hey, he's back. Tune in, everybody.
He's back. He's here. And then he's gone again. See you tomorrow. Stick around here for now, though, because Ilya's back with Macro Money coming up next on Tasty Live.
See you there, everybody.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better.
In fact, I've never seen anything like it in any corporation in the United States.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Pay for backtesting? No. Pick from hundreds of symbols, any strategy you want, and all the data to trade smarter. Tweak the delta, dial in the DTE, and stack the legs. See what survives. Check out Tasty Trade today.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
And we are back for a shortened week with maybe a new story for the markets as the tech earnings season winds down. Hiding behind what looks like a relatively quiet day for financial markets may be an interesting rotation in how things are starting to behave. That could maybe, just maybe, set up a little bit of a change in how things are going to run from here. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we're going to explore here first and foremost is the way that price action has evolved here as we begin this holiday shortened week. Of course, Monday was a market holiday in the US and, as a matter of fact, in the UK. So a lot of liquidity was offline for a lot of the major moving parts of what is now the sort of driving narrative behind sentiment, and of course, in particular, crude oil prices with the US-Iran war front and center and its various consequences. But now we get a little bit of liquidity back. We get the markets to have a little bit of a say as to what they think things ought to be valued at. And so we get a little bit of a signal from the price action here to chew on and see what comes next. Here's the S&P, and here, once again, we start to see pointed signs of exhaustion. Now, this is, of course, interesting for a whole host of reasons, but of course, perhaps the most eye-catching is there is still a loud rally in the tech sector. If we take a look at the way that things have performed as sort of the way that it breaks down below the surface, we continue to see a lot of the same kind of dynamics as we've seen, but with some interesting broadening of momentum. So, for example, today it was materials that outperformed, energy that underperformed. Over the past week, of course, tech has continued to blow out in the lead, but not without participation from some other sectors to a meaningful extent. So whereas tech added, let's say, 4.6% over the past week, something like industrials was up 3%, utilities up 3%, and a third basic materials, almost 3, 2.86. So there seem to be relatively comparable things, whereas, of course, if you look at a 1 month time horizon, tech is up about 11%, 10.7, and nothing else comes close. Comm services are the next one up at 4.3%. So we have a situation where the more recent price action seems to be a little bit more dispersed and better allocated across sectors than the one-sided rally we've had since the late March, April lows, where it was really all just about semiconductors. And even with that continuing to be the narrative today, where tech still looks quite strong, even though it has better company, as it were, we get a performance from the S&P that looks very much like struggling to break the high where, as we saw about a week ago now, a little bit over, we saw the reemergence of inflation concerns as a driver of price action. This red bar here that we see, that of course was the Friday of the 15th. And what we see there is an interesting kind of performance where almost on cue after that week's kind of big corporate earnings announcements and a big IPO from Cerberus came across the wires, the market suddenly discovered that, oh, there was an inflation threat out there, and seemed to lock in with the US-Iran war story that has been playing out in other markets. That is where we stall on the overall kind of benchmark for risk sentiment. Again, we likewise have diminishing momentum getting hinted at in the relative strength index with negative divergence there, higher highs on the index being diverged from in the indicator. Volume is fading as we're setting these higher highs, not just because we have a slow holiday kind of start this week, but over the course of the past 2 weeks or so. And so you get the sense that the thrust behind the move is sputtering, even as some of the high-flying names that have been behind it still look like they're pushing ahead, perhaps even with a little bit of a better spread around the sectors. As for that inflation story, it is much as unchanged as oil is. It continues to stick to the center line of its wartime range. What's particularly interesting is that we start the week with a kind of back and forth where there's a gap lower. We can see that here. And that follows some headlines over the weekend where U.S. President Donald Trump suggested that maybe we were getting close to some sort of an accord between Washington and Tehran. And then, of course, those reports started to come apart, first as the U.S. hit some targets, so some Iranian targets, and then as we got some fiery comments in a screed from Moshtaba Khamenei, the supreme leader, essentially taking the hawkish side of the conversation. And so we have a setup here where crude oil runs down on sort of the initial hopes after this weekly open gap, then runs all the way back and ends up going nowhere. What's very interesting about that, of course, is stocks in their momentum here mirror a similar dynamic. As you get the downside gap in oil, you get the upside gap in stocks. They run, it runs, both recoil and erase what could have been a breakout in both cases. Now, what's interesting about this is, of course, stocks' sensitivity to oil at all. They've been ignoring it for a few weeks now amid the earnings season and all of the happy thoughts about hyperscalers and semiconductors that need buying by those hyperscalers. So we have a situation now at the start of the week where there's seemingly a sort of recognition, once again, that there is this macro thing out there that perhaps threatens the narrower AI build-out frenzy story. As for the other major markets, they've been on that time since really this whole thing began. And so you see in the situation you see in the bonds, you don't have that kind of exuberance that you had in stocks. This was stocks bottom before they ran away to record highs. For the bonds, they, of course, continue to leak lower as the higher inflation implication of a stickier oil price at its kind of wartime levels continues to filter through. And as you saw with stocks having an upside gap, as you saw with oil having a downside gap, you get a upside gap here in the bonds at the start of trade, but the trend very pointedly holds. And so this kind of stair-stepping higher in yields and lower in bonds, it's very much intact here. Gold is a slower leak downward, but higher rates and the expectation of what that will be like and how that will come about as a function of inflation expectations and of policy, that clearly hasn't left gold alone, because although it looks like it's moving very slowly, it is nevertheless a series of lower highs and lower lows. So it is starting to kind of leak down. And perhaps there is something here that is shaping up to be a support to test somewhere around the 4,300 level, maybe. But for the time being, this continues to be a function of what the war trade seems to have wrought. This was the meat of the move. We had a bit of a correction. We are still going in the same general way here. And that, of course, speaks to yields being biased higher. It's a similar sort of thing in the US dollar. Here was its wartime reaction, of course, higher yields, flatter the dollar, and to some extent so does risk aversion when stocks were still caring about it. Then late March, early April, there is the turn across markets, but of course, unlike stocks and much more like bonds or gold, this only erases about halfway the wartime move. It has since attempted a significant rebound, and as gold kind of hovers near the bottom of its range somewhere over here, so too the dollar here is near the top of its range and attempting a push higher. We can see the weekly gap lower in oil ends up being a weekly gap lower in the dollar as well. But as oil has erased its losses, so too has the dollar to a large extent. And so this continues again to be this reflection of, well, from crude oil, there come inflation expectations. Those inflation expectations inspire higher rates, which inspires gold lower and the dollar higher. And the pressure of that, taking out some sort of a key level, has been marinating for several days, but continues to be very much at those breakout levels. Looking at Bitcoin, it continues to meander. Although the general architecture of the break higher has been now held, it seems, on a test. So here was the break higher out of this decline in the fourth quarter. This was the consolidation range. We've retested it now as former resistance becomes support several times. And for now, it seems to be holding, which seems to suggest that still the path of least resistance, albeit slowly, seems to be higher. Now, this doesn't appear still to be locking in with any of the macro narrative, be it the stocks one or the bonds one. And so it seems unclear exactly where this will find its cue, or whether it will just continue to drift sideways. But as long as that drift is sideways with an upward slope to some extent, shallow though it is, that seems to still be the path of least resistance. And there certainly hasn't been a reason from the macro side to think otherwise, just because this doesn't seem to look like the macro side in any kind of a meaningful way. After all, this digestion here was the breakout of the war. It is as though this market didn't even notice. Now, as far as the way forward is concerned, it's a relatively quiet week on the economic data front. We've got Australian CPI numbers coming up, but really the meat of what is actually on the docket here is probably going to be Thursday's releases of U.S. PCE inflation numbers, as well as the revision of U.S. GDP. Now, the revision of U.S. GDP might be interesting in that it'll start to break down the components. And so we'll start to see just how we got to achieve the growth that we achieved in a little bit more granular of a way. And so we, of course, know that there was a meaningful rebound in GDP in the first quarter. The fourth quarter was hampered by a government shutdown. In the first quarter, really, we saw kind of the makings of what is perhaps the main sort of argument behind this AI build-out maximalist idea that you can have economic growth at a reasonable 2% at a time when you have consumption, which is by far the largest part of GDP, growing, first of all, at a slower rate, 1.6%, and secondly, growing at a slowing rate now for 2 consecutive quarters, because you have this frenzied build-out in data centers that is making business investment grow so fast that it is contributing more to GDP than is household consumption. And that is something that is an interesting state of affairs, of course, because it is, of course, incredibly unusual. Business investment is only 14% of the economy. Consumption is 68%. But seeing how that actually works and the extent to which that build out is vulnerable to all the things that have been hampering consumers, high input prices, high energy prices, high prices for transporting goods and people, all of it. How all of that factors into that part of it, or at least where the vulnerabilities are, because of course this will not be new data, this will be revised data that we've already seen and expanded data that we've already seen. And so this is perhaps the most interesting part of this week's calendar. On the PCE side of things, of course, we've already seen CPI numbers, so we know that headline inflation rose in April from 3.5% to 3.8% is what the PCE version of the data is expected to show. Interestingly, more modest at the core from 3.2 to 3.3. We'll see, of course, the extent to which there is some spillover, as we saw in CPI, from energy and into kind of the core part of the inflation matrix, because, of course, that is the biggest issue for markets. That would be the part that would keep the Fed from cutting rates. That would be the part that would make this war something with a lasting impact on the economy and on policy for a significant period of time. That would be the thing that markets would say, well, you could have whatever peace deal you like, but this issue is not going to go away for a while, and probably not without central bank action. And that would meaningfully alter the landscape. But of course, having already seen CPI and PPI, we largely know that already. And so it'll be interesting to see if the markets really do much with this information, or if they just consider whatever happens here basically table stakes at this point, and that which version of that story we get probably depends on how much of an upside surprise this could come together. It's not often that these numbers surprise very much. After CPI and PPI come out, you can infer a lot of what the PCE is going to show. But it will be interesting, nevertheless, to see, even if only as a marker for sentiment, what the markets will do with the passing of this data. On the earning front, things are very quiet. Salesforce and Dell are perhaps the names to keep an eye on, but they don't seem to have the heft as a sentiment indicator like one of the Mag 7 names or something in the sort of hotter part of the speculative narrative, because it is a very narrow market with very specific and narrow leaders. And so to the extent that the stock market is able to shrug off macro, it probably needs news from somewhere within its kind of more effervescent names to really get things excitable. And of course, on that macro front, the story is, as ever, the melt up in inflation expectations, marked here by break-even rates, the 5 and 10 year, which continue to march higher as crude oil does, showing us that what we're looking at still is really the thing that bonds and the dollar and gold have already told us in the price action. We're looking at an inflation shock with consequences that are seemingly becoming more entrenched as we get this build in longer-term inflation expectations implied in the bond market. And of course, as that translates into policy expectations, the Fed now looking at 17 basis points in the direction of a hike this year, and of course, puts the probability of a rate hike well north of 50-50. And that's a sea change, to say the least, from the 50 basis points in rate cuts that were expected at the beginning of the year before this war. It amounts to a 68% probability that we are going to get a hike from the Fed at some point before the calendar turns to 2027. We're looking at something on the order of at least 2 rate hikes, with a strong possibility for a third, just over 50% probability for a third from the ECB, about 56%. We're looking at a situation where the Bank of England is expected to deliver at least 2 hikes. The RBA is expected to deliver at least 1 more, having already hiked rates 3 times this year. The Bank of Canada is leaning toward 2 hikes as well now, having expected nothing at the beginning of the year. So we're looking at a significantly costlier money structure. And the question really for markets now is, if the money costs more, does the myriad of risks out there make sense, or should the allocation of capital be less risky when the cost of money to replace whatever loss might be incurred from something that goes wrong in this risky environment is not only getting elevated, but likely to stay elevated? Because as long as crude oil is increasingly becoming entrenched and its impacts are increasingly spilling over, central banks are increasingly hamstrung and have to take a more hawkish tack. And so from a positioning perspective, I haven't really changed very much here. I'm still very tilted in the direction of higher rates as an overarching theme for the exposure. So I'm long the dollar against a variety of currencies here. Looking at the Aussie, the pound, euro, also short gold, but basically in the same vein, looking at higher rates, applying pressure to that market, short the middle of the curve through IEF, just outright puts here, the long end of the curve through put verticals in TLT, long oil through USO call verticals, long natural gas, around the same idea, through UNG call verticals. In the stock exposure here, because I'm looking at the downside as a better risk reward idea, I've started to sort of transition the exposure, whereas when I put it on about a month ago, they were put verticals. What I'm doing now over the past several weeks is selling call verticals against that, to basically collect premium to pay for those put verticals that are now going to expire essentially at max loss, to limit what those cost and essentially extend the life of bearish exposure, looking for a directional response. And so some of my NASDAQ has already rolled off, but it's collected more premium over the more recent trades than was lost when those puts from a month and more ago expired worthless. So that buys time, and we'll see if it works. Then, aside from that, just a smattering of assorted positions. Still long Brazil, still long Bitcoin, and long IGV. That's of course an underperforming part of tech since the beginning of the year, and maybe what we're seeing in the broadening of the sector performance and the slower outperformance gap for tech, maybe what that suggests is actually a kind of early defensive pull away from the market leaders, and perhaps there is some rotation here that, if one were to be thinking about broader risk aversion downwind, could be a function of the first steps. Of course, we've seen the equal-weighted NASDAQ and the equal-weighted S&P break out. Perhaps that is not the positive thing that it surmises in a diminishing volume environment. And so I'm holding that as a kind of relative idea, considering I'm relatively bearish on the runaway parts of the market, at least from a risk-reward perspective. And that is Macro Money for today. As ever, we are here right after overtime. That's a show that I co-host with Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm also writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on forum or Twitter and on Blue Sky. If you're watching this on YouTube, please like and subscribe. Macro Money returns tomorrow. Happy trading.